advancing after personal differences among members of the band. Strange that in rock and roll. About reaching an agreement, a little bit more difficult. Can you imagine that? Catalogue valued at $500 million. Rockers on the road deciding how much their music is worth.
That's a hot asset. Everyone
Absolutely.
wants to buy music rights. Okay, so this from the Journal this morning, Manus. Trump allies are working on a plan to privatize Fannie and Freddie Mae. Discussions have been underway since at least spring. One thing is clear is there's some people who stand to gain from this. Both Bill Ackman and John Paulson are holders in Fannie and Freddie Mae. They both support Trump, and they both have been calling for privatization of them.
Yeah, look, this goes back a long way. Of course, Fannie and Freddie don't issue mortgages. Everybody knows that. But it's the 2019, it was the Trump administration. They floated the idea about releasing the grip. And guess who's in charge then?
Well, okay, this
Treasury Secretary Steve Mnuchin. So,
yes.
You know, he's got a bit of form in these things.
They gave up on it essentially because, one, Trump lost the election, and then, two, COVID was happening, and there was this sense that the housing market was so fragile that messing with these behemoths would be an issue. I mean, you could make the same argument at this moment, Manus, that housing is quite particularly in a vulnerable spot as we start to debate rate cuts, considering the unaffordability of housing. Is it an issue if you start to tinker with these? But there's always a difference between what kites are floated during a campaign and what actually is a policy that the administration wants to pursue.
Well, I can tell you, as the dominoes fell over that period of time, you know, between Lehman, Fannie and Freddie and a host of other institutions, it's the kind of systemic part that it is in this housing market in the United States of America. There's only one story that's rocking and rolling. It's 50 basis points. We're back on the cards again. Have a look at the 2-year notes over 4 days and you begin to understand risk on, risk off. 25, 50. There you go. What have we got? Down 12 basis points from yesterday?
Yeah, you pointed this out to me, how big of a swing, down 12 basis points from the high of yesterday. I think we can have a robust debate coming up on just how much that Journal story actually matters. This is Bloomberg.
I think that it would be irresponsible for us to ignore the AI revolution. I think that as much as there is a lot of short-term hype, I think long-term it has the potential to be transformative. And so we are spending a lot of time thinking about what elements of it are structurally have barriers to entry. And so there is a winner-take-all element to that and which don't. And it seems to me that things like chips, things like infrastructure of, and systems has a little bit of that because NVIDIA is so far ahead, it's expensive to catch up. There's, the technology that it requires to build these chips are sort of based in Taiwan. What we're seeing is that some of the apps and some of the applications, there are no barriers to entry, right? Like it's fairly easy to come up with, and I don't mean to belittle the complexity of it, but there are not moats around those things like they used to. So I think that there is less of a winner take all in that space. You're gonna have to earn that spot, whereas, so it'll be fun to watch what happens. And I think there's gonna be a lot of money burned in the process because somebody will develop something and a fast follower will come along and make it better and cheaper because data gets cheaper and more pervasive, and it's gonna be easy for new players to come in and do interesting things, so I think we wait and we see.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Bloomberg loves
loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger, alongside Manus Cranny. Let's set your agenda.
It's 50 versus 25. The great debate rages on after reports of the Fed's dilemma. No deal. Boeing factory workers walk off the job for the first time in 16 years, rejecting the deal on the table. The next step in AI, human reasoning. A new release from OpenAI pushes the capabilities to new levels. Danny, good morning. Can't wait for that.
Can't wait for that. Maybe you won't see me standing in front of here doing a market check. Maybe it'll just be OpenAI reasoning in a human level to do this. Anyway, Manus, the thing that we need to reason around right now is a story from both the Journal and the FT saying that the Fed is trying to decide between 25 or 50. That was enough to both reinvigorate the equity market. Equity during the cash trade moved higher. S&P futures higher yet again by 0.2%. It also reversed what we were seeing in yields. Two-year yields go back to around their lows in 2 years after moving higher yesterday. That swing from yesterday's high to today's low, about 12 basis points, 3.5%. And the dollar versus the yen, that weakens by nearly 1%. We are at 140, the weakest level since summer of 2023. And Manus, all of this, again, appears to be off the back of a story from Nick Timiraos, basically titled The Fed's Dilemma, Go Big or Go Small.
Yeah, I mean, I've had some pretty scathing IBs in terms of this particular article. And I think what it does do, if anything, it brings back for the Fed the optionality, which had been taken off the table. If you look at the two-year notes over the past 5 days, that optionality had been taken over the table. You and I sat down with HSBC. We sat down with Allianz. HSBC said, get this snowplow out of the way. They don't need to do 25 basis points is what Allianz said. But maybe the Fed will welcome this optionality, the fact that 33% possibility of a 50 basis point cut. It means it can be not such a shock if it comes down the pike. But it's still the skew is, it's unlikely.
Right, well, it just feels like the first Fed decision in a while, and these stories really enforce this, that we just kind of don't know what they're going to do. Maybe it just allows them to have more FOMC members to say we wanted 50 basis points and set themselves up to go at it later. It's a really confusing one. I was kind of joking in the break. What if Nick Timiraos was simply trying to write just like a big thought piece, and now we're left just trying to read the tea leaves of something that maybe isn't exactly there?
But I think that just shows you how febrile the whole situation has become. You've got Powell, we know a little bit more dovish at Jackson Hole. We've got Waller open to doing bigger cuts. This just shows you just how fine a line we are on. Amanda Lynham is our guest this morning. She's the head of macro credit over at BlackRock. Now, you're going to have a much smarter answer than the both of us. But this whole narrative that the kite is flying again on 50 basis points, our guests have said, tuck it away. What do you think of the Journal article? Yeah. What do you think of the risk of 50 basis points, the risk and necessity?
Yes, well, good morning. Thank you for having me. I don't think we can rule out a 50 basis point cut. I think the important thing that we've emphasized, though, is that the depth and the drivers of this rate cutting cycle really matter for corporate credit sentiment, and I think risk assets more broadly. If there is a start to the cycle that begins with a 50 basis point rate cut, I think the messaging needs to be very crisp around where the neutral rate is, why we are starting with a non-traditional magnitude of cuts, because absent that sort of clear messaging that we are doing this to get back to a neutral territory, I think the market could interpret that to mean that they are responding to some sort of growth downside. So I think the messaging around the drivers is really important. And then more broadly, leaving kind of this year's rate cuts aside, we believe that there's scope for the Fed to cut to the, say, call it 3.25%, 3.5% range next year. And then we need to start having more clear conversations around where is neutral, where is the destination. It's not to say that they couldn't cut beyond that level, but I think once we start to get in that zip code, I think it becomes a more finely balanced decision as to are we normalizing or are we actually easing?
Well, because the oddity of it, of cutting something more than 200 basis points within the span of a year is usually something you'd see in a recession. Yes. But as you're talking about, it could just be getting us back down to neutral. Do you trust in the Fed's ability to communicate that if that's actually what they want to do?
I think they will have to. They've been communicating to us that the neutral rate is moving higher by function of the longer run Fed funds rate. So it went from 2.5 to 2.6, 2.8. We'll be watching the SEP in the September meeting to see if it moves further from that. Fed officials have also said that short-term neutral could even be above that 2.8% long run dot. So I think the directional trend they've been messaging. But for corporate credit, what that really means is that we are unlikely to revisit the depths of the zero lower bound of rates that prevailed for much of the past 15 years, and I think we need to adapt to that.
Can we just talk about the structure and the flow into credit? Yesterday, Mohamed Al-Arian was with the team, and he said, look, money from the sidelines is coming into bonds. It's like the last sale of a decent yield in bonds. What are you seeing in terms of that flow into credit?
In addition to the money from the sidelines that's coming out, and I would say even asset class rotations, keep in mind that we are in a higher coupon environment, and all day, every day, bonds are throwing off higher coupons that need to be reinvested in the market. So the technical picture is really strong, not just from the demand side, which you mentioned, Manus, but there hasn't been a lot of new supply that isn't related to refinancing risk, specifically in the high yield and leveraged loan markets. And so we have a very favorable technical setup in corporate credit. It's a very growth sensitive asset class, though, as you know. So there is a lot of scope for spreads to widen if we have a severe growth downturn, not even a recessionary downturn, but just a really sharp slowing, not our base case. But actually, it's been hard for the credit markets to sell off in a sustained way. You've seen the markets try to widen. Money comes in, especially yield-based demand. So there is this tug of war between, I would say, tight spreads, as we've discussed before, but actually still pretty attractive all-in yields, and we think it's a pretty compelling opportunity.
Well, to the point of higher coupons, this is from JP Morgan. The high-grade issuers are going to pay $420 billion in coupons this year. That's up almost 20% from last year. And this idea that even if rate cuts are coming, higher costs stick around for some time because there's a lag there. So what does it mean for these corporates to have an environment where bond expenses aren't falling as fast as potentially margins are?
It's right. I'm less concerned about the investment grade cohort of the universe because they just have so much financial flexibility and a cushion. But your point is well taken, is that we had ultra low rate environment in 2020, 2021. A lot of debt was put on the books. That's rolling off. It's getting refinanced at a higher cost. I will tell you, though, corporates have shown an ability to navigate that. Actually, EBITDA and earnings, for the most part, have held up pretty well in a higher cost of capital environment. We've already seen some damage as well in the default rate. So I would say that actually the weakest among the corporate credit investors have been responding to this higher cost of capital. Leveraged loan defaults have outpaced high yield bond defaults by the most since the Moody's data began in 1995. And so we're seeing it come through.
We started the year talking about the risk of a 2025 refinancing wall. From the action that you've seen, has that been much, much reduced? And that's much less of a risk, and therefore contains the credit spreads into 2025, even on a slow down.
That's right. The catalyst for spread widening is unlikely to be a payment shock, in our view, right? It's more likely to be a growth downturn. Corporates have been so proactive, Manus, that they are now chipping away at 2026 and 2027 maturities, right? So high yield corporates typically don't let their bonds become current or due within 12 months. So we should always be expecting that very near-term maturity walls are low. That's just prudent risk management. But it's gone even beyond that. They've extended way beyond that 12 months, and they're actually refinancing a few years in advance. I think that's prudent, given some of the headline risk later this year, potential for a growth slowdown, although not our base case. Always good to refinance when you can, not when you have to. And I think the volatility from early August showed us that things can change very quickly.
Right. But as we've been talking about, a lot of the action in the corporate bond market has been refinancing. There's been less so about deal activity and funding deal activity. As we start this cutting cycle and we kind of reflect back on where we've been, is there any element where, because companies have been unable to make those kinds of actions, that they've been able to do less things that allow for expenses maybe to come in, more efficiencies, that the just trajectory of growth is going to be slower?
Yeah, so for sure on the sponsor-related M&A side, volumes have been pretty muted still. So those are deals that are involving some sort of private equity or leverage transaction. Strategic M&A, however, is actually running well above the pace of the past 2 years, and it's not that far below the 10-year average. I think part of that is that the COVID pandemic shined a light in a lot of CEOs and boardrooms' minds that there are gaps in business models that need to be filled through inorganic activity, so diversifying your business through acquisition. The swift rate hiking environment put a pause on that. Now that we have more clarity on the environment, optimism around avoiding a recession, CEO confidence, actually that activity has started to come back across a range of sectors. It's not obvious to me that corporates are really hunkering down and preventing themselves from moving forward with the strategic actions that they need to take. I actually think if we can actually get the rates cut cycle going a bit, get some clarity on neutral, I think it would be a really strong tailwind.
One thing that came through from Allianz yesterday was that everything sort of comes to this kind of crunch stop over this election. Either the Fed is crunched into a stop or the world crunches into a little bit of a crisis in terms of a challenged election. What are the reverberations? What are you seeing in terms of preparation for that, if at all, or the consequence of a challenge around the election?
It's really all about the policies from our perspective. I think having prudent diversification and nimbleness in portfolios is really what it's going to come down to. I think it's very difficult to call in advance because there are so many different paths that policy could take. But really what we're watching are what does this mean for trade, for tariffs, taxes? Those are really the key impacts for corporate credit investors.
Amanda, always brilliant. We really love having you on. Thanks for joining us. Amanda Lynham of BlackRock. Enjoy the rest of your Friday and your weekend. This is Bloomberg.
Day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea, but ultimately you still have to do a lot with it. It just give you very superficial ideas, and but at the end you still have to customize it, how to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment. Yeah.
Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I see that, when the designer doing is the spirit, is the heart that the computer don't have.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
We just announced over in the Stewards Hall that our members rejected the contract by 94.6%, and they voted to strike by 96%. There's a lot at stake here for our members, and so I am proud of them. And we're going to get back to the table as quickly as we can. I'm not sure what that looks like this evening, but we'll certainly engage so that we can try to resolve the issues and address what the members' needs are.
That was John Holden, president of Boeing's largest union. Boeing workers are going on strike. It is the first time they've walked off the job in 16 years. It involves 33,000 workers, and it further cripples production at the Seattle Commercial Jet Hub. Joining us now in person is Benedict Campbell. Benny, great to see you. I know you've just been out and about in D.C. talking to a lot of the industry. What is the wider implication of having a strike at a time where Boeing is trying to get back off the ground and they are trying to fix a lot of problems?
Well, you said it. Really, this is a company in trouble already, and this is the last thing they needed is one more thing they need to work with. And we heard here from Holden saying, let's see how we can get out of this. He said himself, I don't quite know how it'll go. But if you listen to his words, he seems to sort of extend an olive branch and say, we think we can get this resolved. It's unclear what exactly the metrics will be. Will it be pay? Will it be more on pension or on bonuses? They did get the guarantee that the next aircraft would be produced in the US or in the Seattle area. So that's good for workers. But really, they felt shortchanged on this one. So it's really going to be about the money, which Boeing doesn't have.
Look, you say the workers felt stiff. There's gaps here. There's gaps between the workers, the union leaders, and management. If I look at what Stephanie Pope had to say, she said, we put our best foot forward. So where are they going to get the extra money to close these gaps? Because they're already under a lot of pressure.
That part is unclear because, you know, Boeing really doesn't have the money right now. They're bleeding more than $1 billion each month, and that's not going to get any better. The production is going to be disrupted, and that will in turn cause more financial strain on them. There are estimates out there that a prolonged strike might cost as much as $3 billion in cash flow. And this is a company that has a credit rating that's close to junk, and that's something that investors are watching very, very carefully. They have $45 billion in debt, so they need to protect that credit rating. So very little wiggle room for them, but ultimately putting a little bit more money into the pot is better for them than a protracted strike. So that's really sort of the balance they need to strike.
I mean, what a way for Ortberg to start the run as CEO. In what way will this reflect him, Kelly Ortberg, as CEO, and how he moves forward in managing this company?
You're absolutely right. I mean, he's really been thrown into the deep end here. He put out a message a couple of days ago saying he urges everyone to leave past fights behind, move forward, see the light, as it were. But there was sort of a bit of a veiled threat in that message, and that's at least the way it was read by workers. Is like, if you do this, there's nothing good to come out of the strike, and maybe that will have sort of energized people. You saw the numbers, more than 90% on both counts. He's stayed a little bit in the background for now, so what this might give him is a way to come forward and really take the helm of the negotiations. Those have been led by Stephanie Pope, as you said, Manus. So Ortberg can come into this now, and if he can turn it around, then maybe if it's a short strike, he'll be seen as somebody who made peace with workers, and that'll go a long way.
Well, that carries a lot of favor in many of these organizations. You're on the road. This kind of disruption, additional disruption at Boeing, I'm not saying it's necessarily an opportunity for Airbus, but it certainly must bolster the narrative for them relative to Boeing, again.
Yeah, again, exactly. And this is something we've seen since the start of the year, and probably even before then. You know, Boeing's been in several years of crisis.
Yes.
Airbus has said, look, we take no pleasure in our rivals' misfortunes. Something going wrong at one manufacturer is bad for everyone, particularly something that's safety related. And the truth is, Airbus have issues of their own. They're not as pronounced as Boeing's, but they can't just sort of jump in and say, anyone want to buy a couple more planes? Because they can't produce them at that speed. This is a very long-term industry. Contracts are long-term. Relationships are long-term. So you don't just sort of switch from one manufacturer to the other. But the optics are that, you know, this is one company that's down, one that's up. You're slowly seeing a diverging path in terms of the market share. It used to be pretty much 50-50 on the narrow body aircraft. Now it's more 60-40, probably moving more towards 70-30. So that's all happening.
Well, this all comes down to the reliability of the partner that you have in the supply chain that they're dependent upon. Benny, thank you. Good to have you here in New York. Safe trip back to Germany. Benedict Campbell there on the very latest from Boeing. OpenAI, they are releasing a new AI capable of performing some human-like reasoning tasks known internally as Strawberry. The company says the tool will be able to solve multi-step problems, including complicated math and coding questions, two of my favorite subjects in the whole world. You're right, Tom McKenzie is with us. So strawberry is the name of the game. I was, math and coding. Well, coding wasn't around when I was a lad. So Tom, talk us through the next iteration of OpenAI.
Yeah, Manus, I was just imagining this is your weekend set up, isn't it? The coding and the maths and the maths problems. And now you'll have a hand in that effort, in those weekend joys, Manus Cranny. Yes, so they've come out with this new model that is focused. They say, look, this is going to provide a new AI capability. Their competitors, Anthropic and Google, have been working on this as well. They have similar capabilities that are coming to market. But it is seen, at least by the team at OpenAI, as a pivotal moment in terms of the ability of this technology to perform tasks that even GPT-4, their most sophisticated and largest model, still cannot perform. So that is crunching and coming up with answers for some of those most complicated questions and riddles, whether it's science questions, maths questions, or indeed, and some of the demos have showed this, actually doing coding and building things like games in a matter of minutes. Here's the challenge, though, around this new platform, this new model that they've pushed out. Number one, latency. Basically, it takes a long time for them to answer, the model to answer, because what it's doing is working through different scenarios to reach that answer. It is reasoning to some extent. It's been trained to do this through reinforcement learning. So it takes a bit of time to come to the answer. It's also not multimodal, which means it can't deal with things like audio inputs and visual inputs. But they say, they're working on this. That's a longer term goal. They're also, by the way, working on GPT-5, so the next iteration. Both of those things in parallel and complementary is what the OpenAI team say on a week when, of course, they're looking to raise $6.5 billion raised and valued at around $150 billion. Maybe this will give investors more pause for thought around that question, or at least give them more of a catalyst to potentially fund this business.
Yeah, I got to be honest. I'm imagining Manus like with a roaring kitty set up, like a gamer chair, screens everywhere, tie around the head. In the meantime, Tom.
Roaring kitty. Oh no.
That's literally what Manus looks like on the weekend. Okay, anyway, Tom, we'll save him. We'll move on. Oracle up pretty decisively pre-market, some 6%. A very optimistic forecast. What was behind that?
They've been hinting at this. Analysts have been waiting. They had expected an upgrade to the fiscal 2026 forecast from Oracle, but what they weren't necessarily expecting was an upgrade to the 2029 fiscal forecast. $104 billion in revenues for that period is what is now being forecast by a company that has really benefited from their cloud software, their database software that really aligns with generative AI and the workloads, the heavy lift, basically, that workload requires. Their software has performed well on that front, and that's a company they tout. So they upgraded the forecast for 2026 as well, $66 billion, upgraded for 2029, $104 billion. Analysts saying that this shows that at least for this company, Oracle, those generative AI tailwinds are still there. Year to date, the stock is up around 53%, but as you say, pre-market looking higher again.
Tom, thank you so much. Bloomberg Daybreak anchor Tom McKenzie. As I'm spying on Manus's computer with a picture of Keith Gill. Are you getting your outfit ready for the weekend?
I don't know whether I want a red headband. Is this is your perception of me over the weekend?
Yeah, the gamer chair, all of that, just like hunkered in, screens everywhere, coding away.
I mean, she's putting out falsehoods. There you go.
There you go. In the bottom left.
So this is me. Actually, I have friends that are meme traders, and they follow everything with this guy. No, I'm not wearing
the long hair.
No, I just like barely have any hair to talk about. So I don't think we need to worry about the long tress and the locks there. No, that's definitely not me. GameStop Corporation. There you go.
Okay, well, that's Manus's weekend planned, but before that, we're going to set you up for the whole
live
week.
On Instagram for you with my headband.
Tune in to Manus's Instagram Weekend This Live. He'll take you through his latest coding project.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Politics to the world of business. Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
What did you say to your mother and father when you said, I'm dropping out, despite the fact that I said I wasn't going to drop out?
Well, I said I'm just taking some leave.
Oh, leave?
Yeah. I think I'm still technically on leave. Harvard has kind of a funny relationship.
How long can you be on leave? For 10 years or so?
Well, I guess we're going to find out, yeah.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Get you set up for your trading day on this Friday. Coming up, we're going to have the University of Michigan consumer sentiment data that comes out at September at 10 a.m. Then former President Trump will have a press conference that occurs at noon. President Biden then hosts UK Prime Minister Keir Starmer at the White House. On the agenda, Ukraine, Gaza, and the Red Sea. Manis, what do you got for our stocks this morning?
Danny, top end and the bottom end of this market are moving. You got Mag 7 on the up, and it's tech in focus. Boeing is the drag here. We know that we're actively in this strike. What is it that management have got to put on the table to bring them over the line? 25% pay rise was put down. You've got Adobe down 8.28%. Again, delivering an outlook that failed to quell investor impatience, especially around the AI tools. And then Oracle, as I say, very, very strong innings for them. Annual revenue will rise to $104 billion. That's by 2029. And an optimistic view on the growth prospects, of course, in, you got it, the cloud business.
And meanwhile, Manis, it is a market that's in rally mode for equities. Meanwhile, bond yields fall by 6 basis points just nearly on the front end as that debate of 50 versus 25 comes alive yet again.
Yes, dreams and hopes live eternal. It's been called Nikki Leaks, of course. It's the Journal story. But don't forget, Bill Dudley said he'd be calling for 50 as well. Surveillance is up next.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow. I'm not the right one to just do that.
I think you are.
Yeah. But with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting in Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The market overall is a little bit vulnerable.
I think there is significant downside risk here, recession or no recession.
Recessions come from policy errors.
Markets are underweighting the impact of those pro-growth policies in the beginning of the year.
Definitely balanced risks looking forward into the next multiple years.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, and your scores look like this on the S&P 500 on a 3-day winning streak. Make it 4 in yesterday's session, and looking to make it day 5 this morning. Equities up by 0.2% on the S&P. On the NASDAQ 100, just about positive. Last week on the S&P, the worst week of the year. This week on the NASDAQ, the best week of the year so far. That's the equity picture. Switch up the board and get to the bond market and look at the signal at the front end of the curve. The 2-year yield down by 6 basis points, 357.83. We have a live meeting next week, and it is very finely balanced between 25 and 50. And all it takes, Bramo, is a few comments from some former Fed officials, and now the weight starts to shift back towards 50.
Normally, a lot of articles and commentary reflects a shift in markets. The markets had clearly shifted to 25 basis points. To hear Bill Dudley come out, and who actually has supported 25 basis points before at a meeting, come out and talk about how there is this important argument now toward potentially cutting by this amount. Just to give you a sense, I think there's a strong case for 50. I know what I'd be pushing for. At the same time you get a Wall Street Journal and FT article, suddenly it's about 50-50 whether they go 50 basis points, which would be the most undecided meeting in years.
What stands out for me is when Dudley says it's basically up to Chairman Powell to see how much support he has for being more aggressive. So if he's able to get to that consensus based on, you were at Jackson Hole, what he said, talking about how he's concerned about the labor market, could potentially he go for the 50? And then also at the same time, you have these outliers at Citi. Andrew Hollenhorst was pushing for that 50. He saw that inflation data and said, actually, it's going to be 25.
So let's run with the totality of the data. CPI came in a little bit hotter than expected on core. PPI came in a little bit hotter than expected. Then we saw jobless claims still subdued. 4-week moving average around 230,000, and yet here we are having a conversation about 50 all over again.
I think that you should keep using totality of data because that's nice and meaningless. That's sort of what we're learning increasingly, and I'm not blaming that on you, but basically that's what
I'm
we're
not taking it personally.
I mean, I think that there is this question about the totality of what data? The upcoming data that you haven't seen yet, is this an insurance cut, which is essentially what we have heard from Nick Timiraos and Colby Smith at the Wall Street Journal and FT, because that seems to be the big fear. Do they want to get ahead of a labor market that is their preeminent concern, that one mandate Fed, or are they still at least vaguely aware of inflation that's still kind of out there?
Super fired up about this, aren't you? People getting bullish in the last 24 hours. Maybe that's what sort of got Bramo started. Evercore dropping its call for a hard landing in the U.S. economy. That's Ed Hyman. That's a big shift from them. Deutsche Bank, Binky Charter publishing yesterday afternoon, raising his S&P 500 forecast to 57.50. So we're talking about 50 a little bit more this morning at the same time that other people on the street are getting a little bit more bearish as well.
And this is the ultimate key question to me, because we had been asking this question to a lot of people. If the Federal Reserve goes by 25 basis points or 50 basis points, what's better for this market? Most people saying 25 basis points. project this sense of confidence. And now the hint of 50 basis points is actually reviving this hopes of a soft landing, because this is a Fed that wants to get out ahead of this at the same time that NVIDIA just is feeling enthusiasm and nervousness from their clients about not getting enough shipments, and that just is enough.
So much snark from you. You need a weekend. Equity futures right now on the S&P 500 up by 0.2%. In the bond market, the rally resumes. Yields are lower across the curve. We're down by about 2 or 3 basis points on a 10-year, 364.57. In foreign exchange, 110.92 on euro dollar, firmer by just 0.1%. Coming up this hour, we'll catch up with Max Kettner of HSBC saying don't pull the plug on risk. Jennifer Flitton of Invesco as Donald Trump pledges no taxes on overtime. And Bloomberg's Sid Phillip as union workers at Boeing walk off the job. We begin with our top story. US stocks looking to add to this week's $1.3 trillion rally going into the Federal Reserve decision next week. Max Kettner of HSBC writing, we don't think it's time to pull the plug on risk. We therefore add to US equities as Q3 warnings, or rather earnings expectations, also don't look challenging to beat. Max joins us now for more. Max, good morning to you, sir.
Good morning.
That's the equity call. I want to get to the credit call. There was a shift on high yield for you in the last week. You moved that overweight from max overweight to, where are we now?
Slight overweight.
Slight overweight. What was that shift about?
From exciting to boring.
So what's that shift about? Let's start there.
I think, look, when we look at high yield, it's not like it's bearish. So certainly in Euro high yield, things look still pretty okay. Valuation-wise, it looks a bit more attractive. I think in US high yield, there's partly a story around valuations. You have high yield spreads around 320. There's not an awful lot to go anymore. There's not an awful lot of spread tightening that you can still see. So at some point, it gets around pure carry. And then you sort of, okay, is that still the best place where I get the carry, or is other places better, such as EM local debt, for example, where perhaps, you get higher carry, it's a bit short, it's sort of equal or similarly short duration, and it looks a little bit more attractive now, given how much has been priced in since April there, similar to the Fed. And I guess, when we look at it from a total return perspective as well in high yield, if you get now these sort of 10, 11 cuts priced in by the end of this year, if you get just a few priced out, right? Like, let's say, compare high yield to equities then. If you're long equities now, if you're long the S&P, do you care whether they cut 10, 11 times by the end of the year, or they cut 7, 8 times by the end of next year? Not really, right? Like, that's not really the big tail risk anymore. The big tail risk, particularly in April or in September, October last year, was they're not going to cut at all, or they may even have to hike. The tail risk now is, well, maybe I'll do only 4 or 5, but they will be cutting. So for equities, it doesn't matter. For high yield, it matters, because obviously the front end of the curve goes up.
Well, doesn't it matter for EM as well? Can we get into EM a little bit more? What are the assumptions you're making on rates on the US dollar to make that call?
Yeah, I do think, however, that in EM, again, valuations are a little bit more enticing. If you look at EMD spreads in particular, year to date, so they're sort of flattish. Of course, there's been some index composition changes as well. Yes, of course, but from a valuation perspective, certainly there's a bit more juice left compared to US high yield. So we're really at the stage now where it's not really bearish about high yield and much more bullish on the other stuff. It's a bit like, okay, you're really harvesting that carry. Where's the carry best across all the asset classes?
How much is this just a revival of the FOMO trade? Essentially, look for the biggest return and go. And that's essentially because the Fed is cutting rates, and so, yay.
Yeah, pretty much. I think it's sort of the, we were saying in I think it was 2021, that it's all pretty much a YOLO world, right? And it was sort of the return to YOLO. You could argue that's sort of what we're seeing, for example, this week. But let's be honest, we could also sit, maybe by the end of next week, we could sit here and you guys talk about $1.5 trillion being wiped out again. Like, if we had this chat last Friday, we wouldn't be that upbeat. No, we would all be like, oh my God, is this recession? And, are we closer to the end now? And is this the start of a bear market? And what is commodities trying to tell us? And all this sort of stuff. And now we sit there and we're like, YOLO, everything's great. So, this is how much it shifts within a week, if we're honest.
We were having a conversation to start the show about 25 versus 50 basis points, and I wonder how much you were rolling your eyes and how much you were actually saying this is going to matter to the market.
Do you want me to roll my eyes? I don't know.
You're a happy European who actually can go skiing on his weekends. But I am curious about whether you are seeing a market that is likely to sell off in response to a 50 basis point rate cut, or respond with that cheer and YOLO.
Yeah, so it depends. I think they would have had the chance in the last few weeks to say, look, we're so comfortable with this disinflation picture. If they had look, we're so comfortable with this disinflation picture, look what has happened since April this year. We've had super core down, we've had all these, all these components down. So because of disinflation, we could cut higher, right? We could cut more, we could start more aggressive. The problem now is that, of course, particularly with Jackson Hole, you said, oh, we're attentive to growth risks more than inflation. So the problem is if you start with 50 now, particularly with what John was saying in terms of the data, the totality of the data, you know, sorry, not making fun, of course.
No, of course not.
Of course not.
It's not my language anyway. Why are we blaming me for that? That's Chairman Powell. Carry on, Max.
So if we look at that, then the last couple of weeks actually has been really good. Look at weekly same-store retail sales data. It's been picking up from 4.5% to 6.5%. Now, when we look at jobless claims, you look at weekly consumer confidence data. You look at, you know, some of the electricity output. Look at the Dallas Fed's weekly economic index. Look at the GDP now from Atlanta Fed. We're talking 2.5%. So it just doesn't warrant it currently. So the risk is if you go 50 first, the market will say, what do you know that I don't? What am I missing? And I think that's what the market will take, a bit of like, oh God, I don't like this.
But Max,
I really don't like this.
Can't the chairman just clean that up in his press conference?
I think he could, but I think particularly with Jackson Hole, they've sort of missed the boat. Right? It was particularly also with Jackson Hole that they could have said, look, it's really because of inflation. It's really because of the disinflation that we're so comfortable with. That is why we could be cutting much more aggressively from the start, right? That's why we could sort of rush out of the gates and be like, we can cut 50. Yeah, growth has been a bit wobbly, but we're really comfortable with this still. It's just because of disinflation. And they sort of missed the boat on that.
Since you're visiting us from abroad, I have to ask you about the U.S. election. How concerned are you about the risks that are tied to November?
Yeah, look, not an awful lot, but because when we look, for example, at 2025, I think people talk a lot about the US election. I'm not sure how much people have positions on. Certainly when you look at our tactical asset allocation convictions, they are really not particularly tied to the US election, because I think what we're missing, looking a bit into 2025 as well, there is the debt ceiling issue looming, for example. But the Treasury has made it clear that we want to have these $700 billion stocked up in the Treasury general account in order to be able to pay that down, which could be at least perceived by the market again as temporary stimulus. You know, similar to what we had in Q2 last year, which is actually pretty good. Now, that's independent of the election. We know that in 2025, of course, there's a couple of those tax cuts from 2017 expiring. Again, that's independent of the election. We're going to have to deal with that. There is some sort of fiscal cliff awaiting us. Perhaps second half of next year when the negotiations start, there is going to be something looming. That's independent of the elections.
Any evidence from your conversations that the Europeans are willing to de-risk from US assets ahead of all of that? Are they concerned about it?
No, not at all.
Not at all?
Not at all. I think if anything, we've seen in the last, particularly, let's call it 5 months, we've seen the opposite. I think we've had this sort of long Europe trade into April, call it April, May. Long Europe, perhaps long Japan, a bit of diversifying. Oh, is the ex-US outperformance, is that really now kicking off? And in fairness, when we look at all the activity data, when we look at the high-frequency data, it's really strong still in the US. We're talking about the fiscal picture, the fiscal support. It's really strong in the US. Look at what Draghi was saying this week around, come on, we've got to be supporting more, right? We've got to be supporting more. And where it's happening is here. It's in the US. So if anything, you know, then you've got this, you had the French elections, of course, so there was these sort of concerns around that as well, whether unwarranted or warranted, don't care, but all of that really led a little bit more the inflow picture back into the US.
Max, it's good to see you here in New York. Thank you, sir. Good to catch up. Max Cantor there of HSBC. Futures positive on the S&P 500. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Boeing factory workers have walked off the job in the first strike since 2008. Members of its largest union, which represents over 33,000 employees, voted overwhelmingly to reject a contract offer and then walk off the job. The offer would have raised wages by 25% over 4 years and lowered employee health care costs, but union members expected a far greater increase. Both parties have expressed interest in getting back to the bargaining table. House Speaker Mike Johnson is likely to need support from the Senate in order to avert a government shutdown later this month. Hardline House Republicans rejected Johnson's stopgap funding bill this week. The deadline, September 30th. Former President Trump has vocally called for his allies in the House to reject a continuing resolution unless it includes a separate bill requiring proof of citizenship in order to vote. Nippon Steel and U.S. Steel sent a letter to President Joe Biden earlier this month on the Japanese company's proposed takeover. The letter was signed by both company CEOs. Nippon Steel has been mounting a last-ditch effort to try to muster support for that $14 billion takeover attempt. It still, though, faces widespread political opposition in the U.S. ahead of the presidential election in November. That's your brief, John.
Hey, Danny, thank you. More from Danny in 30 minutes' time. Up next on the program, another rally, another tax cut.
As part of our additional tax cuts, we will end all taxes on overtime. That's what we're doing because this is a good one. And I think it's going to be great for the country.
In 2 months, there'll be no taxes left. That conversation up next from New York this morning. Good morning.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The top names at Jackson Hole are on Bloomberg.
So we know that unemployment rates have gone from about 3.4% to 4.3%. That's a big change. Now, it's from super hot to solid, right? So I don't want to make it seem like labor markets are weak. But it really starts to tell me that things are much more imbalanced than they have been for quite some time.
Nobody covers Jackson Hole like Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Live from New York City, welcome to the program. Equity futures on the S&P 500 firmer here by 0.2%. Bond yields moving back in. We're down 3 basis points on a 10-year, 364.57. Under surveillance this morning, another rally, another tax cut.
As part of our additional tax cuts, we will end all taxes on overtime. You know what that means? The people who work overtime are among the hardest working citizens in our country. And for too long, no one in Washington has been looking out for them. It's time for the working man and woman to finally catch a break, and that's what we're doing because this is a good one. And I think it's going to be great for the country.
So here's the latest. Donald Trump looking to turn the page from Tuesday's debate with a pledge to end taxes on overtime wages after 40 hours a week. The Trump campaign moving on to California, with the former president set to hold a news conference and a private fundraiser. Joining us now to discuss is Jennifer Flitton of Invesco. So, Jennifer, I've got to ask you, how long before we see a rally with the vice president and she opens up with, we will end all taxes on overtime?
That's right. She did follow him on the no taxes on tips, so we'll have to watch this one closely. I think she's pointed to some Department of Labor regulation that happened under his administration. I think she wants to move more towards the regulatory side than he on the tax cut side. So we'll have to see. Stay tuned.
Jennifer, what we've heard so far from the Trump campaign, and then to John and yours point, copied in some extent by some of these from Kamala Harris, is it's going to be about $4 to $5 trillion in just extending the 2017 TCJA tax cut law. There's going to be ending tax on Social Security, no tax on tips, lowering the corporate tax rate to 15%. Now he's proposing no taxes on overtime work, and then you have to add in what J.D. Vance is calling for an expansion of the child tax credit plan. Out of this entire smorgasbord of cutting taxes. What actually can get done, do you think, in 2025?
Right, you're right. There is a huge amount, 4.2, some have estimated 4.5 trillion by the time we actually get to it. The negotiation over the provisions that are expiring in 2025 on TCJA. And it's going to it's going to be mostly determined by the makeup of Congress, right? So if Trump does come in and he has a Republican trifecta, meaning a majority of Republicans in the Senate, majority of Republicans in the House, that allows for the reconciliation process to happen. And that's not going to be simple when you have $4.2 trillion on the line here and a lot of aspirational promises. But if you do have divided government, whether that's Trump in the White House or Harris in the White House, it's going to be much tougher negotiations in trying to get some sort of extension past 2025.
So what is your base case as of now?
Well, I have to know what the makeup of Congress is, but I think I do know that the likelihood of the Senate is that it's going to be a Republican majority, right? The Cook Politico report has now sort of given a lean Republican to the Montana seat. We know West Virginia is consensus is it's going to be a Republican seat. So then you have 51 right there. But these are slim margins. We'll see if Republicans can add to that in possibly Ohio, possibly Maryland, possibly up into Michigan. We'll have to see. But even if they get to 52, 53, you're talking about a really tight negotiation. And the House, whether it's Republican or Democrat, it's going to continue to be very tight margins. And getting things done in those tight margins, it's very difficult. So tax is definitely going to take up all the oxygen in the room next year.
Very difficult, especially considering right now they're still debating whether or not they can keep the government open until the end of the year when you're looking at the makeup of Congress. When Trump comes out and talks about this, he says it's about getting blue-collar workers a break. This is something he ran on, we saw in 2016, 2020. Is it still going to land a punch this time around?
Yeah, I think this time around, what is affecting voters most and what we're seeing in the polls and what we've consistently seen over this past year in polling is that fundamentally the issue that is driving folks to the polls is the economy and how they feel in their pocketbooks, right? The tightness. And so any sort of promise for relief, I think, is what both of these candidates are trying to reach working class voters with. I was looking yesterday at the auctions the day before. It seems like they're not taking these proposals seriously. Would you agree with that? Well, I think that these are aspirational promises. So I think that's exactly what you're hitting on here, right? And this is what elections are. These are if I had my way, and we know that's not how government actually works, that there is a checks and balances. It is a negotiation with Congress. But you do have priorities of both of these candidates that they're going to go into any negotiation with. And let's face it, the leverage is with those who have the mandate. And if there is a strong win on either side, then you're going to have a mandate going into these negotiations next year. I love how you frame it, a wish list. And I'm curious what sentiment we're getting from the wish list that goes beyond just taxes. Yesterday, the former president, Donald Trump, also posted a video to X embracing digital assets, saying we're embracing the future with crypto and leaving the slow and outdated big banks behind. He's held rallies having to do with crypto. Do you understand the focus and the wish list item of crypto in his sphere? Well, it's been really an interesting year in this area. And there has been, legislatively, the hard work, the technocrats on the Hill have been trying to create some sort of digital asset market structure. But they have had a lot of pushback from the SEC. And so I think what Trump is trying to relay,
I think we've lost that connection.
And what he has been doing in a lot of meetings with top crypto.
Carry on, Jennifer. It just cut out just for a second. Sorry to distract you, but please carry on. It just cut out just for a split second. Forgive me. Carry on.
Yeah, absolutely.
Absolutely. So essentially what you've seen him do is really be open to the crypto space in a way that you've seen with a number of Republicans on the Hill. They've been trying to create this market structure. They've been trying to do something on stablecoin, digital assets, DeFi, blockchain in general. And he is trying to tell these folks, hey, I'm going to be the president for you. I'm going to put in an SEC chairman who's going to allow for this space here in the United States, which really they need that regulatory framework in order to take hold.
Jennifer, thank you for your thoughts. Apologies about the technical issue on our end. Jennifer Flitton there of Invesco. Jennifer, thank you. Thank you very much. I think no one takes it seriously for now. I think the base case at the moment is divided government, and if you get divided government, the tax cuts expire, and that's bond bullish. But if we wake up the morning after the election and someone's got a sweep, then I think fixed income starts to take things a little bit more seriously.
I think it's important to recognize that the market is not taking it seriously. So we can't get a real check on what the response function is going to be. I do think, though, to Jennifer Flitton's point, this idea of taking some sort of conclusion from the wish lists of what they want to do in terms of what direction things will be going in, I think that's important, especially when it comes to some peripheral industries like crypto, like Fannie and Freddie, and some other issues.
Also, what's interesting is she mentioned what's going on in the Senate. It is really starting to look like the Republicans are going to be able to flip the Senate. You have the political report talking about Montana is now lean Republican. So if there was to be Harris in the White House, and then you have the Democrats controlling the House potentially, that is serious gridlock, and it cannot be progressive policy proposals, and there'll have to be serious negotiations and debates about where the tax policy is
That's
going.
bond positive. I'm not sure where that leaves equities. Where does that leave stocks?
You know, we'll see. I think that there's a sense that going forward, stocks and bonds are going to move in opposite correlation. That what's good for bonds is bad for stocks, and what's bad for stocks is good for bonds, and that basically the proposal from Harris is going to be good for bonds and bad for stocks, and flip it around on the other head. Whether it actually works out that way, we'll see, because in the past, bonds and stocks have actually moved in positive correlation over the past few years. And what's to say that that's really going to shift materially going forward?
Based on current proposals, you'd have to imagine that this market would treat a blue sweep horrendously in equities. The idea that you're taking the corporate tax rate from 21 to 28, game over. Blue sweep will have conversations about taxing unrealized gains as well.
We will. At the same time, you hear other arguments that next year, if there is a blue sweep, you could also get some sort of fiscal proposal that could bolster things. And on the flip side, you get all the negative stuff up front with a red sweep. You know, you could see all the arguments being made. People can make up whatever argument they want because it's all wish list at this point.
If there's a blue sweep, though, the market would also look at it in the sense questioning, where are the centrists in the Democratic Party? Kyrsten Sinema will not be there. Joe Manchin will not be there. So there is that propensity now, potentially in a Senate, to do more than they were willing to do in the past.
2 more months of this coming up on the program. Boeing workers walking off the job for the first time since 2008 from New York City. This is Bloomberg.
every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Four-day climb on the S&P 500. The advance continues this Friday morning. Good morning to you. Equity futures look like this. Positive by 0.2%. On the NASDAQ 100, up by 0.1. On the small caps on the Russell, decent run here, up by 0.75%. Thank the bond market. Front end of the yield curve, the two-year yield down for a second consecutive day. At the front end of the curve, we are negative by 6 basis points, 357.83. The why? It's certainly not the economic data. CPI came in a little hot. Likewise on PPI. Jobless claims were pretty subdued. This is about the Fed speak, or rather the former Fed official speak, in the last 24 hours.
Yeah, there were three items that came out that were kind of the 1-2-3 punch. The first being Nick Timiraos in the Wall Street Journal writing a story, putting a greater emphasis on a 50 basis point rate cut, which is unusual given the fact that markets have basically come and coalesced around the idea of 25 basis points. Right now, the market is pricing in about a 50% chance of either 25 or 50, which is so unusual. It has been years, John, since there has been this level of uncertainty, unclarity, a sense of a real live meeting without necessarily a clear conclusion, and it comes with rhetoric that doesn't really match the market sentiment, but people are going with that because you know something I don't.
I think it's been about a year since the two-year yield did not drop on a Fed decision down at Chairman Powell news conference. Do you remember we were counting? I think it's been about a year since that happened.
And this comes with a material shift in Jerome Powell. And can he move the rest of the committee toward his view? We heard from Chris Waller. He was open to a bigger move should the data warrant. Did the data warrant? Is it the argument you've made? You talk about the totality of data. You just mentioned that inflation is not dead. We saw, upside surprises on housing costs. At the same time, people are saying it's in the right direction, and we're hearing out on all sides of the Atlantic. Right now, it seems like it's a toss-up, but it is odd. The emphasis on a couple of articles and commentary over the past couple of days.
Yields coming in, push it through the FX market. The dollar weaker against the bulk of G10. Dollar yen down by 0.9% at 140.52. Euro dollar looks like this, slightly positive on the session to about 110.90. This from BNP Paribas saying the dollar bull run has come to an end. Our forecasts imply gradual weakening to the dollar to 115 in euro dollar, 132 in dollar yen by year end 25. We note that these forecasts are conditioned on, this is the important piece, Lisa, a soft landing as well as a Harris presidency and a divided government. So there's a lot hinging on that idea that we get a divided government come November.
And that would essentially be dollar weaker, and that would create a bit of strength for the euro. You talk to three different strategists in the FX space, and you'll get three different views. You have Morgan Stanley coming out talking about parity. You have Frederick Ducruzet of Pictet Wealth Management talking about how essentially this is an ECB poised to cut much more significantly than they're even saying, just simply because of the weakness. So, pick your poison, either a Harris presidency or Germany.
If you get tariff man back in the White House, it's dollar ripping, right? Dollar stronger.
He might not say that he wants that. He wants dollar weaker, but that is essentially what people are expecting.
Likely the consequence. Under surveillance this morning, former New York Fed President Bill Dudley saying there's a strong case for 50 at the Fed's meeting next week, citing a slowdown in the U.S. labor market with risk to jobs greater than lingering challenges to inflation. You will remember, going into the July meeting, Bill Dudley made the argument they should be cutting then. I think this echoes the fact that they didn't cut back in July.
Yeah, so how much are you trying to make up for it, and how much do you jeopardize the communication tactics by saying, we're catching up, there is a risk in the market that we're not recognizing? It is notable that Bill Dudley previously had really supported a 25 basis points, so there wasn't a lot of daylight between July and September as long as the path was clear. Why now?
He said the facts have changed, didn't he? So his views changed. Let's get a move on.
Back in July.
Yeah.
But the facts haven't changed from July till September. So the question is, how much are you actually giving the wrong signal to the markets by cutting for 50 basis points? I mean, that's the discussion around 25 versus 50. Does it really matter whether you started in July or September, or is it just the signal that you're actually on this path?
We can talk about this all morning, and I think we'd all agree that we will, I know. There's a lot of nuance here. Beyond just 25 or 50, you can achieve the same through a 50 with a 25 by leaning very heavily on the dot plot and forward guidance. And what comes out of the news conference, and Anne-Marie mentioned this at the top of the hour, what comes out of the news conference is equally as important. So 25 or 50, I don't think all 25s are created equally. You come out at 25 and signal this as the first in a string, start talking up a destination and the journey back towards neutral, start leaning in that direction heavily. That's a very, very dovish 25.
I like the idea of heavy lifting with the dot plot. We're going to be analyzing the statement of economic projections and understand, can they cut their expected benchmark rate while also not necessarily moving the growth forecast? And if that's the case, they will be signaling that it is not because of weakness that they're going to be cutting much more significantly.
The main event next Wednesday. Elsewhere, former President Donald Trump pledging to eliminate taxes on overtime pay. The plan would boost take-home wages after 40 hours a week. Trump also vowing to cut mortgage rates to 2%, despite only limited influence over the Federal Reserve. So let's park the mortgage argument just for a second. Tax cut after tax cut. And I joked about 10 minutes ago that I'm waiting for Kamala Harris, the vice president, to come out and basically say the same thing. But that's what happened last time. Why wouldn't it happen this time?
Well, yeah, she might get asked the question, what do you think about this new policy proposal from the Trump camp? Do you also agree that those who are working overtime shouldn't be taxed? And she could say simply yes, and then technically she'd be copying Donald Trump. But as we just heard, a lot of this might not happen. I mean, it is the Oprah Winfrey election of tax cuts. It's on everything when you look down the list. Extending TCJA, on top of that, ending tax on Social Security, ending tax on tips, lowering the corporate tax rate. We are talking about trillions of dollars, and all of this feels like spaghetti on the wall to get people out to vote. Will it actually happen? A lot of this, likely not.
You said it might not happen. Arguably, it won't happen, most likely. And here's the question that I have. Have we ever had an election where people took the proposals less seriously because everyone said that none of this would happen? Because essentially, that is what the market is saying, which I think is really notable. So it's sort of, why not say that? If no one's going to really cross-check it and say, we believe you and we're expecting it, it seems like everyone's just saying, oh, it's nice that you have to say this to cater to these constituencies.
The overwhelming base case is gridlock in Washington. Like, that's the overwhelming base case. And I think to some extent that's contributed to the bond market rally we've seen over the last few weeks as well. If you get anything but that, got a very different story in this market.
People don't believe there will be a material change. And perhaps it's just because you can't trade in something that you don't know. But it doesn't seem like people are taking it truly seriously in the bond market just yet.
I agree with you. Let's turn to Boeing. Some real news out of that company. Boeing factory workers walking off the job for the first time in 16 years. The strike halting production at the plane maker's Seattle Commercial Jet Hub. This coming after members of the International Association of Machinists and Aerospace Workers rejected a contract offer with 96% voting in support of a strike. Bloomberg's Sid Phillip joins us for more. Sid, welcome to New York. It's good to see you.
Likewise.
Walk us through what happened here. Why is this strike happening?
So Boeing's been in negotiations for the last couple of months for a new wage deal. So the last time they had a strike was in 2008. They've been sort of working on a brand new wage deal that is the first time in sort of 12 years that they're working on a completely new deal that would get basically their workers a brand new deal in terms of just being able to get higher wages and essentially get, because they've talked about how they've been hit by inflation and they've been working towards getting a brand new wage deal. And so for Boeing, they're in the midst of a crisis. They've been sort of trying to get out of this position for a while where they've been burning cash. They've had ever since the Alaska escape. Back in January, when the door plug fell out, they've basically had to slow down production. And so for Boeing, they're in a very tricky spot. And they were hoping to sort of make this problem go away by sort of offering them 25% over 4 years. And they said, that's the best we can do because of our constrained position.
Yeah.
And the workers said, no thanks, we want more.
What is the ask? Do we know precisely what the number is?
They were talking about 40% when they began negotiations. And so that was the ask initially. And there's a lot of anger about the plan to cut an annual bonus. And they were sort of hoping to restore pensions, hoping to get better healthcare. And that's the sort of position where they would like Boeing to take them.
The last two strikes we had were in the 90s and then 2008. And a lot of what analysts are saying is that this means this strike could go into mid-November. Is that what you think this can actually be, mid-November? I say that because there's a really important political calendar as well.
Exactly. I mean, everyone's watching to see how long the strike will go. And both the union and the company are desperately trying to make this happen quicker than the sort of 50 days that it took in the last couple of strikes, because any sort of a stoppage for 50 days is estimated by some analysts to be about 3 to 3.5 billion in terms of affecting cash flow. So essentially, for Boeing and for the workers, everybody really wants a deal to be done. It's all dependent on whether or not Boeing can actually get to where the workers want them to go, and the workers accept what they offer.
Reputationally, this is a brand new CEO. How much blow is this for him? Or will investors understand that this was the cards he was dealt?
Investors will understand this is the cards. I mean, Boeing's been telegraphing that this negotiation with IAM 751 was coming up at the start of the year. So this is something that was expected, but at the same time, everyone was expecting the new CEO to be able to sort of quell this issue and make sure that Boeing can get back on track, get production going, because this will stop production for Boeing. And essentially, a 737 MAX, which is their biggest cash flow generator, will basically come to a grinding halt or close to a halt. And that basically means no cash for Boeing. And so Boeing's in an even more precarious position.
So no one's listening. Who's right here? Is it the workers or is it the company? Just simply because I was reading this and I'm wondering, well, how much is this part of the problem? And the reason why you have had these lapses is because workers haven't felt rewarded and are leaving versus taking advantage of a situation. Which is it?
I think it's a bit of both. I mean, I think there is, obviously workers in the aviation industry are sort of very highly skilled workers. They're sort of very focused on quality, and essentially the industry is highly regulated. At the same time, the workers feel they've been sort of given the short end of the stick because essentially the company has sort of been struggling, and they've been sort of hoping to get a pay rise, and they've been talking about how they haven't been given adequate pay rises, especially with inflation where it's at. And essentially they've had to work on this current deal where they previously lost their pensions, they've had worse healthcare, and so they're hoping to restore some of those benefits. And they are in a very good position at the moment because Boeing really needs to build airplanes, and if they aren't able to build airplanes, then it is a big problem for them.
Their strike timing historically is not the best. 2008, the last time they did this, Lisa, going into what many people are still anticipating to be somewhat of an economic downturn.
Yeah, is this sort of the peak in terms of marking the end? Yeah, exactly. And we've talked about this before. You do wonder if they're a little late to the game and whether they're trying to squeeze a company that's kind of squeezed out right now.
Hey, Sid, it's good to see you here in New York. Thanks for being here. Thank you. Bloomberg's Sid Phillip there on the latest strike out of Boeing. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Chinese government is raising the retirement age in the country for the first time since 1978. Men's retirement age will increase from 60 to 63. The women's will rise from 55 to 58. That from a report from the government. Those changes are set to take place over 15 years. It will likely slow a decline in the labor force, but it does risk angering workers who are already dealing with a slowing economy. Vice President Kamala Harris raised $47 million in the first 24 hours following her debate with Donald Trump. That amount coming to nearly 600,000 individual donors. It also comes on top of the $361 million that she raised in August, more than double the $130 million that Trump pulled in. Trump is seeking to close the fundraising gap with a series of events scheduled today in California. People familiar say OpenAI is releasing a new model capable of performing some human-like reasoning tasks. Internally, it's known as Strawberry. The tool will be able to solve multi-step problems, including complicated math and coding questions. The timing, though, it's still unclear, but a release could be available to some users as soon as this week. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes' time. Up next on the program, a bond market looking for an anchor.
We have excessive data point dependence. We don't have a dominant economic view, so we get swung all over.
That conversation just around the corner. Live from New York City, you're watching Bloomberg TV.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Four-day winning streak on the S&P 500. We could make it day 5. Equity futures positive by 0.2%. Quite a bond market rally over the last few weeks. We're down 3 basis points on a 10-year this morning to 364. On 2s, we're down 6 basis points, almost 7 to 357. Under surveillance this morning, a bond market looking for an anchor.
We have excessive data point dependence. We don't have a dominant economic view, so we get swung all over. We are going to continue with this volatile world until we restore either a dominant economic paradigm or we restore the power forward policy guidance.
So here's the latest. Traders remaining at odds on the Fed's path forward from here. Former New York Fed President Bill Dudley making his case. I think there's a strong case for 50. I know what I'd be pushing for. It's basically up to Chairman Powell to see how much support he has for being more aggressive. Joining us now to discuss, Kato Cedar of State Street. Kato, it's good to see you. Welcome to the program.
Thanks so much for having me.
25 or 50 next week. What are you leaning towards?
I'm leaning towards 25. However, I think there's a really valid case for both sides of the coin, 25 and 50.
Is there a stronger case for one versus the other?
I think 25 because it gives the Fed a little more optionality to speed up the pace of cuts if they need to. I think the last thing they would want to do is overcut and then be in a more of a tighter predicament.
So take us inside the State Street headquarters. Everyone agreed with you. 25 basis points was the most likely. And then the Wall Street Journal article dropped.
Yes.
And then the Financial Times front page. The Fed really considers 25 or 50, seems more on the edge than what markets were projecting. Then Bill Dudley comes out. How much do you guys turn to each other and say, this seems like a signal?
Yeah. I think at the end of the day, we have to look at the level of data that we have. So, for example, the claims data this week. Initial claims signal that the labor market is still in an okay spot. And when we look at the CPI data this week, you have to look at core and the housing component as well. And I think it gives a little trepidation around, is inflation really under wraps?
So I guess that this is the argument that we hear from a lot of people, which is why the market coalesced around 25 basis points, which was the reason why people were so surprised to see that 50 was so squarely on the table. I guess, has the totality of data changed in terms of the Fed's reaction function after Jackson Hole?
Yeah, I think it's still data dependent, and because we have that data dependency and the data that we've gotten since Jackson Hole really hasn't screamed recession, that makes a case for 25 instead of 50.
This two-year yield has dropped a lot over the last month. It's dropped a lot again over the last few weeks. We're down to about 358. The yield curve, 2s versus 10s, is positive 7 basis points. That's a recently new development, pretty fresh over the last few weeks. I think the first time we've seen that positive in the last 2 years. You're looking for the potential here for a bear steepener. Just walk us through what that bear steepener is and why you think long-end yields could actually start to inflect higher.
Yeah, so on the short end, I think you have the case where, all right, you have an economy that's still okay, you have really strong GDP forecasts, maybe we need to take some of those cut expectations out. And then on the long end, you still have some concerns around recession as well as fiscal concerns, I think, that are a bit longer term.
Let's get to the fiscal concerns.
Yeah.
Does the election make a difference?
I think it makes a difference for the bond market, rather. Equities, I think, are a little bit more nuanced. In the past, we've seen the initial knee-jerk reaction kind of reverse, but I think that fiscal question is going to become a concern regardless of who's in Congress and who's president.
What is your base case at the moment?
That's a tough call. Fortunately, I am not our go-to political expert. However, I would say I think that's why in the equity space, we're really, really focused on what's happening on the monetary side of things.
When it comes to what happens with policy next year, you have Kamala Harris talking about a 28% tax cut, Donald Trump talking as low as 15%. So you look at all these notes, Goldman Sachs, RBC, they're saying this means for the S&P 500, it's going to be potentially good under tax policy of Donald Trump, less so under Harris. But then you add in things like tariffs, and some analysts will say if there's a Trump presidency that's going to be inflationary and the Fed may actually have to hike, if there's a Harris presidency, she's going to go lean less hard into tariffs, even though she might use them, and the Fed may actually continue on a cutting path. How do you put all of these different potential policy objectives in one place ahead of the election? Where do you hide?
Yeah, I think when you take in the fiscal side of things and the monetary side of things, and you look at what's driving markets right now, there's a lot of different variables. And because there's a lot of different variables, I think you have to lean on the side of slightly risk averse. And what I mean by that is we're not as risk averse as we would say in some other cutting cycles. However, I think it means this isn't a buy everything situation. So earlier in the summer when we saw small caps really rally, we were kind of questioning that. Why is that the case? And simultaneously, I think we still can see an environment where equities do okay, but we need to be selective. And so what that means is really going to places of quality. And that's where we want to hide because of this uncertainty around elections, monetary, hard landing, soft landing.
You talk about utilities in your note. On this program a lot, we talk about whether or not that's defensive or actually growth, because how tied it is to the AI revolution. How do you view that sector?
I think it's kind of in the sweet spot, actually, where it can benefit from some of this AI trend, but you still do have some of those defensive qualities. And so I think that's actually a good thing right now, where it's a little bit on the fence of both. But given where we see tech going and that pull, it actually makes utilities a little more attractive, I think, than years past.
When you take a step back, would you say that right now the bigger risk in markets is actually inflation than, say, some of the hard landing discussions? And I ask this because person after person has come on and said they're not worried about runaway inflation, but this feels like a market that's gotten overly complacent with the idea that it is truly dead.
Yeah, I think it would be a mistake to ignore both sides of the dual mandate. And I think a year ago or 2 years ago, when there was an emphasis on inflation, it's because inflation was really extreme and the labor market was really tight. As we've gotten closer to balance, I think the degree with which that you can really focus on one or the other shifts, and you need to keep both in perspective. And the case to only focus on one is much different now, and I think you really can't forget about that inflation component. And we saw that in the report this week.
So when you take a step back, if you see inflation as the bigger risk, that would seemingly suggest that bonds are in a worse position right now, and stocks are actually in a better position, because we've seen stocks do really well with inflation and with pricing power. So wouldn't that arguably be sort of bonds bad, stocks good, at least on a tactical basis?
I think it's nuanced. I think I think nuanced is the word of the day, word of the week, word of the month. Within the equity space, I think it comes a lot down to concentration and where you want to broaden out. So what I mean by that is on dips, you still like tech. When the market is at highs, that's an opportunity to shift into some of these defensive spaces. And I think at the end of the day as well, avoiding some of those cyclical places within equities makes a lot of sense.
Kata, it's good to see you. Thanks for coming on the show.
Thanks so much for having me.
Thank you very much. Kata Sita there of State Street Global Markets. You can feel the tension right now in some of the research on Wall Street, the difficulty that people are having calling this market. Ed Hyman of Evercore, renowned economist in Wall Street for decades, said this: very difficult decision to raise the forecast. History and experience say to stick with a hard landing outlook, but he's not sticking with it. He's now looking for a soft landing, and he offers a whole bunch of reasons. In fact, Lisa, he offers 10. So allow me to go through the arguments for a soft landing, according to Evercore. Unemployment claims are still very low. The economy is still awash with liquidity. Consumer net worth is still advancing. Inflation is slowing and lifting real consumer incomes. The solid consumer income proxy, advancing corporate profits, boosting employment. Fed funds likely to be cut next week, 25 or 50. Global short rates are already declining. Seeing that again on the board this morning. Housing's still okay. And then you've got this massive AI build out. You put it all together and he's abandoning his hard landing call.
Well, and most people are. I mean, the only person I can think of off the top of my head is Andrew Hollenhorst, who still is really leaning into this whole hard landing and talking about the need for the Fed to go much more aggressively. Key question in my mind is less who's right, because we're not going to know for a while. It's where are the risks building to what's priced in and what's not. And honestly, fewer and fewer people are talking about inflation at a time that rates are making a really dramatic historic rally. And that, I think, has to come back on the table a little bit more as you talk about long-term, what is the destination, which is a question, frankly, that the Fed has not been willing to really address.
You mentioned Andrew. His mind might change again next week based on US retail sales. Your week ahead looks like this, by the way. It's worth going through. So a little bit later this morning at 10 a.m. Eastern Time, we'll get UMich consumer sentiment numbers. Then we'll hear from the presidential candidates over the weekend. On Tuesday, the big data point, retail sales. Retail sales data. This final piece of information, just as the two-day FOMC meeting kicks off and concludes on Wednesday. And for Andrew, if that comes in very soft, then maybe if you're looking at a very finely balanced decision, maybe that's enough just to tilt things in one direction versus the other.
And certainly, Andrew probably has company based on some of the rhetoric that we've heard out of articles, as well as Bill Dudley, where it seems like Jay Powell really does want to cut more aggressively because they feel like they should have maybe cut in July as well. Key question, though, again, we keep going back to it. If there is weakness, why are we not seeing it? And I think that's an important question. If there is weakness, why are we not hearing it from the retail CEOs who still are saying the consumer's hanging in there? Why are we just hearing about discretionary spend and competitive edge much more?
Choiceful. Word of the moment for them. Jobless claims still subdued. That's still a big takeaway, I think, for many of us. Equity futures on the S&P 500 pushing higher by 0.25%. 4-day winning streak on the S&P 500 into Friday. Looking to make it day 5, up 0.2 on the S&P. On the NASDAQ 100, up 0.1%. And the outperformance on the Russell, the small caps, up by 0.8% off the back of this rally in the bond market this morning. Up next on the program, the second hour of Bloomberg Surveillance. The lineup looks like this. Steve Orth of Federated, Bloomberg's Josh Wingrove, Sharon Miller of Bank of America, and Vishy Tripator of Morgan Stanley. All of that still to come from New York City. Good morning.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, I'm going to say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Oh, leave.
Yeah, I think I'm still technically on leave. Harvard has kind of a funny relationship.
How long can you be on leave for 10 years or so?
Well, I guess we're going to find out, yeah.
It's a very strange economy because a lot of the strength that we had, a lot of the overheating that we've had has gone away, but it hasn't really been replaced by any obvious weakness.
The odds of a hard landing in the Fed's odds have tipped higher, but they're not terribly high just yet.
The Fed must be aware that if they go aggressive here, they're in danger of undermining consumer confidence.
The market has seemingly removed the expectations for a larger, more aggressive 50 basis point cut next week, but I would argue it was never really on the table.
At some point, volatility spills back to the real economy. And the only thing keeping this real economy going right now is the labor market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
4-day winning streak on the S&P 500, looking to make it day 5. Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, with equity futures up by 0.25% on the S&P and some real outperformance on the small caps. The Russell looks like this, up by 0.75%. The small caps not the dominant story, though, this week. The NASDAQ 100 heading towards its biggest weekly gain of the year so far, up by around about 5%. Thank the bond market, the 2-year yield is down another 5 basis points this morning, 3.59, even with hotter CPI, even with hotter PPI, and even with jobless claims. Staying pretty subdued, Lisa. The data so far this week does not scream, let's go 50. It says, I think we're going 25.
But it seems like maybe people have other ideas, which is the reason why the market is now pricing in an equal chance of 50 versus 25, which would be really the first time going back years since we've actually seen a live Federal Reserve meeting. I just want to point out, you pointed to all the data being okay. 2-year yields are down more than a full percentage point from the end of June. It just gives you a sense of how far we have come down as people reset their expectations for the Fed and the destination as well.
In the commercial break, I was counting. I think we're at 7 consecutive meetings that the 2-year has rallied. The yield has dropped on a Fed decision day. Chairman Powell likes to outdove where the market is. Is that where we're going on Wednesday?
That's the reason why that feeling was the reason why Bill Dudley's words carried so much weight. Does this Fed chair have the ability to convince the rest of the members to go more aggressively? That's the reason why the Wall Street Journal and the Financial Times articles got people's attention, because suddenly you started talking about the idea of insurance cutting to get ahead of potential weakness.
When Dudley came out and talked about this, and he says it's basically up to Chairman Powell, it feels like Powell wants to go there. Can he bring the rest of the committee along? And then he says the question is, why don't you just get started? Dudley is starting to sound like Neil Dutta. Get on with it, this Federal Reserve.
I think a lot of people are on the same page as Neil Dutta. Neil Dutta has poured freezing cold water over this idea that if you go 50, you're signaling something really bad. What does the Federal Reserve know that we don't? He does not approve of that message at all.
I love what he was saying. If you really believe that, you should not cut at all and give ultimate confidence to the rest of markets. I mean, he doesn't believe that, and I would argue, I don't know that the market believes it either, because just we got the hint of the idea of the market coalescing around 25 basis points, and then equity is selling off. And that I thought was a really interesting knee-jerk move. Arguably, it's just algos doing algos, but at the same time, how much does that really support the fact that this market is looking for bigger moves?
For the first time in a long time, we have a live meeting to look forward to. Equity futures on the S&P positive by 0.2%. We gave you a snapshot of the bond market rally. 10-year yields are lower by 2 or 3 basis points to 365.32. The lineup this hour looks like this. Steve Orth of Federated on why the Fed needs to cut by 50. Sharon Miller of Bank of America on how small businesses are preparing for rate reductions. And Vishy Thiruppatura of Morgan Stanley looking for markets to dip and then rip. We begin with our top story, looking ahead to next week's Fed decision with the call to go 50 or 25 basis points still finely balanced. Steve Orth, a Federated Hermes, writing they need to cut by 50 next week, but probably won't. If they don't, the next 6 weeks of data will likely push them to do so in November. And for sure, we're now entering a prolonged cutting cycle. Steve joins us for more. Steve, it has been too long, my friend. It's good to see you.
Likewise, John.
Thanks for coming in, sir. Let's talk about your call. Massive week for tech this week. Big tech, the NASDAQ 100 up by around about 5%. You like the small caps more, I understand from your research. Walk us through why.
We think the whole groundwork of this bull market that we've been in tech is shifting underneath our feet here. If you look at, I call it the 5 big things. Number one, you've got the Fed entering a cutting cycle. We've been in a hiking cycle. The economy is clearly softening. The labor market is softening up. It had been tight. Inflation has come way down. We're closing in on the Fed's target, which I think is 2.5. The yield curve is reinverting. This is huge for what works in the market. We can go into that if you like, but that is very big, and that's happening under our feet. The yen carry trade is over and is reversing, and it didn't happen in one day. It is going to unwind over several months. That was very supportive of tech. The relative earnings growth of the tech sector versus everything else is reversing. So you add all that up, all the factors that have lied underneath this bull market in, say, the new economy, the tech stocks, are underlying. And you've got this election coming, and that potentially, well, we know if nothing happens that rates are, taxes are going higher. And probably the regulatory regime is going to get even more difficult. We'll see. It depends on who wins the election.
3 things to unpack. The big tech call, things reversing, the yield curve, and then we get to the politics. Can we start with number 2 and the yield curve? Fed funds right now is at 550. The 2 years at 360. Mike Wilson of Morgan Stanley was on the program earlier this week and said, unless that spread closes, either with the Federal Reserve getting aggressive or the labour market data coming in much better than anticipated and the 2-year yield climbing again, that this stock market's going to struggle until we reconcile and resolve those differences. Do you not agree with that?
So I don't always agree with Mike, and he tends to lean bearish, and as you know, I tend to lean bullish, but I kind of agree with Mike. Yeah, we are in a difficult environment here because the Fed, as usual, this Fed is behind the curve. They were behind the curve. I mean, we were out there in 21 with others saying they got to get going. They're way behind the curve. They waited a year. They had a lurch at that point, 75, 50. And now they're in the same position. They're looking at everything with a rear view mirror. The inflation numbers are already at where they need to be. The labor market is really soft right now. The manufacturing sector is technically in a recession. The China economy is in a recession. Europe is probably close to that, or whatever you want to call it. So the Fed is way behind the curve, and they're probably going to do 20. I agree with Neil, by the way. The market isn't this stupid. The market knows the data. They're not going to be shocked if the Fed does the right thing. I disagree with that, but they're not. I don't think they will. I think this Fed tends to move slow. They're watching with a rearview mirror, but by November it's going to be obvious that they should have cut, and they'll probably do 50 in November. We're going to get to. I keep asking my bond people, where are we getting to? We're getting to probably a Fed funds rate of 2.5 to 3 on this cycle. So we have a lot of cuts in front of us. The 10-year is about where we're going to get. You know, if the inflation rate stabilizes at 2.5, and you're back to having a 1.5% risk premium, which bond investors need, both because of Lisa's concerns about the fiscal, but also because, you know, they've just figured out you can lose 20% in bonds, which, you know, it was assumed you couldn't, you know, back in 22. So the risk premium's back. That puts you at 4, 3.5. I mean, we're kind of there on the 10-year. So that's the inversion, because what's going to happen here is the short rate is now coming down, and instead of being the short rate, you know, 100 basis points above the long rate, it's going to be back to 100, 150 below the long rate. That changes what works in the market. So the tech stocks, they don't need financing, right? They're cash flow generators. Everybody knows that story. It's the old economy that finance themselves short, the asset-heavy businesses. They've been getting pummeled by these high financing rates. The housing market's been pummeled. The auto market, we saw this week, you know, Ally having trouble. So when rates come down, it's going to really help the old economy stocks. That's why we're calling for this great rotation, if you will.
We've been trying to wrap our heads around the idea of betting on the recovery before we have the dip. And that's sort of what the likes of yourself and other people who believe in the Great Rotation are basically calling for, that you should go into the areas that will benefit from the remedy to a problem that hasn't been fully revealed. How do you reconcile that?
Well, okay, Lisa, the Great Rotation actually is into value, right, and small cap. Half of value is defensive. So there's a little bit of diversification in this call. Like our dividend fund, as an example, is up 18% year to date. And it's all happened since this rotation started at the beginning of July, literally. So there is some defense in there. But you're right. That's why we put out that piece earlier this week about the enter the 2 Rs. What we're starting to worry about, given how the Fed is behaving so slowly, that they could put us in a recession, not a rocky landing. We've been talking about rocky landing. And that hurts the cyclical call, which is in the value rotation. So it's kind of either a recession or a rotation. We're still on the rotation, but you're fair to bring that up. That is sort of the issue right now.
What would be the tipping point? What would you have to see to say that maybe move away from the little r of rotation to the recession call, especially if the Fed only moves by 25 basis points on Wednesday, and then you start to see the data continue to weaken?
Well, I think they'll then do 50 in November. They have so much room to go. I think they can avert a recession, but I am nervous for sure, given how they're managing things. Now, they might surprise me and everybody else. Not everybody else. The market's now almost getting to 50 next week. I think that would be a wonderful outcome. Then you'll see this rotation trade really rip, because that's a good thing.
Can we talk about the politics? How much is the small caps?
Love talking about politics.
How much is the small caps trade also tied to potentially a Trump presidency?
Absolutely. So the politics helps the small caps, right? He's sort of old economy guy, if you think about it. Biden, Harris, new economy folks. So if you get a Trump sweep, which is not obvious here, but if you did, that would certainly add fuel to the fire, because he's going to cut regulation. Regulation disproportionately hurts the smaller companies because the compliance costs are the same, rather how big your revenue base is. So it's going to help the small cap trade. It's going to help the old economy. You're going to get more of a tax cut. That helps the old economy stocks. So yes, absolutely.
When you think about the tax cuts, you mentioned them earlier, TCJA expiring. You said that you can't really put any weight on those tax cuts coming back into play. Basically, we flip back up to higher rates. But Kamala Harris has also said she doesn't want to raise taxes on those making under $400,000, and she also is calling for 28%, which is higher than a rate in the 30s. So could you start baking in some of those scenarios as a base case, regardless of who wins? There are going to be some provisions.
Yes, that's right. I agree with that. Yeah, it's probably going to end up somewhere in between. But if on the small cap trade, most of those smaller companies are paying taxes based on high income tax brackets. They file as individuals. So she's for sure going to raise those taxes if she can. What the market doesn't fully grip here is that this is a tax hike that's on autopilot. It's usually the case that you go, well, I don't know who wins the election. You got to have a majority. Maybe they'll do a tax cut.
Oh, no,
you know.
they expire.
Yeah, they full stop. They all go up, and now we're negotiating which ones don't. She leans more towards, you know, let them all go up. That'll be her trump card, if you pardon the pun. He leans on cutting. He obviously likes them where they are. So you guys are talking about this.
Yeah.
It looks like Montana is red, and probably you're in a divided government, but very tight margins. Someone at your show mentioned this earlier this morning. It's not clear, so I think that the market's going to have to digest that. It's not clear where that's heading.
Steve, it's good to see you.
Likewise.
Got to do this again soon. It's been too long, which I think is your fault. Steve Orth, the Federated Hermes. Steve, thank you, buddy. Equity futures on the S&P 500 up by 0.2%. Let's give an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Chinese authorities have banned PwC for 6 months and also levied a record fine of $62 million over lapses in its work auditing Evergrande. In March, China's securities regulator had said PwC approved Evergrande's accounts, even though the developer had inflated mainland revenues by nearly $80 billion from 2019 to 2020. PwC said its top executive in China will step down in the wake of the scandal. Shares of Adobe trying to find its footing, but down some 8% in the pre-market trade following the sales outlook that disappointed investors. Investors were eager to see that the software company, which is known for programs for creative professionals, can make money from its tools. Adobe has focused on implementing AI into features and products like Photoshop and Illustrator, but the broader software sector has been seen as vulnerable to startup rivals and taking businesses from traditional companies like Adobe. Gold at yet again another record high. The precious metal is on track for a weekly gain of almost 3%. The surge has been boosted by expectations around a widely expected decision from the Fed to cut next week. Gold buying from global central banks and strong haven demand also been helping the advance, alongside shorts getting squeezed. That also might have contributed to the metal's rise in value. And that's your brief, John.
Danny, thank you. 25.68 on gold. There has been one consistent tailwind, central bank gold buying. Danny mentioned it, big feature of this move over the past year.
And it's a structural shift, so when it begins, people forecast it to continue. And I'm thinking about China in particular, but also other countries that would like to diversify some of their FX reserves.
Another all-time high. Up next on the program, attempting to settle the debate about the debates.
I believe we owe it to the voters to have another debate.
We've done 2 debates, and because they were successful, there will be no third debate.
That conversation up next. Live from New York City this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The top names at Jackson Hole are on Bloomberg.
So we know that unemployment rates have gone from about 3.4% to 4.3%. That's a big change. Now, it's from super hot to solid, right? So I don't want to make it seem like labor markets are weak. But it really starts to tell me that things are much more imbalanced than they have been for quite some time.
Nobody covers Jackson Hole like Bloomberg. Context changes everything.
good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Live from New York City this morning. Good morning. Equities right now positive, just about by 1/10%. Just a couple of upgrades in the last 24 hours. Had one yesterday from Deutsche Bank. Binky Charter raising his S&P 500 forecast to 5750. And Lisa, just moments ago, we got another one.
Yeah, from Michael Purvis over at Tauback and Capital. Moving from the call that they had last December of 4,800 to 5,800. Again, we're talking about forecasts now of about 3 to 4% gains from here, from current levels. So this is a bit of a catch-up, but it highlights the sort of capitulation to the YOLO, FOMO kind of moment that we're really in the equity market.
It's leaning bullish. Going into a big Federal Reserve decision a week away. In the bond market, the rally continues or resumes. Yields down by 2 or 3 basis points. The 10-year 364.76. Under surveillance this morning, attempting to settle the debate about the debates.
Donald Trump and I had our first debate. I believe we owe it to the voters to have another debate.
She immediately called for a second debate, which means that she was like a prize fighter that lost a fight. We've done 2 debates, and because they were successful, there will be no third debate.
So here's the latest. Trump and Harris hitting the ground, running with a busy schedule of campaigning following their one and only debate. Trump holding rallies and fundraisers in Arizona, Nevada, and California, with Harris honing in on swing state voters with a return to Pennsylvania once again today. Joining us now is Bloomberg's Josh Wingrove. Josh, no debate or a debate? What's on the table at the moment?
My money is on no debate right now. Trump seems to have drawn a line in the sand. However, as we know with Trump, nothing is final. It can always change. You never know. This is, of course, a big flip. You talk about sort of YOLO and FOMO. Trump was going anytime, any place with Biden. He wanted like a million debates, it felt like, back then, just a few months ago. Of course, the first one set in motion Biden's exit from the race and brought in Harris. I think, the results of this, pundits are saying that Harris won it. We're waiting to see a lot of polls to see if voters agree. But right now it's Harris sort of begging Trump. So the tables have flipped. Doesn't look like we're going to get that. We will, of course, get that VP debate. So that's at least something for those, anxious for their fix on debate.
Josh, not to go into full-on scenario analysis, but if Kamala Harris, because you know these 2 individuals, if Kamala Harris came out and said, I'm willing to do a debate on Fox News, would then Trump show up?
It's a good question, because Trump yesterday did float Fox, and he floated NBC as options. Fox, of course, much more friendly to conservatives, typically extremely friendly in certain corners of Fox News. So Harris would have a calculus to make. She has not paid a lot of interest in the past to his previous offers to do Fox. Of course, his September 4th town hall that he did with Sean Hannity was initially unilaterally announced by Trump as a debate, and the Harris campaign sort of laughed it off as not a serious proposal. So if she was to say that, I think Trump would consider it because he thinks it would be friendly territory. However, she's shown no interest in it until now.
So, Josh, let's talk about where Kamala Harris is going. Pennsylvania. She continuously goes to Pennsylvania. So I read that they don't think they're winning that state right now. Is that accurate?
Pennsylvania looks like it's increasingly the ball game. The polls look really good for them in Wisconsin and Michigan. And the question is, how do you get those other 19 electoral college votes? Well, magic number, Pennsylvania has 19. So to win, she either needs Pennsylvania or she needs some combination of other states. Nevada plus either North Carolina or Georgia would get her there. Those are, of course, traditionally less blue states, although some polling has her competitive or even leading recently in North Carolina, for instance. You're going to see both of them in Pennsylvania all the time. And the question here, we've been talking a lot about what Harris has done since Biden left, right? A lot of the polls are up. The fundraising is way up. She's, more enthusiasm among certain blocks of voters. Joe Biden was from Pennsylvania. This is a state where the other side of that coin could come into play. Does him leaving the ticket, even with all the concerns about his age and his debate performance, impact things, in particular Northeast Pennsylvania, where he's from? Or can Harris put together the coalition that has won there in the past by driving turnout in Philadelphia, in its suburbs, and kind of holding the line throughout much of rural Pennsylvania, which skews, more Republican, a lot whiter, that kind of thing. So we're going to see them both in Pennsylvania all the time. And of course, that is putting a lot of eyes on the issues in Pennsylvania, including that U.S. Steel deal that we've been talking so much about.
There's a question around how much Kamala Harris is actually playing catch-up after not selecting Josh Shapiro as her number 2. Is that part of how you read some of the tours of Pennsylvania?
Yeah, it's the big question. I mean, her picking Walz is a bid that he can have broader impact in broader states rather than picking one guy that she would want to deliver one state. Now, Harris's team seems delighted with Walz. I don't want to leave any impression that they're sitting here with second thoughts. But hanging over this all is if they lose Pennsylvania and can't fill it in with one of those other scenarios like North Carolina and Georgia, then the Monday morning quarterback question after the election will be, could Shapiro have won this for them? And of course, that will tee up a lot of questions leading into 2028 about whether Governor Shapiro will run and if he'll be a top tier candidate. Of course, he would be a very high tier candidate if he did decide to seek the nomination in that scenario. So it's just everything, so much attention on Pennsylvania always. It just feels like more and more so. But things can change so much. Of course, 6 months ago, the war in Gaza, the Israel-Hamas war, was impacting things in Michigan in particular. Now Michigan is consistently looking like it's in pretty good shape for the Democrats. Of course, no one knows entirely, so things can change really quickly. But we only have, 53 days till the election.
Can things change very quickly for Nippon Steel as soon as the election's over?
Yeah. If they get an extension, this is the big thing. The timeline is the big question for them right now. There was a big meeting this week. Maury, the executive vice president who's been handling this, flew to Washington for meetings, and people have been reading the tea leaves on this. And right now, there are not a lot of tea leaves to read. But the question is, Joe Biden has pledged to kill it. Our reporting and the reporting of others is that he plans to block it once it reaches his desk. As of Wednesday, it had not reached his desk. We haven't had an update since then. The question is whether an extension will push it, because otherwise analysts think, people watching this closely think that deadline is coming up pretty quick before the election. So the choice it seems here is, does Biden have it hit his desk before the election and make a decision before the election, or is an extension granted and this drags on past the election, and then it's a different environment, obviously. I should note Harris, of course, is echoing Biden's position, which is they want U.S. Steel to remain domestically owned.
Yeah.
They've not been swayed by the proxy board that Nippon Steel has offered. Trump has just outright pledged to block it.
It would be nice if we had a sequence of questions on that in the debate on Tuesday night, but we didn't, Josh, and maybe we won't get another debate again. Josh, I've got to ask this. If Harris loves debate so much now, why does she still seemingly hate interviews?
That's a good question. I mean, I'm ready anytime, any place, man.
I feel the same way.
Yeah, good. I'll put in the word. They are going to do more. They announced yesterday, in particular, either constituency or local media in battleground states. She's also going to go talk to the National Association of Black Journalists next week. Remember, there was some to and fro about that a month or two ago, and Trump went, and it was, let's say, an explosive interview that caused a lot of head scratching. So she's starting to open the aperture a little bit. We'll see how far that leads. Right now, it's about 3 or so, if memory serves, interviews. She's done 1 national interview. It's not a lot.
Not a lot at all. Josh, thank you, sir. Josh Wingrove there of Bloomberg on the latest. Some might say it's nothing. It's nothing, really. 1 interview, it's pretty pathetic.
You ought to be getting your message out and answer questions, especially if they weren't necessarily answered during the debate.
Caveat, 1 interview with a human shield with Governor Walz. That's not fair. There really needs to be a one-on-one interview.
Sharon Miller of Bank of America up next, and certainly not on this.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
2 hours away from the opening bell, stocks are positive by 0.2% on a 4-day winning streak on the S&P 500. This could be day 5, up by 0.2%. The worst week of the year feels like a year ago, and it was last week on the S&P 500. This is the bounce back this week, heading towards a week of gains on the S&P 500 and potentially on the NASDAQ 100. Lisa, the best week of gains of the year so far.
Driven by NVIDIA, right now we are about 1% away from the all-time highs in the S&P 500 with a series of upgrades from the likes of Binky Chadha over at Deutsche Bank, as well as Michael Purvis over at Talbot and Capital. They're playing catch-up with a market that is now being supported by both the soft landing and a Federal Reserve expected to do what it can, to do whatever it takes to support the sense of a labor market that's resilient.
This bond market has a strong bid once again this morning. Across the curve, the 2-year out to the 10-year, yields lower by anywhere from 5 to 3 basis points. 5 at the front end, down 3 on the longer end, on a 10-year at 3.65, on a 2-year at 3.59. How quickly the conversation changes. A couple of articles here at Bloomberg, at the Journal, at the FT, quoting some former Fed officials, teeing up the prospect of a 50 basis point cut, and a market saying, oh, don't want to be on the wrong side of that.
What that shows to me is just how balanced, I mean, I hate using the sort of language of du jour, but how finely balanced the market feels like this argument actually is, and how people don't understand what the Fed's reaction function actually is in terms of trying to get ahead of some sort of weakening that has yet to be seen, or whether they are data dependent in the sense that they would like to see that weakness first. And that's really the ultimate question. You heard Steve Auth there saying, look, if they go 50, we'll be grateful. If they go 25, well, they have to signal that they've got a lot more down the pike.
For me, it's not just about the 25 versus the 50, and I think for all of us, it's about the message in the news conference. You can go 25 and achieve the same thing as you would have done going 50 by being very dovish with the forecast and the dot plot, and being very dovish in the forward guidance as well by saying, this is the first in a string of interest rate cuts. This is where we think neutral is. This is the beginning of that journey back towards neutral, and lean heavily on that kind of guidance. I think the most hawkish thing they could do next week, if you heard the kind of Chairman Powell that we heard in Sintra, Portugal at the start of summer, and you don't hear the kind of Chairman Powell that we heard in Jackson Hole at the end of summer, then you've got problems. Because in Sintra, Portugal, only around June, July was it, he was coming out and saying things like, the labour market's strong, and that gives us time, and we can be patient to get this right. That was basically the communication coming out of the Federal Reserve. If you say things like that next week on Wednesday, when this market's very, very focused on the other side of the mandate, that would be a very hawkish 25.
Basically, that means a 25 basis point cut would come with a pretty significant equity sell-off, especially if you take a look even deeper into the statement of economic projections. They start to right-size their unemployment rate at the end of the year to closer to where we are right now. On the flip side, a very dovish central bank would be one, a dovish 25 basis point would be one that would signaling another 100 basis points of rate cuts, which could happen later this year. So you just really are correct in saying the details matter.
It's a 3-part act. It's not just the 25 or 50 that you'll see in the statement. It's the guidance you get in the forecasts, if they call that guidance. Maybe they won't. and it's the guidance you get in the news conference with Chairman Powell afterwards. There's a lot to get through next Wednesday. In the FX market, the dollar's a bit weaker today against the Bollinger G10 off the back of that move in the bond market. The 2-year yield is lower. That means you've got a weaker dollar against the euro, 110.86, particularly against the Japanese yen, 140.84 on dollar yen right now. We're negative by 0.7%. Under surveillance this morning, Bloomberg learning the US and UK are considering lifting restrictions on Ukraine's use of longer-range Western missiles to strike deep inside Russia. Russian President Vladimir Putin warning against the move, saying the decision would be considered an act of war.
So basically what they're discussing is actually using Ukraine deploying British cruise missiles, but they would have to use the U.S. navigational data to use those missiles. And then Putin come out and says, well, if you're even using NATO navigation, that is an attack from NATO on Russian soil. This has been a debate for months. And I remember at the NATO conference, Biden was asked about this, and I just gotten back from Ukraine, and you really heard the Ukrainians pushing for this. And Biden said no, because if they have this ability to hit the Kremlin, we couldn't allow something like that. Say they go to Moscow. And the Ukrainians say, we're not trying to hit anything besides Russian facilities where their jets are taking off to hit Ukrainian soil. It's a big debate, but potentially we will see some movement on this.
It's one to watch in the next few days, that's for sure. Let's turn to the latest out of China. Set to raise the retirement age for the first time since 1978, the country's top lawmakers endorsing a plan to raise the man's retirement age from 60 to 63, while the age for women will raise from 50 and 55, Lisa, to 55 and 58.
What do you do if you've got a population that's aging much faster than you're procreating?
Don't let them retire.
Exactly. Basically work forever and expect to work forever. I mean, shockingly, those ages are pretty young. In the U.S., I think it's something like 75 years old.
I thought the same thing.
I mean, I was thinking to myself, they're just playing catch up. And at what point are we all going to be working until we're 95 with the help of, AI robots in our heads that can kind of make sure that we're cognizant?
Not many politicians in the West want to deliver that message, do they?
No.
Given that their cycle is 4 years.
Yeah, I mean, basically this idea of Social Security, you can't start paying until later on, is something that we've heard just briefly introduced, and that was political dynamite. That was not exactly what people wanted to see.
Well, Nikki Haley told Joe Matthew and myself that she wanted to raise the retirement age. She basically just said where we are right now is way too young. We need to shore up Social Security. And guess what? That clip was then turned into a Trump advertisement in Iowa to remind people why you should be voting for the former president. And then guess what? Stop talking about it.
Not popular at all. Let's turn to this report from the Wall Street Journal reporting Donald Trump's allies want to make another run at ending U.S. control of Freddie Mac and Fannie Mae. He's elected in November, saying former officials of the Trump administration, as well as bankers, have been discussing plans regarding the mortgage companies since the spring. That's the latest on that report from the Wall Street Journal. Elsewhere, Bank of America's business owner report showing cautious optimism from small and mid-sized businesses as the Fed prepares to cut interest rates. Sharon Miller of Bank of America writing, rate cuts will reduce the cost of debt servicing on floating rate credit facilities. This easing of the expense environment may create cash flow capacity for expansion or investment opportunities. We're lucky this morning that Sharon gets to join us on this program. Sharon, welcome to this program. I just want to start with this one. The amount of insight that you and the team have across 1 in every 3 small businesses in America. We're worried about stress starting to build, weakness starting to materialize. What are you seeing in the businesses that you cover at the moment?
Well, you're right. We cover 3.4 million small and mid-sized businesses in the U.S., and we are the #1 lender to small business across the U.S. And so we do have a lot of insight into what's happening. In our most recent survey that we did with business owners in the spring, we found cautious optimism from our clients. And so they do expect their revenues to increase over the next 12 months. And we know that debt servicing, as you said in the opening here, will be reduced because we do expect that rates will be cut, at least our economists do here at Bank of America, 25 basis points in the next 5 Fed meetings.
So, Sharon, are you saying they've got the confidence, the expansion plans are ready, they're just waiting for small reductions from the Federal Reserve over the next few quarters?
They are, and we still see demand in the marketplace now. So I'm not saying that they're waiting entirely. There is good growth across the small and mid-sized company sectors, but they are watching that. And certainly as we see rates come down, that will improve their cash flow and certainly consumer demand.
Sharon, I got to say, I was reading this report and I was shocked, the recent report that you put out. I was kind of shocked that actually we saw such sanguine sentiment, that people were expecting to continue to hire, that they were continuing to expand. They had positive outlook for their businesses. How do you reconcile that with some of the rhetoric that we hear every single day? This is an economy that's on the razor edge of turning negative.
You know, I think with small and mid-sized companies, so we bank clients in the business banking space from startup to 50 million in revenues. And so when you have a smaller company, you're certainly more nimble. You're able to really, think about your business, your growth, and you can pivot easily. Bigger corporations may have more of a hard time doing that. And so that is a competitive advantage of small to mid-sized companies. And we see that come through in the data and just in our conversations that we're having every day across the desk from these clients.
What I thought also was striking was in the market, it seems like inflation is no longer a significant concern. We heard just a couple of days ago from Mike Wilson over at Morgan Stanley that it's dead. Essentially, inflation is no longer an issue when it comes to what you're seeing in bonds. Nonetheless, 68% of small business owners say they've raised their prices over the past 12 months. And on average, they've raised prices by 12%. They're talking about inflation as a more pressing concern than many other things that we talk about every day. How do you understand whether this is really a small business issue or whether maybe we're not giving enough credence to just how much ongoing inflationary pressure there actually is?
Well, there is ongoing inflationary pressure. It is a sticky issue. And so we continue to hear that. That is the number one concern of small and mid-sized companies. And so you have seen price increases brought along because of all the pressure there. So I do see it as a concern. We hear it from our business owners, and we do feel that as we go forward and the cycle begins to ease a bit, that is going to take some pressure off.
Sharon, given that pricing pressure, how difficult is it for these small companies to keep up with the bigger players?
Well, I think that, there is some difficulty in keeping up with the bigger players, but I would say that, they also have a competitive advantage. And so, as supply chains have improved and as businesses have expanded, and certainly they've gone more online, gone more digital, they have more reach and scale than they might have had before the pandemic. And so what we are seeing are expansion plans from small and mid-sized companies, and they are competing. And certainly, they benefit from the downstream impact as well from larger corporations.
We're talking about inflation. We're talking about the fact that they're preparing for these rate cuts. When you talk to clients, what is their number one concern right now in this economy?
Their number one concern is inflation. And then right next to that is hiring and making sure that they have the right skilled labor, the right employees to go into their business to work. And so those are the concerns that we hear every day. I mean, we're also in an election year, so you do hear that as well. But we hear that with every election cycle. We've been doing this report for the last 10 years. And so in each election cycle, we see, concern once the election is over, no matter who wins, no matter what party, that there's certainty. And so people can move forward. And so that's what we're hearing this cycle as well. And, I anticipate after November, there'll be certainty and people will continue with their plans.
Sharon, talk to us a little bit about how things have changed since March of last year, given all the banking stress in this country and some of the banking failures as well. How some of your clients have changed the way they do business with you, whether you've managed to attract a lot more small businesses over the last 12 months worried about where they place that cash and they want to put it with a bigger institution like Bank of America. Sharon, how much has changed?
Well, I think, listen, we are the number one small business bank in the U.S., and we're very proud of that. We have been for the last 4 years plus. And so, we continue to stand by our clients in good times and bad. And certainly, we every day we work to attract new clients and to retain the clients we have, because this is our mission. This is where communities meet business, and that is what we do at Bank of America. So we want to be sure that we are there for our clients. We have the capabilities they need, whether it's to transact internationally, to be able to, have expansion in their business, to get a loan, to provide payments for merchants. So all of those different areas, we are able to help our clients. And so we want to make sure that we're there for them, whether it be our online tools and capabilities to manage their cash flow. So we're investing in the business based on what we hear from clients and what they need.
Well, we were thankful that you managed to make some time for us this morning, and we appreciate it. Sharon, thanks for joining the program. Thank you. Sharon Miller there of Bank of America. On the latest insight into the small business situation across this country, biggest banker of small businesses, and I think we need to get into this. I was surprised to see what you were surprised to see, which essentially is there's still confidence there that we've got this expansion plans ready to go, just waiting for a reduction of 2 or 3 or 4 in interest rates, and then we can start making a move. And then inflation is still the biggest concern for corporate America.
Basically, this flew in the face of a lot of the assumptions of a lot of people in the market in terms of the broader economy and the broader S&P 500. Question of how different this particular sector is from the rest of the universe. There were some nuggets in here, though. Yes, inflation, the number one concern, but when it comes to AI, I thought this was interesting, too. We all talk about AI adoption, how quickly it will be sort of rolled out. 37% of small business owners plan to use AI in 2024. Sounds like a lot. That's a 12 percentage point drop from last spring. So a question about the use case and whether it's actually getting diminished as time goes on.
That's a big stock market story as well, potentially for the next 12 months or so. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Biden administration has moved ahead with major tariff hikes on imports from China. The tariffs include a 100% duty on EVs, 50% on solar cells, and 25% on materials like aluminum and steel. That, according to a U.S. trade representative. The tariffs will go into effect on September 27th. China has vowed retaliation against the actions, claiming the success of its EV industry comes from innovation, not unfair government support. Hedge fund Millennium Management is looking to raise between $7 and $10 billion of locked up client cash. It will do so by asking clients to make pledges that Millennium can tap over time. Like its peers, the hedge fund has been moving to make more stable capital that it is able to access for longer. ECB President Christine Lagarde said the central bank may consider another rate cut as soon as next month. She spoke in Budapest just a day after the ECB cut rates by a quarter point. Lagarde said that an October rate cut would be warranted if the economy suffers a major setback. Still, Lagarde indicated that policymakers will remain data dependent and are leading towards waiting until December for their next move. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes' time. Up next on the program, divided over rate cuts.
The market has seemingly removed the expectations for a larger, more aggressive 50 basis point cut next week, but I would argue it was never really on the table.
The conversation just around the corner, that decision a week away.
Names that move markets are on Bloomberg.
I am a huge believer in trade. I believe that the benefits, the dispersed benefits to American consumers of trade are huge and important, and we've all enjoyed them. What is true is that the Chinese economy is doing something strange. They are leading the manufacturing of almost every clean energy product: wind turbines, solar arrays, batteries, EVs. But what's also true is they're by far the biggest polluter in terms of carbon emissions. And they're using their carbon emissions to try and drive their economic program of leading this energy transition to pull their very weak economy out of the ditch. So in fact, the idea that they should be charged for their emissions that are about a third of global emissions makes very good sense to me. And we're doing it in a not direct way, but it's actually a way that turns out to be pretty fair.
Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Equities this morning positive by 0.1% on the S&P 500. Yields a little bit lower, down 2 basis points on a 10-year, 365 on a 2-year, down a little more than that. We're down 5 basis points at 359. Under surveillance this morning, divided over rate cuts.
With this lingering uncertainty, unevenness in terms of the disinflationary trend, I think this underscores the Fed's need to remain on a very patient, tempered approach as we do embark on this policy pathway back towards neutral. Now, the market has seemingly removed the expectations for a larger, more aggressive 50 basis point cut next week, but I would argue it was never really on the table.
And then the market reintroduced it this morning. So here's the latest. Investors questioning whether the Fed goes 25 or 50 at next week's meeting. Vishy Tripatura of Morgan Stanley saying, although we're still looking for the Fed to start a series of 25 basis point cuts at the upcoming meeting, a 50 basis point cut is not off the table because our read of the jobs report sees heightened risks that the slowdown will be more than our baseline assumes. Vishy's with us around the table. Vishy, good morning, sir.
Good morning.
You've been around the world seeing clients, I'm sure. Can we just start with this massive bid and the bias to buy in this bond market for both sovereigns and corporates alike, and not just in the US, worldwide? What's behind that at the moment?
I think there is a general expectation. Two things are behind them. One is the relative value proposition between stocks and bonds. And the second is the expectation that we are heading to significant amount of rate cuts. And it's global. It's in the US, it's in ECB. So we expect to see more rate, the path ahead is for a lot more rate cuts. And I think that this basically makes, rate cuts are happening at a time when the economy, especially in the US, is not in a recession. Rate cuts are happening when the economy is clearly decelerating, but still, around 2% growth. And that's actually looks pretty good for credit. And I think main focus is really coming from, the path ahead for lower rates, and economy looks good, credit looks good.
Let's sit on credit, 2 words, and they're yours, dip, rip. Why the dip before this rip? What are you looking for in credit?
I think it's a little bit of technicals in this. The technicals here come from, seasonally, September is not a great month. There's some uncertainty associated with that. And, as the markets are resolving the 25 or 50, exactly what the Fed resolves it eventually for us, I think we might see a relative value between credit, as in corporate credit, and other parts of credit. Whether you look at, CMBS or CLO or other parts of other spread products, look relatively cheap at this point. But if you look ahead further, once it looks like a pretty good path ahead for credit overall.
Torsten Slok this morning putting out a note talking about how there's a lot of foreign buying of credit in particular. To just build on what John was asking about, where is the cash coming from to buy all these bonds? We were talking to Mohamed El-Erian yesterday, and he was saying this is the cash on the sidelines, kind of coming back in, away from money markets, into credit, into duration. Is that how you see it?
I think it's, the money sitting in money markets. I think the idea that there'll be money market will flow in one big swoop, I think that's misleading. It will take time, but I think when it does move, it will move more towards high quality fixed income rather than jumping into stocks. So yes, there is some of that. There's also what I would consider, especially in the US, there is an insurance company bid that's going on. So insurance companies are selling these annuity products, which are effectively fixed rate products that sit on the liabilities sit on the balance sheet, the assets sit on the balance sheets of insurance companies. They need a Treasuries plus 200, 300 type of product. And that bid is become insatiable. And that's, the sales of the single premium deferred annuity products have more than tripled in the last few years. And that's a big positive technical.
Yeah. A lot of the private investment firms have been offering these. This is the hottest growing area. We've talked to Apollo about that. I am curious, though, just from a broader perspective, how much what we're seeing in credit, what we're seeing in duration, is a technical trade more than, say, a macroeconomic call? And I ask that because we were just talking to Bank of America about how inflation is still the preeminent concern for a lot of small businesses. We see in the data this week, CPI, PPA, okay, great, it didn't surge to record highs, but at the same time, on the margins, just creeping up a little bit, or upside surprise in certain places. How do you reconcile the macro signals versus the reality right now?
Absolutely. I think there's a positive technical, no doubt. But the fundamental story for credit is really strong. If if you think that the macro story, as I was just saying earlier, Fed is cutting at a time when the growth is still pretty decent, 2% growth. And this decelerating but not falling off the cliff, when Fed cutting at the time of decelerating but not falling off the cliff, is actually very constructive for credit. If you in fact step back and look at, we've looked at data from 1948 to now, because we have data, because I'm a geek. I think basically what we see is that if you look at quarterly returns, excess returns in credit, and you map that with GDP growth rate during the period, credit does best when economy is neither too hot, not too cold. The 1 to 2% GDP growth rate is the context in which credit does the best. And we are precisely in that sweet spot.
You're maintaining a short dollar yen.
Correct.
Do you think the carry trade is over?
It's very difficult to say it's over. I mean, because it's very difficult to assess how big it is. I don't know if it's over or not. But we think that the yen is the direction of yen is more driven by the direction of the U.S. rates, particularly the 2-year Treasury. So we expect that the 2-year Treasury will drive, and that's we do expect to see yen drop further.
And then also the BOJ. Do you expect them to actually hike?
Our expectation, our base case expectation, is that of a 25 basis point hike next year in January from the BOJ. Certainly, the market is assigning somewhat higher, somewhat higher possibility that we'll see more than that. So this, what I would say, policy divergence, which is BOJ hiking while the rest of the world cutting, that actually makes this, regardless of why it is happening, we think dollar yen is going lower.
I hope we stop talking about the carry trade for a bunch of reasons. I hope we talk a lot more about the massive dollar long that's accumulated over the last few years, underpinned by US exceptionalism, particularly in the equity market, underpinned by the fact that this is where the income has been, the yield, with rates of 5.50 in the United States versus what's available and the direction of travel in places like China or in Japan. And whether that dollar long needs to be unwound. And what sparks that? Is it 50 basis points, 100 basis points of the Federal Reserve? I think we can park the carry trade language. The idea that there's this bunch of hedge funds that are doing something in Japan that influences something in America. There's something much bigger going on that's accumulated over the last few years. How vulnerable are we to a big unwind of that?
I don't think we are that vulnerable. I mean, we don't think we are in a point where dollar investments will shift dramatically away. We are still, the American exceptionalism stands still. It very much, that thesis very much is there. We still have growth differential, meaningful growth differential. We are decelerating, but the rest of the world is decelerating much more. If you look at China, clearly the prospects don't look that good. And then you have the idea that there will be cuts, but the rest of the world is cutting as well.
Yep.
So you put all those things together, we think the dollar as a reserve currency holds, and I don't think there's we periodically hear of this. Dollar is no longer a reserve currency. We completely reject that argument.
Sticking with it, Vishy. It's good to see you, sir. Vishy Tripatur there of Morgan Stanley. Rebalancing growth differentials is going to be harder than some people make out, Bramo.
That's the reason why people are looking for that carry trade boogeyman.
The third hour of Bloomberg Surveillance. Up next.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investments that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea, but ultimately you still have to do a lot with it. It just give you very superficial ideas, and but at the end you still have to customize and how to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment.
Yeah. Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I feel that when the designer doing is the spirit, is the heart that the computer don't have.
What did you say to your mother and father when you said, I'm dropping out, despite the fact I said I wasn't going to drop out?
Well, I said I'm just taking some leave.
Oh, leave?
Yeah. I think I'm still technically on leave. Harvard has kind of a funny relationship.
How long can you be on leave? For 10 years or so?
Well, I guess we're going to find out, yeah.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The market overall is a little bit vulnerable.
I think there is significant downside risk here, recession or no recession.
Recessions come from policy errors.
Markets are underweighting the impact of those pro-growth policies in the beginning of the year.
Definitely balanced risks looking forward into the next multiple years.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Henry Hearn.
We're almost there. The weekend hours away. The third hour of Bloomberg Surveillance starts right now. Live from New York City this morning. Good morning, good morning. For our audience worldwide, we add some weight to this rally on the S&P 500. 4-day winning streak. We're up another 0.2%, leaving behind the worst week of the year so far on the S&P and adding some weight to the best week of the year on the NASDAQ 100. NASDAQ 100 futures look like this. Positive by 0.02%. On a Russell, that's where your outperformance is. The small cap's up by 1 full percentage point. Off the back of this move in the bond market, check out fixed income. The front end of the curve, the 2-year yield is down by 4 basis points, 359.91. Let's just round it up and call it 360. Looking ahead to the Federal Reserve decision on Wednesday, 25 or 50. The data this week gave you a lean towards 25. PPE, CPI a little bit hotter. Jobless claims yesterday coming out just a tiny bit higher, but no drama. Still pretty subdued over the last month or so. Take the totality of the data, 25. Then this happens. The 13th member of the FOMC writes an article in the Wall Street Journal, and all of a sudden we start to query whether the bias is to go 50 and not 25.
There was an article that came out around 1 p.m. yesterday in the Wall Street Journal that talked about the two-sided debate around 25 or 50. Some officials have suggested they would rather speed up the pace once the economy looks like it is weakening further. Alternatively, and this is what caught people's attention, some may expect that if they do see weakness coming up, they ought to make that move now when rates are farthest from their ultimate destination. All of a sudden, just like that, 47% chance that you're going to get a 50 basis point rate cut. A real question here about whether this is guidance or whether this is just a reflection of the debate that's being had in markets right now.
I think it is highly problematic. I've said it on this program before, and I will say it again. It is very difficult to get a read on certain articles by certain authors on whether this is actually coming from the FOMC or coming from the author and the people they cite directly. And when you don't know, I think the Federal Reserve has a problem. And the Federal Reserve has a problem that's accumulated over a long, long time. It doesn't just go back to 2022, but let's take 2022 as an example. We were expecting a 50 basis point hike. We got UMich sentiment that week, that Friday, I think, before that Federal Reserve decision, and inflation expectations clipped higher. And all of a sudden we get an article sourced directly almost from the Federal Reserve, leaning towards 75. Ever since then, for this whole cycle, under this leadership, we've waited not just for Fed speak, not just for economic data, but for an article from the Wall Street Journal to give us a steer as to what's going to happen on the Wednesday. I don't think anyone at the Federal Reserve thinks that that's how you should run monetary policy, and I certainly would agree with them this morning.
There is a real question right now, again, and I think you're correct, in terms of is this a steer or not? And it was interesting to hear Jim Reed over at Deutsche Bank saying that this echoes, as you said, what happened over in 2022, where there were questions around how much they would hike rates. And this article put together the 75 basis points that they then came through with. A real question here, and Jim Bianco pushing back this morning and said this is the opposite because it introduces that uncertainty. We don't know whether this is a steer or just simply a reflection of a debate that's being had in markets. Either way, is this the way forward guidance is being operated? I
want to be super clear. It's not the author's fault. I think the author is the envy of the world in financial markets when it comes to financial journalism with the access he has in the Federal Reserve. It's not the author's fault. This is the Federal Reserve's problem. Yes. And I think it is a problem, a big one, going into a big meeting.
If you want to signal something, say it in a speech. If you want to steer the market directly. If you want to do it through second channels and it's not necessarily clear, then you might be giving a different steer, and you're giving people an outsized degree of power to influence the market and alternatively, potentially the Fed's power. You're right, because this is something that was traditionally what they did. And here we have a situation where it's introducing more uncertainty.
It's muddying the waters. They want transparency. And maybe a journalist can ask Jay Powell about this at the press conference. If you want to go to someone with credibility this morning, it's Dudley. The question is, why don't you just get started? That's what he said. It's basically up to Chairman Powell to see how much support he has for being more aggressive. I take Dudley's comments with a lot more weight in terms of potentially them leaning towards 50.
Bill's been making this argument for a while. Neil Data's been making this argument for a while. If you're offside, let's get a move on. And I think that the point that Neil Data made around interest rates is an important one too. If you go 25 instead of 50 because you're worried about the signal, why cut interest rates at all at this point? I think that's a perfect point, a valid one.
It is definitely highlighting the lunacy of some of these arguments. At the same time, you can imagine that if they cut by 50 basis points, maybe the market would extrapolate in 150 basis points of rate cuts, because why not cut by 50 basis points at every single meeting? Look, you can come into a lot of different scenarios. As you've mentioned, the Fed can do a lot with the messaging, with a statement of economic projections. So it's not just about this particular move, but going forward, where the balance of risks actually
Wednesday is a three-part act. You'll get the decision, you'll get the forecast, and you've got a big news conference as well with Chairman Powell. Equity futures on the S&P 500 firmer by 0.2% on the S&P. In the bond market, was shaping up as follows. Yields are a little bit lower, down a basis point on a 10-year, 366. On a 2-year at the front end of the curve, we're down 3 basis points to about 360. And foreign exchange showing a little bit of dollar weakness against the euro. Euro dollar at 110.80, a little bit more against the yen. Dollar yen down by 0.6%, Lisa, this morning.
And really, it'll be a two-part act next week as well, given the fact that we have the Fed conference on Wednesday and then the Bank of Japan rate decision. How much are they going to lean on what happens with how dovish Jay Powell actually is to decide whether they need to hike or signal a hike, or whether they can just leave it be?
Coming up on this program, Sinead Colden-Grant of BNY Wealth saying the S&P 500 can still climb into year-end. William Stein of Truist on the divergence among chip makers, and Troy Gajewski of FS Investments saying tech is one of the greatest growth stories in capital market history. ... because he's got things to say. So stay tuned. We begin with the big issue, the NASDAQ 100 heading towards its biggest weekly gain this year, going into the Federal Reserve meeting next week. Sinead Colden-Grant of BNY Wealth looking for the rally to continue. U.S. exceptionalism continues. The rotation that started with a soft headline CPI print for June is a healthy broadening of the rally, bringing our year-end forecast for 2024 to 5,700. Sinead joins us now for more. Good morning, Sinead.
Good morning, Jonathan.
It's good to see you. So let's start with this call, because this week has been about big tech, not the breadth, not of the broadening out, not about other sectors. In fact, at times, financials and energy have really struggled. Why is the bet beyond big tech?
Well, we're starting to see the beginning of the rate cutting cycle, as you were just speaking about. So whether we get 25 or 50, the point is that we're starting on the journey. So as we start to see a little bit more loosening of financial conditions, that's going to be helpful for equities broadly. One of the reasons why tech has done so well, setting aside the AI focus, it's been because of the amount of free cash flow that they've had, the fact that their earnings have been expanding so quickly. When we look ahead to the remainder of the year and also into 2025, so we're looking for earnings for the S&P for the full year to be between 245 and 255, and then higher again in 25, so 15% earnings growth in 25, getting us up to 280 to 290. So when you talked about 5,700, yes, that's right. That is the upper end of our range.
Okay.
So assuming we don't have a recession, that we do see a soft landing, you could even see markets slightly higher than that. And the other thing to remember is September is usually a tough month for markets. On average, markets fall about 1.2%. It's the broader market, the S&P, not the NASDAQ. But then you have almost a 3% rally in Q4. So looking at where we are now, that sets us up pretty nicely for 5,700.
Let's pick out a sector, the financials, the banks. It's been a really interesting week. JP Morgan's Dan Pinto came out and essentially said the analysts' expectations around net interest income are too bright, too rosy, so everything's starting to come down. JP Morgan had a terrible day that day. That's based on the path for interest rates. Ally Financial came out and said the auto loan book wasn't great. That's based on credit deteriorating. What was your takeaway from the conferences this week, particularly the Barclays Global Financial Conference earlier this week?
Well, look, the path of rates is clearly important for net interest income. We are of the view that we probably see 25 next week, but undoubtedly, somewhere between 75 and 100 by the end of the year. What those two contrasting comments are focused on is the impact on the consumer, right? The reason why you're seeing some deteriorating credit quality is because the lower income cohort have been really feeling the pinch, not only from the higher rates, but also the cumulative effects of inflation. So at the margin, as we start to see rate cuts, that will relieve a little bit of that pressure. But when we look across various segments of the market, you've got the upper income cohort performing very well. They've got balance sheets that have expanded. Generally, their debt service cost hasn't really changed since 2019. So they've been insulated by 2.5%, 3% mortgage rates. But at the lower income cohort, when you start looking at, we focus on, our 2.5% CPI read year over year, the most recent one. But when you look at the cumulative impact and you start looking at individual segments, food, energy, et cetera, you're in the mid-20s for the cumulative impact over 4 years. You take all of that together, not surprising that on the auto loan side, you're starting to see some pressure.
When you put it together, it just is a sort of a contradictory signal that's hard for some of us to get our heads around, this idea that you could have a weakening economy, you could have a rotation towards some of the more economically sensitive stocks that are going to be susceptible to some of these shifts, the financials in particular. And you're projecting a gain of about 13% from here to 6,300 by the end of next year. What's going to lead that? If you do have these questions around certain aspects of the cyclical market, and you do have these concerns about the resilience, particularly of a whole cohort of consumers?
Well, first of all, by the time we get to the end of next year, we're probably going to have seen somewhere in the region of 150, 200 basis points of rate cuts. So that's automatically going to help with some of those more sensitive sectors. But let's think about the economy more broadly. And look, realistically, market participants, we can tell, have been finding it very hard to believe that we're going to see a soft landing. And you've seen that in the market reaction that we've had to softer data prints. When we look ahead to 2025, we think the economy continues to expand. So in addition to an upper end of 2 to 2.5% this year, we think we see a similar level of growth in the economy next year, which will underpin sectors more broadly. Now, if you look at one of the sectors that hasn't done well this year, relatively speaking, it's consumer discretionary. And as you start to see rate cuts, you'll probably see that start to do a little bit better. But broadly, when you look at earnings across the board, 2025 heading into 2026 is when you've got to start to see investment in AI impact productivity, impact earnings, and that's the other tailwind that we expect.
It's interesting, the sort of shifting story around AI, and that's actually something that's where I wanted to go. Can you get a 13% rally in the S&P 500 in the next 14 months or so without participation of some of the big tech stocks?
They're a huge component of the market. So of course, if we expect the S&P to be at those levels, the tech sector is going to play a significant role there.
Sinead, we've got to leave it there. It's got to catch up. Appreciate your time, as always.
Thank you, Jonathan.
Thank you. Thank you so much. Sinead Colin-Grant there of BNY on this market going into this big Federal Reserve decision next week. As we keep on saying, three-part act. We get a decision in that statement. We'll get some forecasts as well and a news conference with Chairman Powell shortly afterwards.
Which has leaned dovish consistently, and that's probably why Bill Dudley's comments got so much attention as well. Not only is he the former New York Fed, but he also is saying, can he bring the rest of the committee around to his view?
Is he the 13th member of the FOMC? Equity futures on the S&P 500. Don't worry, Bill, we know you're not. We're up by 0.2% on the S&P. Maybe you'd like to be. I don't know. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Strategists at Bank of America, led by Michael Hartnett, are expecting stock markets to trade sideways until more clarity on the U.S. labor market. He wrote that a clear direction for jobs will, quote, resolve the autumn ambiguity. Hartnett also noted that stock funds had their largest weekly outflow since April, with $6.1 billion exiting the asset class, citing EPFR data. Meanwhile, investors continue to pile into cash. The New York Times just out with a report that Miami Dolphins owner Stephen Ross is talking with PE funds looking to sell a stake in the team. Besides the Dolphins, the transaction would also include a stake in the Miami Grand Prix and the Hard Rock Stadium. In total, Ross is looking to sell as much as 15% stake in the assets. Firms in conversation include Arctos Partners with a valuation above $7 billion, according to the Times. Elsewhere for the Dolphins, week 2 of the NFL season is underway, and the Buffalo Bills are riding high after easily handling the Dolphins in South Florida. Concerns are high, though, for Dolphins QB Tua Tagovailoa after he left the game with a concussion after diving for a first down. That's his 3rd concussion in 4 years. And that's your brief, John.
Yeah, that's not great. That's not great at all. Danny, thanks for the update. Appreciate it. More from Danny in 30 minutes' time. Up next, the Morning Calls plus William Stein of Truist on the outlook for chips. That's just around the corner from New York. This is Bloomberg.
Was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Top names at Jackson Hole are on Bloomberg.
So we know that unemployment rates have gone from about 3.4% to 4.3%. That's a big change. Now, it's from super hot to solid, right? So I don't want to make it seem like labor markets are weak. But it really starts to tell me that things are much more imbalanced than they have been for quite some time.
Nobody covers Jackson Hole like Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Andrew Honhorst of Citi with this to say, 25 versus 50 remains a close call. Articles in the Financial Times and Wall Street Journal keep the prospect of a 50 basis point cut next week on the table in our base case. The Fed cuts 25 next week, followed by 50s in November and December. But he says the story's not over. Next week, weak enough retail sales on Tuesday could push the Fed to cut 50. I think we all just want to see the back of this meeting next Wednesday, don't we?
I couldn't agree more, considering the fact that we thought we were getting most of the economic data that was relevant this week. Now, retail sales is the new Michigan Sentiment Survey.
Let's see what we get. Let's turn to the bond market. Price action looks like this. Yields are coming in down 2 basis points on a 10-year, 365.51. At the front end of the curve on a 2-year, down 4. It's a break of 360, just about. 359 leads through the front end of the curve, unlocking some dollar weakness on the margin again on the morning.
And this, to me, really does hinge very much with 25 or 50 and whether the market can extrapolate in an additional 100 basis points of rate cuts after that. Key question to me is just how much people are underweighting the possibility of the ECB actually saying, hold my beer, considering the fact that their economic outlook is negative and they did downgrade it further in the economic projections yesterday.
I keep saying this. If the Federal Reserve delivered the kind of guidance that the ECB do, can you imagine the kind of reaction? The growth profile in America is better than what we're seeing in Europe. Inflation is basically in line. Europe versus the United States, not quite apples for apples, but you know what I mean. And we've got an ECB saying, meeting by meeting, 25 now won't tell you anything about next time, a mystery. Let's see you next time. And the Federal Reserve, we're sitting here saying, oh, 50? What about next time? And the one after that? Show us a string, show me the dot plot. Talk to me about the destination. Where are we going?
If the Fed were going to do what Christine Lagarde did, you would see a massive sell-off in equities, led by those same small caps that might be the ones that get the biggest boost from the rate cuts right now.
Futures outperforming on the small caps this morning. Time for the morning calls. First up, JP Morgan cutting Moderna to underweight from neutral with a lower price target of 70, down from 88. The analyst saying quarterly results are not likely to surprise to the upside. Your second call from RBC, downgrading Halliburton to sector perform from outperform with a lower price of 37 from 44. The analyst citing disadvantages in a tepid commodity macro environment. And your third and final call, BNP Paribas downgrading Micron Technology by 2 notches to underperform and cutting its price target to a street low of 67. The analyst warning the stock will continue to underperform others in artificial intelligence. Divergence growing in the semiconductor space between the likes of Intel and NVIDIA. A theme to watch. William Stein covers semis and AI for Truist, and William Stein joins us now for more. William, let's get to that. The divergence that you're expecting, that theme, can you just build it out for us a little bit more?
Sure. Well, we didn't write a note on this recently, but certainly we have a view that semis are in an upswing in aggregate, but the end markets and products are seeing very divergent trends, right? For at least a year, we've seen these broad-based end markets like industrial and automotive and those end markets sort of drag. And, I think for folks that are just looking at companies that serve those end markets, you might say we're in a downturn and maybe at the bottom. But meanwhile, those who are very focused on the AI-linked names, you're seeing tremendous growth. In aggregate, it means that we've actually been in an upturn in semis for about a year and a half already. And, growth is quite good, but it's very much a story of haves and have-nots, with the AI-focused companies led by NVIDIA doing very well and many of the others seeing fundamentals trough.
Well, I do wonder then what you make of the recent volatility in NVIDIA shares. We saw just a comment from Jensen Huang coming out and saying that people are feeling really anxious, nervous, or emotional conversations about getting their deliveries. That was enough to boost the stock by more than 13% in just a couple of days. What do you think the signal is from the volatility in shares of such a massive stock?
Yeah, I think it's maybe an over-discussion. I think that's the best way I could describe it. An over-discussion by investors who are not sure and not perhaps long-term enough in their thinking on the trends that are, so powerful for this company. AI is one of 2 major trends that NVIDIA is experiencing. The other is a shift away from serial compute to parallel compute. That's a bit of a technical issue, but the big application there is AI. The demand is very strong. We think it's going to remain that way for some time. We think the return on investment opportunity for companies to build out these systems is very robust. And that's where the discussion tends to focus, right? Is, we're spending billions of dollars. Are we getting anything out of it? And are they all going to stop spending next year somehow? Our checks for some time have reinforced a view that 2025 is going to be a very strong growth year for NVIDIA, not just for these so-called GPU chips, this parallel compute for AI, but also the CPUs that NVIDIA is delivering into that market as well, this product called Grace, that's a big new opportunity for the company. We think that really ramps in 25 as well.
You can feel this anxiety, though, among a lot of investors. It's just been such the overperformer, the outperformer, the thing that's held up the entire U.S. equity market for a lot of this year, that surely it's got to change. And so we hear more and more investors talking about rotating their portfolios away from NVIDIA just to sort of diversify. How much can you push back and say, actually, even though it seems like we've priced in all of this growth, we haven't? How do you sort of reconcile some of the anxiety that you're feeling in your when you speak to clients?
Yeah, I think the most straightforward thing to do is to ask investors to stop looking at the price chart and instead look at the PE chart. You know, someone said to me the other day that, look, the stock's exploded. Well, if that's exploded, earnings have, gone to Saturn, right? I mean, the earnings growth has been tremendous for this company. And so, what you've seen in the PE action, I know through most of last year, you were seeing PE contraction despite this massive run in the stock. And I think that's the thing that I would focus on is certainly there's growth embedded in the outlook for this company. But the PE multiple relative to the growth we're seeing is really nothing demanding.
Well said, William Stein. William, we've got to leave it there. It's good to catch up as always. William Stein there of Truist on the latest for the semiconductors. Note just drops from Neil Dutter of Renmac. I believe in Jerome Powell. The case for 50 is strong, and so Neil is sticking with it. If there is a higher risk of rising unemployment than rising inflation, and the policy rate is well above neutral, a large upfront move makes sense. The high end of the central tendency for the range for neutral is 3.5%, and so a 50 basis point move would still keep policy in a restrictive setting. If the Fed is offside, maybe by as much of 100 basis points, it's time to get a move on. My words at the end there, but ultimately the sentiment's the same.
If they do that, I'm curious how much they're going to address the neutral rate, how much they really discuss the destination and whether their dot plot and the third part of the act or second part of the act of the economic projections when they come out, how much they elucidate the Fed's new framing of where they're going. Because what we saw in Jackson Hole was not a lot of discussion about that, maybe 3.5%, maybe 3%, who knows? But there wasn't necessarily a focus as much on naming what that destination looked like.
Chairman Powell did something really clever in Jackson Hole, Wyoming. He set a threshold for the whole committee to be judged by. He set a threshold for them, which means they're sort of constrained. He basically said, and we all know what the words were, we do not want to see or welcome any further cooling in the labour market, right? So everyone's got to abide by that. So when they sit around the committee, when it comes to the middle of September, next week at the decision, they have to look back on the labour market data of the last month and make a call. Have we seen a cooling in labour market conditions, yes or no? And is that desirable? And the answer to that is yes, we have, and no, it's not. So we should do something about it.
How much? And now that's the question. Right now, that's the reason why the debate is between 25 and 50. There's a question of whether this will spook the market. It seems like fewer people are mentioning that, actually. Fewer people are actually talking about the fact that this would actually be a negative signal to markets. And yet, you have to imagine that at some point, there's a question of whether it's too much weakening. I don't know. I'm personally thinking that when do you start worrying about inflation again?
That's your call? You think that's what gold's reflecting this morning?
Yeah, I do. I think that right now there is a feeling that this market might be baking in a overly complacent feeling about inflation at a time where small businesses are still saying that's their preeminent concern, and you're still seeing housing costs remain high.
New all-time high on gold again this morning. Up next on this program, Tiffany Wilding of PIMCO, Troy Gajewski of FS Investments. From New York, this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
60 minutes away from the opening bell, equity futures on the S&P 500 look a little something like this, just about positive by 0.2%. I tell you what, last week just feels like ancient history. The worst week of the year on the S&P 500, bouncing back and going towards a week of gains. On the NASDAQ 100, Bramo, we're looking at the best weekly gain of the year so far, a move of 5%. People are sort of downplaying the importance of NVIDIA and this big rotation that's going to take place. Jensen Huang, a few words, the CEO over at NVIDIA, and you've had a major move on that stock this week.
People have been trying to move away from this and viewing it as healthy, and then they just can't get enough because at the end of the day, I mean, we just heard basically from Will Stein that what you see is their earnings are keeping up with their stock price that's surging so much. Question about whether the rotation will continue, though, in a more significant way, not necessarily with underperformance, but just outperformance of small caps if you do get that outsized rate cut.
Outperformance on the small caps this morning, the Russell up by about 1% on the Russell 2000. There's some of your index level movers. Let's get you some stock movers with Manus Cranny. Good morning, Manus.
Jonathan, good morning. Yeah, it seems as if we've moved off that buy the dip to incremental FOMO. 5 days ago, we started this show with this stock bid on the prospect of a deal between the unions and management. That unfolded overnight. 33,000 machine workers going on strike. 25% is the pay deal that's on the table. But here is the thing. This is a company burning through cash. So we've gone from the euphoria of Monday morning to the reality of that strike coming to bear. If they go out for the average strike, 50 days, you're looking at 3 to 3.5 in terms of the additional cash burn. They can't afford that on the credit outlook. So we started from the ecstasy to the agony of Boeing. Have a look at this. Oracle, if you really want to go beyond the Mag 7 and understand who is eating into the cloud pie, it is Oracle. Basically, this stock was up 14% to the close last night. We're now up 20% for the 5 days trade if we finish up 6.4% today. It's a vigorous guidance again from this company that they are making inroads in the cloud business. Guggenheim have a price target of $200 on the stock. So the momentum is with Oracle. Let's close it off with Adobe. What do you not want to hear from the guy that runs all the innovation around AI? And this is what has happened. The AI guidance here, use our AI. It's not about monetizing our AI. That is not what the market wants to hear. The market does not have the patience for get used to my AI. The market wants you to adopt, use, and monetize. And that is not what we heard from Adobe overnight. Morgan Stanley still stick with 660 on the books. Jefferies are still there at $700. So it's not the guidance in terms of profitability. It is the AI delivery story. Jonathan.
The language matters. Manus Cranny, thank you. Not a pretty chart on that stock this morning. A pretty chart for NVIDIA. That name this week is up by almost 16%. That is a cool $400 billion of market cap added to that name this week. Isn't that amazing?
Well, if you said words matter, use, not necessarily adopt, well, anxiety by our clients, boom, for 16% rally. That's what you see in NVIDIA.
What a stellar run for that stock. That's the move on NVIDIA. Let's talk about the moves we've got to see over the next week. A busy slate ahead with retail sales and a Fed decision next week. Tiffany Wilding of PIMCO saying we are heading back to pre-pandemic conditions. Developed market economies now look more like they did in 2019 than at any time since the pandemic. In that context, we think the more relevant question is this: why are interest rates still well above where they were in 2019? Tiffany joins us now for more. So Tiffany, you've got to give us the answer. What did that conversation sound like at PIMCO this past week?
Well, I think the bottom line for us is certainly interest rates are coming down. The Federal Reserve, I think, has also been very clear about that. Powell, when he spoke at Jackson Hole, I think acknowledged the fact that monetary policy now probably doesn't reflect the underlying conditions in the U.S. economy. And if you look at the labor markets, we don't think that the U.S. economy is in recession, but nevertheless, the recent loosening in labor markets just suggests that there is some possibility for overshooting on that side. And in that kind of vein, the Federal Reserve should be focused on moving policy rates back to neutral. And I think the question at this point is just how quickly they get there. We think they probably will revise down their own estimates for the rate path in September. We're looking for a 25 basis point rate cut, but for them to really signal they're going to do a sequence of cuts here.
Tiffany, tell us where you think neutral is. If they revise the path down, what is the path to?
Yeah, I think that's a great question. So the Federal Reserve still believes it's between 2.5 and 3 on a nominal basis. And I think ultimately that's why they will get there, with not overnight. They're not going to move the policy rate there overnight because they're not exactly sure where it is. And when you're not sure, you want to just go slowly. Now, how slowly, I guess, is the question. And it's about balancing risks. You obviously don't want to take the economy into recession because your policy is too tight. We think a reasonable kind of baseline for them is to kind of write down a median rate path of kind of 3.5% by the end of 2025, could even be a little bit lower than that. And so that's the kind of pace, every meeting type of pace over the next several meetings to see how the economy responds, and then they can reassess and make a further decision from there.
Tiffany, we've been talking a lot about 25 basis points or 50 basis points on Wednesday. And before we get into the guessing game of how you interpret the tea leaves that have come out of a number of publications overnight, I am curious about how you will be gauging the trickle-through effect to the real economy of whether they cut 25 or 50. How will you understand how that's being sort of deployed in the real economy?
Yeah, well, I think if a 50 basis point cut is if they end up doing it, it suggests to us that, or would suggest, I think, that they're more worried about downside risks to the economy, and they want to kind of more quickly get to neutral. We've said they've achieved a soft landing. Now, really, it's going to be about sticking that soft landing and keeping it going. And I think again, the question is about how quickly they know they need to get to neutral. How quickly do they get there? So that's how we would be reading. We still think a 25 basis point rate cut is probably reasonable here. We don't think the economy is in recession right now. Certainly the labor market indicators, are worrisome, but we have had this big surge in immigration that is kind of blurring the picture with some of those indicators. So, I think there's a lot of things they have to take into consideration here. And so again, 25 with a sequence of cuts that they signal seems reasonable to us.
Just what I'm trying to get at is what's going to be the actual implementation of lower rates in the economy? Will you be looking for some sort of significant uptick in small businesses borrowing? Are you going to see increases in consumer borrowing or reductions in, say, some of the delinquencies as people's borrowing costs go down? What are the sort of signs that this actually is working at a time where the efficacy of monetary policy has been profoundly questioned as rates went up? And now the question is how quickly it'll be implemented on the way down.
Yeah, I think if you look at the household sector, we've been talking a lot about this as well. Households just haven't really felt higher interest rates. Many of them have low rate mortgages that they locked in to 30-year periods during the pandemic. So the household sector probably won't feel a lot of it, unless you have new home buyers or first home buyers. But where I do think it could be potentially helpful, is in terms of housing supply. So we've all known that we've been in a period of underbuilding slowing relative to population growth over the last decade post-pandemic or more, and that's resulted just in supply-demand imbalances in the housing market, which suggests to us that as you have rates coming down, you can have real residential investment that picks up. That's obviously going to be helpful for the economy. We think housing investment probably subtracted 1.5 points from GDP in the third quarter. That's a pretty big subtraction. So just getting that back into some modest growth, we think, is probably helpful. And you could certainly get that as you have rates coming down.
I'm glad you mentioned housing. There's been this debate on what actually will happen when rates come down. Will people start moving and more supply will come on the market and costs will come down? Or potentially, will we actually see housing prices go higher?
Yeah, I mean, so in terms of, the moving and the existing home sales and things like that, when people move, they usually move from one house to another. So, in terms of the aggregate supply picture from that, yes, you get more churn in the market, but it's not on net really that, it shouldn't increase by that much the overall supply of homes. What increases the overall supply of homes is new building. And so that, I think, is really the key. Building, has been slow and sluggish this year because interest rates are elevated. Many builders you talk to say the economics are, make less sense with higher interest rates. And so when rates come down, we do think that, building will accelerate somewhat. And I think that's ultimately good for the economy. It's good for the supply-demand imbalances. Eventually, hopefully, that helps to moderate housing prices. Although, we don't think that they drop, housing prices will probably be, kind of 5% type-ish ranges. But again, I think that's not necessarily a bad thing for the economy.
Tiffany, and just circling back to what Lisa alluded to, some of the tea leaves that are coming out of things like the Wall Street Journal or the Financial Times, if the market is now presented with potentially next week the Fed going 50 basis points, does that mean now there's outside weight on retail sales next week?
Well, certainly, I think if retail sales next week is bad, is much worse than expected, I think that would maybe potentially increase some probability. I think if you just kind of take the broader range of data that we've gotten over the last month or two, labor market data, in our minds is important, and the labor market data that we saw, it wasn't great, but it wasn't terrible either. So it does suggest that labor markets are slowing, and I think the Federal Reserve wants to try to understand what's going on there a bit more. The slowing that we've gotten over the last couple of months, I think, has been more pronounced than many people expected, both in payroll growth and, of course, the unemployment rates ticking up. So I think, they probably look at that and they say, we are a little bit concerned about that. And if you're concerned about payroll growth slowing, the labor market slowing, of course, you'd expect consumption to be slowing as well. So they probably will be looking at retail sales and those consumption indicators, to kind of confirm or deny, if you will, whether the labor market slowing is having a broader impact on the economy.
Tiffany, appreciate the update. Thank you. Tiffany Wilding there of PIMCO. Looking ahead to next week, the data, including retail sales, going into that Federal Reserve decision, 25 or 50. But the nuances beyond September, I think, is so important. I don't think we can overstate this enough. When we sit here next week and talk about a September rate decision, we'll have a conversation about 2025 with very limited information about policy in Washington. When we sit here for the next meeting on November 7th, we'll have a much clearer picture, we hope, of what policy might look like in 12, 18 months, the next 4 years possibly, and it could be a very different conversation.
You've mentioned this before, though. How often has the Fed moved ahead of actually policy getting passed versus just the suggestion of it? And this is a tricky moment because people say that fiscal could ultimately change it. And you know why? Because it could be inflationary. This is the reason why I think that is potentially one of the bigger risks being built into the market is the balance of risks and how this market, how much it's sort of moved past inflation, maybe before the proof isn't really shown.
When it comes to fiscal policy like the tax cuts, that's going to be a long, drawn-out debate. When it comes to tariffs, that could be almost immediate. And I go back to what Mike Schumacher said to us earlier this week, which was basically, if you get a Harris administration, the Fed could cut more because she's not going to put up the walls as high as Donald Trump. But if you get Trump in the White House and he decides to put up the walls immediately, and he could do so unilaterally, potentially are we looking at a Fed that might have to recalibrate and start hiking again?
We could have a very different conversation at the Federal Reserve's next meeting after this one in September. Joining us now to discuss is Troy Gayeski of FS Investments. Troy, good to see you, sir. As always, welcome back to the program. Before we get into the markets, let's talk about the Federal Reserve. What's the base case for you and the team?
Yeah, so 325 basis points cuts. You know, we came into this year thinking 2 to 3. There was some overreaction, obviously, early on that there'd be 6. And then when the inflation data came hot in Q2, some folks were arguing for none. But, you know, it's almost a certainty at this point that we're going to get 3 cuts. Clearly, the labor market's softened. There's no doubt about it. Inflation's gotten much more under control. That's the right policy response. And I'll tell you, you know, when you think of credit investors like ourselves or originators of private debt, you know, we're more than happy to trade off some degree of incremental income to further reduce the risk of a recession going forward. And so that's where we're at in the economy, and it's going to be an appropriate response. To your point before, it's now about next year and the year thereafter where there's much more uncertainty.
Yeah, much more to play for. Troy, I want to get to the quote from Tiffany Welding just moments ago from PIMCO. When she said this, and I'd love your reaction to it, developed market economies now look more like they did in 2019 than at any time since the pandemic. In that context, we think the more relevant question is this: why are interest rates still well above where they were in 2019? Troy, what's the best argument for that, do you think?
Yeah, so when you think longer term, right, arguably the biggest reason why we should have more sustainable inflation going forward than we did pre-pandemic, and particularly in the post-GFC realm, where, as we all know, the Fed was struggling just to get inflation too, it is a much globally tighter labor market, right? You think of places like Japan or even China now, declining working age population. The U.S. labor market has gotten much more structurally inefficient. So that's arguably reason number one. And then reason number two, of course, is this really desire to onshore production. Obviously, we're going through a period of protectionism. So, you know, I think that debate is new terminal rate 2.5 or 3. We can debate that quite vociferously. However, it's certainly not 0 unless we have some type of major exogenous shock that is unforeseen.
There is this question right now of how much we can really count on just sort of inflation continuing to diminish. And I just want to build on what you're mentioning. How are you sort of countering the assumption in markets that inflation is dead in terms of more contrarian investments that push against that?
Yeah, you know, I don't think we're arguing, or most rational market participants are arguing that inflation is dead. It's just that we've made significant progress. And the balance of risks is now much more symmetric between the labor market and inflation. But in terms of counter-cyclical to that thinking, there's really nothing specific there. However, you know, opportunistically, we have to look across markets and try to find areas where there's more inefficient pricing. So, for instance, if you look at most spread product, whether it's high-yield bonds or levered loans, and even in on-the-run private credit, spreads are relatively tight. They're a little bit tighter than they were coming into 2022. You still have very attractive yield. However, if you look over at public markets, what you're seeing is markets are pricing about a 22% probability of deal breaks in each individual deal and mergers. Historically, over 10, 20 years, it's been 5. Even in this environment, it's peaked at 8%. So we're trying to identify inefficiencies like that we can take advantage of in our liquid strategies.
I know you focus on illiquid strategies and some of the private investments. You're talking about merger arbitrage. And let's go there, because this is actually one area that a lot of people don't want to get caught dead in, just simply because a lot of these deals have been broken. And we have seen a very different FTC under Lina Khan. How can you have confidence to go in and bet that deals are going to get done now, given how politicized so many of these deals are actually getting?
Yeah, well, I think, again, that gets back into pricing. Let's say, for instance, markets are pricing in 12 or 15% probability of deal breaks, and the historical average is somewhere between 5 and 8, depending on how aggressive the FTC was or not. It would be a different story. But as an investor, you're always trying to look at market mispricings versus empirical data. And this is one of the more glaring. And we're not going to say it's an overreaction to your point, a very active FTC. It's just presenting itself with a very attractive theme over the next 12, 18 months. And I think at this point, regardless of the political outcome in November, that looks like a very attractive risk reward to us relative to other strategies out there.
Interesting. Troy, it's good to hear from you, buddy. As always, Troy Gajewski there of FS Investments. Thank you, Troy. Appreciate it. The personnel changes down in Washington. Big deal for this market.
Yeah, we have to see what happens. You know, J.D. Vance was one of those individuals that thinks Lina Khan is actually doing a decent job, and he looks across the current Biden administration. We should know we've asked Chair Khan to come on Bloomberg a number of times. I've met with her before privately in the past. And, yeah, we still welcome her appearance.
Still no appearance?
Still no appearance.
Disappointing. Disappointing. I have to say this, though. Vice President Kamala Harris, based on reporting, also facing pressure to get rid of Khan. And not exactly coming out and vocalizing her support for her either, is she?
We don't have clarity on exactly what this merger policy will look like or what the FTC will look like, which is one reason why a lot of people are wondering whether you see a surge in mergers that do get completed after the election, regardless of who gets in the White House.
This started with the conversation earlier this year, the very beginning of the year. Do you remember with Brian Moynihan of Bank of America?
I do.
Who made this point about deal flow being held up by the fact that we don't know what kind of deal gets through Washington? It's a problem.
I mean, I think Kroger's and Albertsons was sort of the key example. If they're looking at trying to compete against Walmart, if they're looking at trying to compete against Amazon, and if they can't get a deal done because they're being held up as somehow creating more expensive groceries, that creates a real issue of what the threshold is at a time when you have a lot of banks that are potentially going to look to merge and other sectors as well that are looking for a certain economy.
Do you remember the handbag transaction? What was that? Do you remember that one?
That was with
Capri, wasn't it?
Capri, yeah.
Yeah, coaching, no handbags, that was a problem. Do you remember that one?
Handbags are a problem, groceries are a problem,
groceries
airlines
makes sense.
are a problem.
I can understand the sensitivity around groceries and airlines. The sensitivity around luxury goods, I couldn't get my head around at all.
Clearly you don't have handbags. You should just try a little bit more.
Worried about entry-level luxury down in Washington. Makes sense of that.
That's the reason why people really are having trouble understanding what deal could potentially get done.
Let's get you an update on stories elsewhere. Let's move on to your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. United Airlines has announced a deal with SpaceX's Starlink, where Elon Musk's company will power their in-flight Wi-Fi. United is now the first major carrier to use the satellite system, becoming a marquee customer for Starlink. The airline said in a statement that it will begin testing the service early next year, rolling it out later in 2025. The yen strengthening this morning for a fourth consecutive day to 140 versus the dollar, the strongest level of the year. Traders told us that hedge funds are in the options market, putting bullish bets on the yen against pairs like the Aussie, Swissy, and offshore yuan. Bank of Japan speak that signaled more rate increases will come has helped the yen advance about 14% versus the dollar since the end of June. Economists surveyed by Bloomberg say the Fed is likely to cut 3 times this year, each by a quarter point. Only a few of the 46 economists surveyed anticipate a larger half-point reduction at the November-December meeting. However, respondents do think that policymakers will pursue a more aggressive rate cut path in the years ahead. And that's your brief, John.
Danny, thanks for this morning. Have a great weekend. Up next on the program, we'll set you up for the day and the week ahead. That's just around the corner from New York. This is Bloomberg.
Every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying, put your hand up for the most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
there is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Counting you down to the opening bell, here's the trading diary. The week ahead, your agenda, the calendar at 10 a.m. Eastern Time. We'll get UMich consumer sentiment data at noon. Donald Trump holding a news conference in California as Kamala Harris prepares for a rally in Pennsylvania. On Tuesday, the data kicks off, it's retail sales, and the FOMC two-day meeting begins. On Wednesday, it concludes. A Federal Reserve rate decision followed by a Chairman Powell news conference. Happens on Wednesday. We'll get some forecasts as well. On Thursday, another round of jobless claims. And on Friday, a rate decision from the BOJ. With us around the table, Mike McKee. Good morning, Mike.
Good morning.
Let's get into this. What do you make of some of the recent commentary? The shift back towards 50, it seems, at the Federal Reserve.
Wish being father to the man. I'm not sure exactly. Obviously, we had stories in the Wall Street Journal and the Financial Times yesterday that suggested that it's a close call. I don't think anybody would argue with the fact that it's a close call. It doesn't appear, if the bottom line question is, did Jay Powell call up and tell them what they're going to do? No, I don't think so, because both stories were rather ambiguous about it, but it does raise some questions in people's minds. So maybe loosens up the mark a little bit in case there were something. But we're still a long way away from Wednesday. And we have retail sales coming up. I know you were talking about that earlier. And that could be something that pushes the Fed one way or another as well.
Do you think that the Fed welcomes or pushes back against the idea that people don't know whether certain things, articles, are tea leaves or whether they are just simply reflecting the market discussion?
Well, I mean, if they are leaks from the Fed, it's a deliberate effort to steer the markets. And we saw that back in June of 22 when the Wall Street Journal got a call from the Fed and published a story that basically pushed the markets into the 75 basis point cut because the Fed doesn't like to surprise markets. But in this case, you've got a situation where now it's not going to be a surprise if they do 50 or 25. It's just that we haven't in so long had a live meeting where it could go either way, where what they do matters as much as what they say.
How much focus do you think, besides Jay Powell's, everyone else on the FOMC looking at stories like this, when everyone came out and basically said, yeah, it's going to be 25 basis points, and now there's starting whispers of maybe it's going to be 50?
I don't know that they really pay a whole lot of attention to it. If it were a leak from somebody, then that person would be paying attention to it. But this is the day, the Friday before the meeting, when Jay Powell gets on the phone and speaks to everybody one after another and kind of takes the temperature of where they are.
So it would be the perfect day to put stuff in the newspapers. I suppose it would
be the perfect day if that was his goal. But I think each one of them comes into the meeting with their views fairly set about what they're going to do, because they have to make a decision. So they've been sitting, especially the bank presidents, have been sitting with their economists and people in their banks and coming up with a decision for each of them to bring into the meeting.
It's the first live meeting in a long time, and I can't wait to see the back of it. Michael McKee, thank you, sir. Coming up on Monday, I'm sure everyone feels the same. Laurie Calvasina of RBC, Savita Subramanian of Bank of America, PIMCO CEO Manny Roman, and Megan Robson of BNP Paribas. All of that to come next week. From New York, thank you for choosing Bloomberg TV. Have a wonderful weekend. This was Bloomberg Surveillance.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Yeah, I think that it would be irresponsible for us to ignore the AI revolution. I think that as much as there is a lot of short-term hype, I think long-term it has the potential to be transformative. And so we are spending a lot of time thinking about what elements of it are structurally have barriers to entry, and so there is a winner-take-all element to that and which don't. And it seems to me that things like chips, things like infrastructure of, and systems has a little bit of that, because NVIDIA is so far ahead, it's expensive to catch up. There's, the technology that it requires to build these chips are sort of based in Taiwan. What we're seeing is that some of the apps and some of the applications, there are no barriers to entry, right? Like, it's fairly easy to come up with, and I don't mean to belittle the complexity of it, but there are not moats around those things like they used to. So I think that there is less of a winner-take-all in that space. You're going to have to earn that spot, whereas it'll be fun to watch what happens. And I think there's going to be a lot of money burned in the process, because somebody will develop something and a fast follower will come along and make it better and cheaper, because data gets cheaper and more pervasive, and it's going to be easy for new players to come in and do interesting things. So I think we wait and we see.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry, and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
All right, stocks trying to hit 5 straight days of gains. It certainly feels like a while since we've seen that. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, it's 50 versus 25. Economists split on how the Fed will communicate next week's policy action. And no deal. Boeing shares are sinking as factory workers walk off the job for the first time in 16 years. And sticker shock. We'll speak to the CEO of Spartan Nash as consumers across the nation grapple with increasing grocery bills. 30 minutes to go. Let's take a look at where markets are trading right now. And like I said, a little bit of green on the screen. Of course, that would be 4 straight days of gains, 5 straight days of gains for the S&P 500, which we will show behind me at some point. Of course, we saw 4 straight days of losses to start September. We'll see, of course, if we can keep the momentum going on the S&P 500, currently up about 0.2%. The NASDAQ 100 can't really decide what to do. Your big tech stocks currently unchanged pre-market. And then you take a look at the 10-year yield, Sonali, currently lower by about a basis point.
We'll talk a lot more about that bond market. I know it matters today going into that Fed meeting this week. But of course, some stocks to watch pre-market. Talking more about Boeing because it's down as Seattle employees walk out on strike for the first time since the great financial crisis. You have Boeing shares down almost 3% pre-market. We'll talk more about that. On the earnings front, Oracle impressed Wall Street with a bullish 2029 revenue target, while Adobe disappointed with guidance on AI investment returns. You have Adobe just sinking now more than 8.3% pre-market, and Oracle up more than 6.3%, Katie.
A good reminder, of course, that we are still in earnings season, but let's go back to the bond market and why it matters today, because, of course, bets on a 50 basis point cut next week are building again. You have Bill Dudley, of course, coming out, making the case for 50. You also have Neil Dutta over at Renaissance Macro pounding the table in a note this morning. And let's just be honest here, the elephant in the room, Nick Timrose over at the Wall Street Journal, out with an article, of course, exploring the case for a 50 basis point cut, which really reignited this current round of speculation.
He's defined himself as really the Fed whisperer this cycle, which is why traders are taking this report so seriously. And the question he poses at the very top is start start small or begin big. And really, you're looking at a market on the razor's edge, Katie.
It is really interesting. Of course, Bill Dudley kind of exploring that as well, saying that right now, the risks to the labor market, those are more pressing than any concerns about lingering inflation here. So it's up to the Fed. I mean, less than a week to go. It's a big decision, and it's a live meeting.
And it sets a tone for the rest of the year. We're going to discuss this now with Ellen Hazen, FL Putnam Chief Market Strategist. And what would 50 basis points say to the market? There's a worry under the surface that 50 might be a little drastic here and set off this idea that things are worse than they seem. There's a flip side here that says if you start big, then it creates room to go less later on. How do you feel, Ellen?
That's the question of the day, Sonali, isn't it? And that's what everyone's talking about yesterday and today, especially after the Wall Street Journal piece that you referenced, as well as some other comments made by Mr. Dudley and others. So as we look at it, we think that a 50 basis point cut would be more problematic than a 25 basis point cut. And the reason for that is that, first of all, a 50 basis point cut does say, look, things are more serious than maybe you might know, and it does indicate a little bit more strong action, which might spook the market. But the other side, which I think is just as important, if not more so, is that a 50 basis point cut is very likely to boomerang on the Fed and to cause the equity markets to spike, thereby loosening financial conditions a lot more, and maybe taking a little bit of that control out of the Fed's hands, which I don't think they want to do. So we think, like the market most of the time, that 25 basis points now, another 25 perhaps in November and December is the right move. And we think that 50 basis points not only sends a message that things might be worse than they seem, but also might complicate their job by sending the equity markets off to the moon again.
Oh, very fairly, Michael McKee points out that the Financial Times also has been pointing out the question about the razor's edge we're standing on as well. A little shout out to our former producer, Colby Smith, over there. Ellen, you know, if you think about the spillover effect there is to the equity market from the bond market, is there a significant one that you expect, whether they go 25 or 50?
I think that the equity market is very focused on corporate earnings growth and what growth is going to be next year from a GDP perspective, what jobs are going to be, and what corporate earnings are going to be. And right now, that looks pretty healthy at 15%. I don't think that the equity market impact is going to end up spilling over to the bond market, which is much more focused on inflation and overall economic growth, but not so much corporate growth. So I think that those might be not as closely joined at the hip as they have been in recent months.
And Ellen, give us the outlook for small caps here. I mean, this has really been the back and forth, hot and cold trade of the past several months. I mean, if we enter into a cutting cycle where maybe the Fed is a little bit more aggressive than markets are pricing in right now, of course, taking that more cautious tone just to front load a little bit here, what would that mean for that universe?
It's been a really tough slog for anyone who's tried to invest in small caps over the last couple of years, because there have been at least 4 pretty big false starts where in any given month, small cap universe has outperformed and then gone on to pretty dramatically underperform over the subsequent months. And the reason for that, as we see it, is that small cap earnings just are not there, right? So we all know about the debt and the fact that small cap companies have higher debt, more variable rate debt, they're more adversely affected. But the really important thing is that estimates for the small cap indexes just keep going down in a way that S&P 500 estimates are not going down. So you saw this false start again in July, right? And then where small caps outperformed, people thought, okay, now is the time. And then in August and in September to date, it's just been another disappointment. We don't think small caps durably outperform until after the economy has slowed and is exiting either a recession or a dramatic slowdown. We think in a soft landing scenario, when you have economic growth okay, that small caps are not going to do better than large caps. They just haven't gotten quite cheap enough, and you don't see that reacceleration that you really need in order for small caps to outperform.
All right, Ellen Hazen there, of course, with a dose of reality for the small cap trade there. Let's get specific here. Let's name some names and talk about some of your individual stocks. I see Booking Holdings on your list, for example, which I find interesting because so much of our conversations are centered around that slowing consumer, of course, that cost-conscious consumer, and yet here we are.
So we like Booking for a couple reasons. Number one, it's a pretty reasonable valuation for the growth that you're getting. And number two, regardless of the shorter term consumer slowdown, which I agree is happening, it's clear from the data that that's happening, you have this long-term secular trend toward experiences from goods and toward online from using travel agents. And so I think that Booking taps into both of those very well. You see estimates continuing to go up, and the company is very well positioned. I think that longer term, this is a winner. Shorter term, could you have softness because of a softening consumer? Yes, you could, but only if you're trying to trade day to day, week to week. I don't think that that's going to be a longer term problem.
Ellen, I also want to talk about D.R. Horton because this is another play that is very firmly tied to the interest rate outlook here. And is 50 basis points, even if they get there next week, is that enough to set off the housing market significantly when you have such an overwhelming amount of mortgages really held still below 4%?
I think that the impetus and the catalyst for D.R. Horton is not necessarily a rate cut because, as you correctly point out, Sonali, the rate is not going to make that much difference on a 10 or 30-year fixed mortgage rate going forward if we cut by 25 or even 50 basis points. But there's a structural shortage of housing in this country, so there's this very long-term demand tailwind. In addition to that, D.R. Horton is focused on the growth areas of the country geographically in the Sun Belt region, which is where population keeps slowing. Every quarter we look at the numbers and population keeps flowing to those areas. So they have a secular demand driver from that front as well. And then finally, from a valuation perspective, you're paying a low double-digit multiple for earnings that are growing pretty strongly. So they're not levered the way many of the home builders were before the great financial crisis. They're at 0.2 or 0.3 times debt to EBITDA, so very safe balance sheet, pretty strong growth, and very reasonable valuation for what you're getting with these secular tailwinds. I don't think you should buy it with the idea that a 50 basis point cut is necessary in order for the stock to do well.
And Ellen, before we let you go, of course, you take a look at the bond market right now. Usually we don't talk about it with 20 minutes to go until the market open here, but traders currently pricing in a 40% chance of a 50 basis point rate cut next week. I want to bring that in with your positioning because right now, according to your notes, you're underweight fixed income, which stuck out to me. Of course, we are on the precipice of a Fed rate cutting cycle. How unusual is it for you to be basically underweight bonds right now at the start of such a cycle?
That's a great question. The reason we're underweight bonds is because of what else you can invest in. So if you're underweight bonds, it means you're overweight something else. And we're overweight cash and overweight equities, and we're overweight some alternatives. And despite the fact that we might be at the beginning of a rate cutting cycle, I mean, I think we are at the beginning of a rate cutting cycle, that still doesn't make bonds attractive enough to be overweight compared to what you can see in equities, compared to how much you can still make in cash. And compared to some of the opportunities available in alternatives, and particularly in some of those increasingly democratized alternative private investments that investors can access in a way that they didn't be able to used to access 5 years ago.
All right, Ellen, really great to speak with you on this Friday morning. Our thanks to FL Putnam, Chief Market Strategist Ellen Hazen. Meanwhile, let's get a check on futures right now because, again, trying to make it 5. We've seen 4 straight days of gains for the S&P 500 so far this week, following 4 straight days of losses last week. Right now, the odds are in your favor. The S&P 500 currently up about 0.2% pre-market. Of course, a lot can change between now and 4 p.m. Meanwhile, you see the NASDAQ 100 currently flat on the day. Not that enthusiasm in big tech. Of course, we've seen little hints of it over the past 4 days, not so much right now. Let's get to some specific stocks, though, because we do have some breaking news, and that is that Waymo is going to offer Austin and Atlanta rides only on Uber next year. That has been a boon for Uber shares right now. You can see currently up about 5.6% pre-market. We're going to continue to follow that story and others. And to that point, let's get a look at the stocks moving ahead of the opening bell right now. We'll do that with Abigail Doolittle.
Well, Katie, it's super interesting because we do have the shares of RH surging. They're up about 20%. This, of course, is the company formerly known as Restoration Hardware, that high-end furnishing retailer. Again, up 20% on a very good quarter. They beat estimates. Sales rose 3.6%. They also provided a positive update on the future. They're saying that the healthy demand that started in the first quarter, that just showed up in the second quarter, it's likely to extend. Now, it is worth noting that there's a roughly 13% bearish short interest, so some of this could be a squeeze, but Citi is saying it's a solid step of progress. Turning to a stock that's down but well off its pre-market lows, Flutter, right now down about 0.5%, Flutter Entertainment. This, of course, is the mobile and online gambling services company. They've announced a 56% stake in Brazil's NASDAQ. That's worth $350 million. Initially, it's expected to weigh on earnings despite bringing in more users. This may be why investors are a little bit pessimistic. And then finally, Moderna down for another day. Yesterday, falling 12% after they cut their R&D budget. They also are trimming their pipeline, having a rough time after less demand for that COVID-19 vaccine. This stock down more than 80% from its pandemic peak. Well, today, there's a slew of downgrades. Some analysts apparently think that maybe there's further downside. Oppenheimer, JP Morgan, Jefferies, Leerink, and there's more, down 5.6% in the pre-market.
Abigail, we thank you so very much for keeping an eye on all of it for us. Now, coming up, we're going to switch and talk about Boeing because factory workers go on strike for the first time since 2008. We're going to discuss the implications for the economy and the travel industry. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name. Because, you know, it's just because we're behind the scenes, but it's big. With $1 trillion of assets almost, we're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
To the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
And now to high interest, a look at what's making headlines around the world. China will raise the retirement age for the first time since 1978. The move could stem a decline in the labor force, but it risks angering workers who are already wrestling with a slowing economy. Under the rules, men will retire 3 years later at 63, while women retire 5 years later at 55. Hindenburg Research is taking another swing at the Adani Group. The short seller said in a post on X that Swiss authorities had frozen more than $310 million as part of a years-long probe into the Indian conglomerate for money laundering. The Adani Group denied what it called baseless allegations. And Roaring Kitty is meowing again. A post about Petco on the subreddit dedicated to the retail trading icon Keith Gill has helped boost the company, which has posted encouraging results earlier this week. Gill didn't actually mention the stock on his own Reddit, YouTube, or X pages, and there's no evidence that he owns a stake in the company, Katie.
All right, meme stocks, they never die. But let's switch gears here. Let's talk about Boeing, because you take a look at shares right now. The struggling plane maker now dealing with a walkout in its Seattle hub, where a union representing 33,000 workers overwhelmingly rejected a contract offer. Let's discuss now with Sid Phillip. He is Bloomberg's deputy editor for global aviation, usually based in London, joining us on set. It's great to see you.
Yeah, likewise. Thank you for having me here.
It's good that you're here because, boy, it just feels like the hits keep on coming for Boeing. We'll get into the TikTok of what exactly happened with this deal, how it fell apart, but just put this into context for how bad this is for Boeing at a very critical juncture.
It's a crucial juncture for Boeing because, I mean, at the moment they've had curtailed production of their 737 MAX jet, which is the sort of workhorse jet for them. Essentially, they haven't been able to make enough planes. They've been sort of, the FAA said that they are sort of restricted to making 38 after the whole mid-air blowout that they had in January. And so Boeing's been sort of in sort of the ringer at the moment. They've had a management change with a new CEO. They've had a new chairman. They've had sort of management reshuffle. And essentially for Boeing, they really need to get planes back out of the door because at the moment, there's no way for them to actually sort of start generating cash, which is vital. I mean, they have a $45 billion pile of debt that they need to get through.
So talk about this week alone, because the new CEO, Kelly Ortberg, seemed to have some wins in his discussion with labor. You fast forward just a couple of days, and a lot of those wins seem to have been reversed. Is this an about turn? How difficult does this make his job?
It does make his job really difficult because for Boeing, they really need, like, Ortberg's entire priority is to get their production back on track and get sort of planes out of the door so that they can sort of start generating cash and start working on their debt pile. And this is a setback towards that goal. And for the workers, I mean, the union did agree to a deal where the workers would have got 25% over 4 years, but the workers were expecting more, and essentially they've been asking for increased pensions, return to pensions, they've asked for increased healthcare, and they've asked for better pay. They've asked for 40%. So there is a sort of urgency to it, and the union and Boeing have said that they are working towards a deal, but it remains to be seen.
Yeah, 25%, certainly not nothing, but it's certainly not 40%. Still, it's striking just how overwhelmingly this was rejected. You take a look, union workers voted 96% to support a strike. I mean, talk to us about how much distance is between these two sides. What is it going to take to bring them back together, essentially?
It's going to take a deal that the workers are so on board with, and I think the workers are pretty angry at the moment in terms of what they've actually been given, and they're looking at how they can actually get what they've asked for. And the workers are in a really strong position at the moment because Boeing, because of all its various issues with production, is desperate to get a deal so that they can actually get this in. So for them, it's a really good position to be in.
Talk through the potential economic implications for Boeing here, because if the workers are on strike, obviously they're not sitting making planes and other things that Boeing needs them to do as well. Do we have a sense of how long they may strike for and what it could mean for Boeing ultimately?
So the analysts have said it could essentially, if it's 50 days, which was what happened in 2008 and previously, that would cost about 3 to 3.5 billion in terms of the impact on Boeing's cash flow. So it is a significant impact, and essentially every day that Boeing's not building the 737 and the 777 and the 767 freighter, it is a sort of that many days for that they can't actually produce planes and actually deliver those planes, which is when they actually get paid. And so for Boeing, they need to get those planes out of the door and actually start generating cash again.
Yeah, and I mean, to that point, they need to start generating cash again. How much can they actually afford when it comes to the price tag it's going to take to sort of reset labor relations onto the good path here?
I mean, that's the billion-dollar question. Essentially, what is Boeing willing to pay in order to make this problem go away and essentially get their production back on track?
ultimately, when you think about the predicament they're in now, you were talking about this idea of them needing to get those planes out the door to get paid. What do their partners do in this scenario? Are more and more of them looking for other options?
In terms of, if you're talking about customers, I mean, customers have no options because the global industry is basically a duopoly, and Airbus is sold out of its best-selling A320 jet until the end of the decade. And so there's no option for a customer to actually do anything but actually just wait for their plane. And so they haven't actually got a solution.
Do consumers then feel that problem at the end of the day?
They will, because essentially they'll be flying around in older aircraft. There'll be older aircraft that are in service for much longer, and some airlines may not have as much capacity on offer as they would have had those planes been produced.
It's just a wild state of play, of course. That duopoly you describe, it's either Boeing or it's Airbus, and increasingly that just means you're flying on older planes. Sid, great to see you in person. That, of course, is Bloomberg's Sid Phillip. Now, coming up, Uber's autonomous vehicle foothold just got a lot stronger. Details next in our Social Climbers. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The top names at Jackson Hole are on Bloomberg.
Inflation's kept coming down, so in the real rate sense, we've been tightening. I think that this reflects the reality of the economy, that we've got to keep our eye on the employment side of the mandate now. This is what the path down to 2% inflation looks like.
Nobody covers Jackson Hole like Bloomberg. Context changes everything.
Morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. Wednesday. The Fed decides.
I know we're all obsessed about what the Fed may or may not do on September 18th.
25.50, that doesn't matter so much.
We're being very measured where maybe other central banks aren't.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We have made no decisions about future meetings, and that includes the September meeting.
At this point, the Fed is leaving it open.
It's going to be up to Chairman Powell.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Uber announcing it will be the sole supplier of driverless rides with Waymo cars in Austin and Atlanta. This exclusive deal is a boost to Uber's ambitions in the autonomous vehicle arena. And you can see shares currently up almost 7% pre-market. Next up, we have Australia announcing it will fine internet platforms up to 5% of their global revenue for failing to prevent the spread of misinformation online. Now, this bill is part of a regulatory crackdown by the government, where leaders are complaining that foreign tech platforms are too powerful. And finally, we have United Airlines announcing today that it plans to offer in-flight Wi-Fi from SpaceX's Starlink for free on its jetliners. It's the biggest in-flight internet deal yet for SpaceX, and it comes as airlines have been investing in faster in-flight Wi-Fi. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Meanwhile, of course, a few minutes until markets open, you take a look at futures right now, currently up about 0.2% on the S&P 500. 500. The NASDAQ 100, Shonali, still can't find its footing, down about 0.1% right now. And interestingly, small caps currently up about 1% pre-market.
And of course, we are less than 4 minutes away to that open as traders weigh the size of the Fed's next decision. Stick with us for the open. This is Bloomberg.
What are your thoughts on fast fashion? It's been transformative. It gives the masses access to fashion, but there's a cost to it, downside to it.
My first notice is too much waste. I think it's also how I grew up, making your own clothes and making something that's well special and well unique. It's like timeless. And now you see that everybody is looking the same, like wear sweatshirts and wear t-shirts. And for me, it's just like when they wear something that's special, they feel empowered.
Is there a need for fashion to be more mindful of the impact it's having socially, environmentally?
Definitely.
Is it happening enough?
I think it's happening. It's gradually happening. All the designers are doing. Everybody is thinking about this subject at this moment, thinking how to be more sustainable, how to be more environmental friendly.
Do you think the fashion industry is doing enough, to ensure that it is sustainable? There's so many targets out there. Are they even realistic in wanting to achieve them?
I think some of them are just like they're using sustainable ideas as a marketing concept only. They're actually not really doing it. I think as a designer, it's really important to really make it happen. Every collection, I'm thinking about how to do it and how to tell the customers. I think that is our responsibility to educate our customers.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bringing you up-to-the-minute technology news whenever and wherever it happens. I'm Annabelle Drawlers in Taipei, and this is Bloomberg.
All right, we are moments away from trading, 23 seconds to be exact, on this Friday, the 13th. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You can see we have some green when it comes to futures right now. Of course, as traders really debate what would be good news from the Fed last week. Of course, would a 50 basis point cut signal that they're worried about something, or would it signal that they're serious about supporting this economy? A lot of big questions hanging over the markets, of course, as we round out what has been a very good week following a brutal start to September. You can see the bells currently ringing right now at both the NASDAQ and the NASDAQ. The New York Stock Exchange, that is. Let's take a check on the major averages right now, about 17 seconds into trading, and it's pretty much as expected. You can see the S&P 500 currently up about 0.2% right now. The NASDAQ 100 can't really decide where to go. Big tech has been bouncing back and forth between gains and losses in the pre-market, currently a touch lower, but we have one clear winner, and that is your small caps. The Russell 2000 currently up to the tune of about 1.1%. We'll see how that one develops. But let's take a look under the hood right now, because we need to talk about Boeing. Under pressure after a union representing 33,000 employees rejected a contract, forcing the first strike since 2008. And Chanel, you take a look at the reaction in shares right now, currently down about 1.4%.
red on the screen's never good, but at least it's less than it was before, right, Katie? Well, let's look at a stock that is just absolutely soaring. Restoration Hardware, soaring on demand for luxury home products here, improving 18% higher as the market opens. This is despite cutting its sales forecast for the year. And some earnings movers. Oracle moving higher after reporting a promising long-term outlook. Wall Street was impressed by a bullish 2029 revenue target here, and you have the stock up more than 7.2% at the open. But on the other hand, Adobe down 9%. Sales guidance fell short of Wall Street estimates, raising concerns about whether its bets on AI are paying off. We're going to take a closer look now with Bloomberg's Abigail Doolittle.
And let's put those moves, Shonali, into the context of the week, because of course Katie just mentioning that we're looking at a good week for stocks after a bad week last week, that rough start to September. And on today's fall, coming into today, Adobe had been set for a 4% gain, now down about 5% on that weaker than expected forecast, as you just mentioned, Shonali, having to do with less ability to monetize their AI tools. Oracle, on the other hand, now in the week, a banner week, up 22%, its best week going back to 2021. They, of course, had this investor update where they did raise their sales forecast essentially for 2026 to $66 billion. They also said that this trajectory should continue to 2029. That comes just after that strong report recently where they also announced another deal with AWS. So Oracle, one of the top software stocks on the year, up more than 50%. Let's dig into that Adobe pain, though, just a little bit more. These are the sequential growth numbers, or I should mention the year-over-year revenue numbers for Adobe. And you can see that we peaked back in fourth quarter, and now we've been moving sort of to the downside. This third quarter, an estimate here, just slightly sequentially higher, but not overall, not a lot of great growth here. And when this is interesting to me for certain, Katie, if we take a look at this chart of the S&P 500, an ETF relative to the AI ETF, I would have thought, based on NVIDIA and Supermicrocomputer and some of these other AI chip companies, that the AI ETF would have blown the SPY out of the water, but that's not the case. The SPY up about 17%, the AI ETF right below. So maybe some of that Adobe weakness is factoring into this ETF.
Yeah, it's fascinating, too, to see when those lines broke apart. Of course, it seems like it was right around when we were sorting through all those big tech earnings, so clearly a sign of the times there. Abigail Doolittle, thank you so much. Let's broaden out this conversation now with Brooke May. She is managing partner of Evans May Wealth. She has an S&P 500 year-end price target of 5,600 to 5,800. And Brooke, we're right about at the lower end of that range. I want to talk about the Fed next week, though, and of course how that factors in, because I'll ask you the question that I've been asking everyone, and that's whether or not 50 basis points, whether that a cut of that magnitude next week, would that be good news at this juncture? What does sentiment look like?
I do think it would be good news. That said, I was surprised to hear Dudley come out and say that he felt a 50 basis point cut would be warranted. When we look at the totality of the data, it doesn't necessarily feel like we're in a dire situation where we need to expedite rate cuts. When you look at historically rate cutting cycles, the playbook isn't relevant. Typically we're cutting because we need to stimulate the economy, or there's an energy crisis, or there's a bubble that's burst. And so they have the ability to be cautious. They've been cautious all along. And Jerome Powell hasn't done anything to indicate that they're going to change their posture. So a 50 basis point cut would be welcome. However, it would surprise me.
Well, let's talk about why it would be welcome. I mean, is that because you think about sort of the effect of these higher interest rates, the fact that we're clearly in restrictive territory, or would it be good news basically because it signals that this is going to be a more aggressive Fed, that they're going to mightily bring down interest rates, which will ultimately...
I think that it's that, we're just ready. We're ready to get back to neutral. And it doesn't need to be aggressive, but we need to show that we need to demonstrate that we're moving in that direction because it is restrictive. When you look at small cap companies, for example, today they're rallying and, they've been under pressure. They've been under a significant amount of pressure. When you look at small cap in general, only about 60% of those companies are profitable and they rely heavily on debt. And not all small cap companies are able to lock in fixed rate debt. So they're subject to variable rate debt, which is very expensive. And clearly that cuts into their profits. So as we see rates come down, that's going to bleed through to small cap earnings. Now, it might take a few quarters to actually see the impact, But in anticipation of that, we're going to see small cap rally. So there are going to be clear beneficiaries across the board of the economy with lower rates.
I guess how much does the Fed really have to cut to see that benefit seep through, especially kind of those more heavily levered companies? We say small caps, but it's not limited to small caps, is it? And is 50 basis points, if we get there next week, even enough?
Yeah, the Fed has a dual mandate: price stability and maximum employment. And we have seen unemployment tick up. However, this last reading, it actually ticked down. We went from 4.3% to 4.2% unemployment. So it's not a rapidly deteriorating labor market. When we look back, we had 2 years of sub 3.9% unemployment, which is just incredible. From February of 22 to January of 24, every read was under 3.9%. So now that we're at 4.2%, we're clearly moving in the wrong direction, but it's not unraveling quickly. What's held up the economy the last few years is the labor market, and we don't see that changing. When you look at the CEO surveys that have come out recently, CEOs are indicating that they expect hiring to be stable over the next year, that they see wage growth in excess of 3% over the next year. And a year ago, CEOs were predicting an 84% probability of a recession in the next 12 months. Now that number's 30%. All that indicates that the labor market should be sustainable, assuming the Fed starts on this path to neutral.
It's interesting.
So I don't think it needs to be aggressive.
It's interesting to hear you talk about CEO confidence there, Brooke, because I wanted to shift us over to consumer confidence at the top of the hour. In just over 20 minutes time, we get University of Michigan sentiment data, which has been increasingly important to those viewing the market and the consumer sector in particular. What role does the consumer play, and how much of a boost they get into this rate cutting cycle?
The consumer's huge. The consumer plays a significant role in this economy, and it boils down to, though, if consumers have jobs, they spend, and that's what keeps the economy afloat. Right now, we're seeing wage growth in excess of inflation, and so the sentiment out there is decent. It's not as robust as it's been in previous readings, but we don't see it completely deteriorating because people are working. There are headlines of inflation, or headlines of layoffs. However, there's not broad layoffs across the economy. It's small pockets here and there that are catching headlines, but not necessarily detrimental.
And Brooke, quickly, before we let you go, I want to get back to the horse race of these year-end price targets, because the top end of 5,800 places you among the biggest bulls on the sell side right now. We're at the lower end right now on the S&P 500, about 5,600. How confident are you that maybe the S&P 500 can add those additional 200 points by year end?
Well, we're setting the expectation with our clients for the next 2 months. Fully expect volatility. September, October tend to be poor performing months in the market. On average, over the last 25 years, September, the market's been down about 1.7% on average. So we're setting the expectation near term, there's going to be volatility, but we're going to use that volatility as buying opportunities, because when you look at the earnings growth projections going into 2025, they're good. We think big tech earnings growth will be around 18%, and we think the broad market will have earnings growth around 13%. That's more robust than what we saw going into this year. So we think that it's earnings that takes us higher, but it might take us 45, 60 days to start to move in that trajectory to get closer to that 5,800 price target.
Brooke, happy Friday to you. That is Brooke May, Evans May, Wealth Managing Partner. We thank you for your time. Now, I want to bring you some breaking news, because the Los Angeles Chargers and the Miami Dolphins are among NFL teams mulling private equity deals. Remember, the NFL opened up to the idea of private equity investment, with team owners voting just about a couple weeks ago, really last month. They still need final approvals, but Bloomberg is now reporting that the Chargers is in advanced talks with 2 buyout firms already to offload a stake. And of course, the Dolphins also in talks with those private equity firms alongside potential individual buyers. These are 2 major markets. And of course, the deal making is on. Now, coming up, sticker shock in the grocery aisles. We're going to explore that with Tony Sarsam, the CEO of Spartan Nash, a national food distribution and grocery retail chain. We'll get under the hood of what pricing looks like across the food aisle. This is Bloomberg.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Grocery prices aren't climbing as much as they had been in the last 2 years. And in fact, online grocery prices fell 3.7% last month, according to Adobe, the largest decline since the firm began tracking the numbers 10 years ago. Still, of course, many Americans are still frustrated by what it costs to put food on the table. Joining us now to talk about price of food is Tony Sarsam. He is the CEO of Spartan Nash, a food distributor and grocery retailer. Let's talk about the good, the bad, and the ugly here. Of course, inflation, particularly at the grocery store, is a hot button issue for Americans all over the country. Where are you things seeing meaningfully get better?
Great. Well, thank you again, and thanks for having me back. I appreciate being here. Let me get a little backdrop on Spartan Nash before we get started to set the table a little bit. We are a food solutions company. We are in the wholesale business and the retail business. So we provide groceries and consulting services to about 2,300 grocery stores, including the ones that we operate ourselves. We are a proud provider of groceries to the U.S. military system worldwide, and so that gives our men and women in uniform a little taste of home wherever they may be stationed. And we have 17,000 associates that help us deliver the ingredients for a better life every single day. So that perspective of both the wholesale side and the retail side gives us some great insights as we see what's coming up and what's going on in the near future. So hot topic, obviously, around pricing. One of the interesting things is there's an idea that food prices have driven a lot of the inflation in the last couple of years, and it's not really supported very well by the actual facts. You guys saw the CPI data here recently. Inflation is moderated down to 2.5%, and food prices are down to 0.9, and they've actually trailed overall inflation for most of the last 2 years. But people are still very concerned. They're very concerned about trying to make the ends meet overall, and they focus on grocery bills. As a matter of fact, about 79% of the folks that we've talked to in our own internal surveys say that pricing of groceries is the most important thing for them, and we take that very seriously. And so we think about how we construct the overall offering to our shoppers. We want to make sure they have access to value and actually the other things that they want that are most important to them.
Well, appreciate that context. And it's a good point. You think about the most recent CPI reading. It was shelter costs that drove a lot of that inflation. So there's a new, of course, boogeyman out there. But I want to talk about categories, because you look at overall food costs and they barely rose last month. But then you take a look at an index for meats, poultry, fish, eggs. It rose 0.8% in August. So how much dispersion are you seeing when it comes to different categories of food?
There is dispersion always, and the ones you just mentioned are interesting because they're close to agriculture commodities, and so you see these effects of things like macro effects like weather, like a bird flu, which is actually causing the egg prices to go up right now. You see things like the overall tough weather that was in West Africa driving up cocoa prices pretty dramatically. So staples in my cabinet pantry at home like Nutella and Cocoa Puffs and those kinds of things, those are all experiencing some cost increases because of those effects. But those items like the meat and eggs and cocoa, those prices will go up and they'll come down when the event that caused them stabilize and more episodic. And there are some other more longer-term effects in the grocery categories as well, grocery aisle as well. Those long-term, when you think about overall, Americans spend about 11% of their income on food. It's about the same numbers it was 10 years ago, but prices have gone up over that time frame, and there's some lurking price increases that are sort of interesting and think about how these things get caused. Things like, in the last few years, we're paying about 50% more for tractors and trailers, the big rig trucks that get the products from the fields or from our DCs into our stores. The freezer cases in our storage are about 35%.
You know, it's interesting to see where there's still that lingering inflation. I want to pull up a chart here just of cocoa prices, for example, because to the point that you're making, they go up, they go down, and they have come down from their peak, but they are still meaningfully higher than where we were a year ago. It's hard to see how, you know, cocoa's, people like chocolate, cocoa's a staple, right? Is that fair to say? When you see prices at this kind of elevated level here, what is that ripple effect? Who has this crowded out?
Yeah, so the cocoa being a staple is absolutely the right thing to say. It's a critically important item in everyone's diet. So that agriculture community, particularly the one where most of it comes from West Africa, is not fully recovered yet. So that's where you see the continued higher prices there, as they are kind of recovering from a lot of issues driven by the early weather events, but some other events around farming there. So I think it's going to be a while before we get all the way out of that one.
Right, and it's a good reminder, like you said, I mean, there's so many factors you can't control when it comes to bird flu, extreme weather, et cetera. But we're talking about food prices, and food prices, of course, have become a political issue as well. You think about the conversation happening right now around price gouging at the grocery store. Have you seen any evidence of that? I have seen no evidence of that. And as a matter of fact, you think about this industry broadly, we are about a 1.6% profit collectively. So that's the most recent data about the overall profitability in our industry. So it's very, very competitive, very low margins. And so we are always, all of us and our competitors are fighting to get shoppers dollars and offer them something that makes our stores attractive to come in and spend their hard-earned dollars. I mentioned a moment ago that 79% of them are looking for good deals. So that doesn't really match up so much with taking extraordinary prices, because you're going to be less competitive in that space. So I think that element is actually a self-governing of it. Just such a competitive industry that you're going to always have people fighting for the shoppers' scarce dollars, and so it kind of regulates that overall pricing effects. But there are people who feel those effects that I mentioned a moment ago. There are prices that are passed on to customers because things like the tractors and the freezer cases and even the bags that are up 30% over the last couple of years. And there's one lurking variable I think that's sort of interesting, and that's swipe fees for credit cards. So that's also part of the overall cost, but it's late in the value chain, obviously. It was right at the end. And those fees for us, we've seen a 34% increase in the overall cost in our stores. And those, while the fee maybe seems small, it's between 2 and 4% typically, those industries are not quite as competitive
competitive. There's two companies that control 80% share. There's 21,000 independent grocers who compete with each other for that 1.6%. The two credit card companies have a little over 50% margin. So the interesting stat here is that if you bought $60 of groceries in the store, the store would get about $1 of profit, and the swipe on that would get $1 of profit for the credit company as well. So we're looking at ways we can better regulate that. There's some legislation right now in Congress that may address that. That's a way the government can actually help out.
Tony, we have to leave it there. Hope to have you back soon. It's great to see you in person.
Wonderful to be here.
That, of course, is Tony Sarsam. He is the CEO of Spartan Nash. Now, coming up, meet the dirtbag of the internet, who happens to be behind the crypto project promoted by Donald Trump. That's next in our Wall Street Beat. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
And it's time now for the Wall Street Beat. In the last year, Donald Trump has fashioned himself into a friend of the crypto crowd. He and his two older sons have been particularly good friends to World Liberty Financial, a crypto project that they've been promoting on social media. To tell us more behind the man behind that project is Bloomberg's Zeke Fox. And it's fascinating because this is somebody, Zeke, that wasn't very well known to the rest of the crypto industry, was he?
Yeah, I mean, his name's Chase Hero, and he was a weed dealer. He sold weight loss colon cleanses, $149 a month, get rich quick class. And now he's the guy behind World Liberty Financial, which is a new crypto venture that the Trumps are promoting like just ahead of the election.
Yeah, it's wild. I mean, former President Donald Trump himself has teased in a video that he'd announced details on September 16th. It's September 13th right now, Friday the 13th. What are we expecting to hear? I mean, how intense is this involvement?
Yeah, so I'm told that Hero is the kind of main deal maker behind this. He met the Trumps through a real estate developer who's a longtime friend of Trump. And you said dirtbag of the internet. That's what this guy called himself on a video. I can't even read you most of the other quotes, but he's got like a very cynical attitude towards crypto, and nobody in the crypto industry that I talk to has heard of him. There's a lot of skepticism about this World Liberty Project, even among crypto people who maybe aren't known for having the highest standards for how well thought out projects need to be.
You can certainly go to the story and read it. It is one of the most read ones on the Bloomberg terminal on Bloomberg.com. Some of those expletives are certainly in there. Zeke, why is this the project that Trump is touting when so few people in the crypto industry are really familiar with it?
I mean, that's the question that a lot of people in crypto are asking. Trump used to criticize crypto. He called Bitcoin a scam. Then he went and spoke at the Bitcoin conference. He said he's going to make the U.S. the crypto capital of the world if he wins. But a lot of people in crypto are like, we like that, but why are you now starting your own for-profit crypto venture?
Right.
Like, why not? What does it have to do with crypto policy?
Yeah, a lot of big questions there, of course. It'll be interesting to see, of course, what Donald Trump unveils on September 16th. That is Bloomberg's Zeke Fox. Great reporting, as always. Of course, Zeke is author of the great book, Number Go Up. It's all about crypto. I suggest you go read it. Coming up in our next hour, though, we'll speak to Jay Hatfield and Jason Furman on the economy and next week's Fed meeting. Plus, we'll speak to the CEO of Pirelli about the tire manufacturer's new partnership with Bosch. All that and more coming up. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Into the U.S. trading day. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Shonali Bassick. Matt Miller is off today.
Meanwhile, we take a look at markets, of course, as we're awaiting that University of Michigan Consumer Sentiment Data report. You take a look, and we have a rally on our hands. The S&P 500 currently up about 0.4%. The NASDAQ 100 up 0.3%. You take a look at the numbers coming out right now. Michigan preliminary September consumer sentiment rising to 69. That is a beat there. there. The estimate had been for 68.5. Of course, you take a look at one-year inflation expectations as well, falling to 2.7%. That is the lowest since December 2020. So certainly some good news there. Let's get more context now with Mike McKee. He is Bloomberg's Chief International Economics and Policy Correspondent. What's your first take?
Well, it doesn't move the needle really for the Fed. But it does give them permission, if they want to go 50, to be more dovish in the sense that it doesn't look like inflation's a problem. At least inflation expectations are a problem in the short run, 2.7%. They go up in the 5 to 10 year, they go up to 3.1 from 3.0, but that's way out there at this point. And the Fed isn't going to think that is any kind of realistic change that they have to worry about. Current conditions rise to 62.9 from 61.3. Which is a fairly good increase, and expectations up to 73 from 72.1. So this is probably the best Michigan numbers we've seen in a little bit of time. It's too early probably to know whether the debate had any impact on that, because it was just before the end of the survey. It would only had a couple days to pick that up. But people do seem a bit happier about the overall economy, which gives the Fed the idea also that maybe they don't need to move because, the economy's in good shape.
2-year yields are lower on the back of this report as well, and I still am a little bit confused here, because if the consumer believes that inflation is going to be around 2.7%, they're feeling pretty good, in fact better than expected, why cut 50 basis points?
Well, that's the question. The Fed has to decide that they think the economy is in worse shape and needs a quick jolt to do anything, to maintain. The problem is at this point, it's not going to matter a whole lot because it takes a while to get into the economy, so it's not going to have an effect on the election or the way people think in the short run about the economy. So the Fed has to look out and try to figure out what's the economy going to be like in the early part of next year, when this might start getting into the overall economy. And that's kind of the question. And as you know, there are a lot of different views on Wall Street about that.
They feel good today. They might not feel as good tomorrow. Michael McKee, we thank you so very much for your reading. And in a few minutes, remember, Mike will have a question and answer session with Joanne Shu, University of Michigan Surveys Consumer Director. You can follow that conversation on Live Go on your Bloomberg terminals. Now let's get more market insight now with Jay Hatfield, the founder and CEO of Infrastructure Capital Management. A lot to talk to you about, Jay, about the market itself and where people are headed in terms of maybe some of these more defensive trades. But let's get back to kind of the key issue of the day, 25 or 50. Do you think that the Fed needs to go 50?
We don't think they need to. We might have about a month ago. The key indicator of a recession is the housing sector. It's hyper-cyclical. Investors spend way too much time worrying about consumers. Consumers have never facilitated a recession. Only investment does. And so 11 out of 12, you had a crash in the housing sector. We are getting nervous about the housing sector, but really the market cut rates for the Fed. The key financial indicator, there's not 100. It's really just 10-year and mortgage rates. So when mortgage rates went below 7, all of the home builders said that traffic picked up. And you saw, even in the last report, 750,000 new homes. So normally that would, if you have a limited home building, you have layoffs, then the consumer goes down. So we're confident the Fed doesn't need to, plus they're very cautious, and they're also concerned about their forecasting ability. So they're likely to do a dovish cut, and that's fine, because then the 10-year will stay down.
That's really interesting, the perspective that, okay, actually the market has helped the Fed out here. Of course, the market has been fighting the Fed for so long, it feels like, but now kind of working in tandem here. But just to push back on that a little bit, you think about the case for 50, which has been advanced by none other than Bill Dudley this morning, of course, speaking in Singapore, saying that right now the risks to the labor market are greater than the risks that there are to a reignition of inflation here. It sounds like you don't put much water in that argument.
Well, I agree with that argument, but you have to assess this Fed. Like Greenspan doesn't run this Fed anymore. Greenspan just made up. He would cut rates, after if the futures are weak over the weekend, he would cut rates. So this is a very bureaucratic Fed. Powell is not an economist, so he just gathers consensus. So I'm sure there will be people arguing for a 50 basis point cut. Now, having said that, we're short the Fed funds futures and losing money. So obviously some people today, not a lot of money because it's a small bet, but a lot of people are responding to some of the journal stories. They do leak it through the journal, unfortunately. They should leak it through Bloomberg. But,
we agree.
Yeah, but so when they write a story on the front page and people think it's clearly on the table, but I don't think it'll happen.
Yeah, of course, a signal coming out from Nick Timiraos in the last couple days. But you make the point about a bureaucratic Fed, sort of the complexion of this Federal Reserve under Jerome Powell. How do you invest around a bureaucratic Fed?
Well, they're actually really easy to predict. So that they tend to be behind the curve. It's almost like that's their third mandate, is to be behind the curve. So that's why I think it's pretty easy to say they're not going to do the 50. They're going to talk about it, but not do it. And then you have to be very, very focused on the housing sector. We've had the right call for 4 years, which is we weren't going to have a recession, but then got nervous about it. So it's been pretty easy to predict. Like we said they would cut in July when everybody else is saying they're cut right away. Models don't really work. And so they should have cut in July. That's when the data made it obvious. So it's actually very easy because they are bureaucrats.
Let's talk about the rest of the way through this year, because it's interesting. I understand you still have that price target of 6,000 on the S&P 500. As Katie's been pointing out, we've had a good week. It's Friday the 13th. You are not seeing the jitters really in the market today. Not yet. The day is young. But you have also said to us that this has a lot of uncertainty around who takes office in November. It's a lot around the presidential election and tax rates here. What's the delta?
Well, I think people tend to overestimate the importance of the presidency and the impact on the economy. Really, all that matters is tax policy. And tax policy only changes when there's a sweep. So if there were a Democratic sweep, we do see our target going from 6,000 to 5,400.
Wow.
Just
what
because,
are the chances of that, really?
Well, I'll tell you, if you take the betting markets and do cumulative probabilities, it's 8%. So in other words, you take the probability of Kamala winning, taking the House, which is 68%, taking the Senate, which is only 25, and you get 8. It's 12 for a Republican sweep. So the most likely case is gridlock, which is bullish for the markets. Usually there's less spending, less change. Change is disruptive.
Right.
Even tariffs are disruptive. Increases in corporate tax rates are terrible for not just earnings, but international competitiveness. So we're still really bullish and we believe in our 6,000 target, but we just want to note, usually people ask me what the risks are, and I'm like, well, there are no risks, which is that's why I'm not a popular guest. Well, but now there is a real risk, which is a sweep or upside, if the Republicans sweep, but if they also cut corporate taxes.
Well, that's where I wanted to go, and I'll just add, you're popular on this program, so rest easy.
Flattery gets you everywhere.
If there's a Democratic sweep, I mean, it's really shocking to hear how much your price target would be effective. If there's a Republican sweep, can you game plan that same analysis? What does 6,000 go to?
It would be about 6,700. And the thing that most people don't appreciate, it's not just the earnings impact. I mean, that's the most obvious, but also the growth impact. Because companies grow because of their retained earnings after tax. So if you tax them more, then you're going to have less growth and a less multiple. We're forecasting at 25%, which is what we're hearing out of Congress, by the way, as a compromise, not 28, because we do make small donations to even Democrats. So, but at 25, you just have a direct reduction in earnings. It's not like a political thing. Just they go down and then the stock prices go down.
You know, Jay, an investor yesterday made a great point to me about what the bond market is saying. And if you look at the number of rate cuts priced in, you have more than 100. I believe this morning you still have 117 basis points worth of rate cuts priced in. The investor had told me that don't think about this in terms of how investors think rates are going to be cut. Think about this in terms of a risk premium being priced into the market about what the government needs to pay you to own bonds. That perhaps there's a certain percentage here, maybe 25% chance here, that you could have a worse outcome in terms of a recession than currently being priced in. And you need to pay more because of where the fiscal situation is. How much of the bond market pricing right now is just an element of probability here? This idea that you need to price in that risk.
Well, I think the key point there is that everybody just looks at the U.S., or not everybody, but most U.S. investors look at the U.S. because you can get away with it because we kind of dominate the world. But I would recommend the Bloomberg screen of the day is WB. So that's the world bond market. So you can see that premium for U.S. fiscal irresponsibility on how much more we pay than other countries. So Canada, which is not very far away, pays 70 basis points less than the U.S. because they're more fiscally responsible. So I think that's where you see the risk premium, is that the U.S. pays more than they really should because we run huge deficits that cause our rates to be above global rates.
All right, appreciate the Bloomberg Terminal shout out.
Right.
Usually it's Matt Miller who's calling out esoteric functions. So, Jay, this was great. Have to have you back on around the election. Really great insights. That, of course, is Jay Hatfield of Infrastructure Capital Management. Meanwhile, let's take a look under the hood. What's moving underneath these indexes right now? Here's Abigail Doolittle.
Well, one stock that's helping to drive the S&P 500's gain. Take a look at the shares of Uber. Actually, two stocks, Uber and Alphabet. Uber has announced today that they're expanding their partnership with Alphabet's Waymo autonomous vehicle unit. This is an exclusive deal to offer driverless rides in both Atlanta and Austin using those Waymo vehicles, driverless vehicles. And you can see Alphabet is higher as well, but Uber really getting a nice pop, up nearly 6%. Turning to United Airlines, these shares are higher as well. This is the company is announcing that they are going to be offering free Wi-Fi using SpaceX's Starlink. This is win as well for SpaceX, of course, a private company, but this is the first major carrier to use Starlink, and investors seem to appreciate this news, up 1.7%. And then finally, we do, of course, have some laggards as well, one of them being Adobe. These shares are down dramatically, down about 9%, the worst day since March, after the creative software company essentially said that the outlook's not quite as good, as strong as had been expected. Some of their AI tools, the demand is weaker than anticipated.
Abigail, thank you so very much. Now coming up, the CEO of tire manufacturer Pirelli joins us next in the C-suite. We are going to make this a story about racing and the best tires to use for it. This is Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Well, I said I'm just taking some leave.
Oh, leave?
Yeah. I think I'm still technically on leave. Harvard has kind of a funny relationship.
How long can you be on leave? For 10 years or so?
Well, I guess we're going to find out, yeah.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Wednesday, the Fed decides.
I know we're all obsessed about what the Fed may or may not do on September 18th.
25.50, that doesn't matter so much.
We're being very measured where maybe other central banks aren't.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We have made no decisions about future meetings, and that includes the September meeting.
At this point, the Fed is leaving it open.
It's going to be up to Chairman Powell.
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
And now to high interest, a look at what's making headlines around the world. Donald Trump's allies want to have a second bite at trying to privatize Fannie Mae and Freddie Mac. Talks among former Trump administration figures and bankers have been underway since at least this past spring, according to reporting by the Wall Street Journal. And if allowed, the government could raise over $100 billion in a sale of securities in one swoop. That would be the biggest stock and bond offering in history. And hedge fund Millennium Management is looking to raise between $7 and $10 billion of new capital. It will do so by asking clients to make pledges that Millennium can tap over time. Like its peers, the hedge fund has been moving to lock up client cash for longer. And Pink Floyd is in talks with Sony over a music rights sale. Talks are advancing after personal differences between David Gilmour and Roger Waters made reaching an agreement difficult. The band's iconic catalog, including Money and Dark Side of the Moon, is valued at about $500 million, Katie.
All right, switching gears here. Earlier this week, Pirelli and Bosch signed an agreement aimed at jointly creating new software-based solutions and driving functions. The vision is to give drivers greater control, comfort, sustainability, and improved driving dynamics. Let's get into the details now. I'm pleased to say Pirelli CEO Andrea Castellucci joins us now, and it's great to have you with us. When you think of Pirelli tires, you think about Formula One, of course, and maybe this is unfair, but when I think of Bosch, I think of course, high-end household appliances such as dishwashers. So maybe you could give us a little bit more detail on this marriage and how this works.
Yeah, thank you so much. So today, tires are very important parts of a vehicle, but responsible to transfer forces from the vehicle into the road. But tomorrow, what we want to do together with Bosch, thanks to this new joint development agreement, is to make tires able to talk with the car, collecting data thanks to the sensors that we are applying to tires, elaborating this data into useful information thanks to the algorithms we have developed, and then use this information to dialogue with the vehicle dynamic and improving the safety and the driving experience of our customers.
Andrea, it's interesting. Your tires are, of course, considered more high-end. They're used in very high-end racing cars. You think about F1 and the technology needed for the drivers to really communicate with their tires, for example. When you do things like this, as you've done with Bosch, how much more available does the technology become to a wider audience here?
Yeah. The target of this relationship and the development of this technology is to reach the wider market of at least the premium segment. As always, when we introduce new technology, we start from the motorsport and the prestige segment, as we did, for example, with this new technology, starting working with the hypercars of Pagani. And then once we consolidate the technology, thanks to these incredible open-air laboratories that are the motorsport or the prestige segment, then we try to move the technology into a larger scale and the wider premium segment. The target we have is to reach the wider market in the coming 2 years, because the technology we are working on with Bosch is already at a high level of maturity.
Well, excited to see, of course, this partnership bear fruit. I'd also love to get your perspective on the broader industry right now. Of course, Pirelli recently reported earnings, and you kept in place your targets for 2024. You beat on certain measures, but you also said that the market is expected to be flat year on year compared to around 1% growth forecast in May. So a downgrade of overall growth expectations for the broader industry. How do you plan to navigate through that? How are you going to stick to those financial targets that you laid out?
Yeah. Look, you're right. The market in the automotive, as far as car registration is concerned, is expected to slow down in the coming months, mainly due to a reduction on car registration in Europe, but also in North America and China, we see some slowdown in the demand. Nevertheless, inside this slowing down scenario, the high-value markets, which is the core of our business model and our strategy, is still keep on growing around 6%. So despite the slowdown of the wider automotive market, the high value is maintaining its speed of growth. 77% of our sales are concentrated in the high value, being Pirelli the global leader in prestige and premium segment as far as tire is concerned. And so we maintain the pace of growth of the high value. And thanks to the strategy we have and the target of growth we have mainly in North America, we confirm our target within end of the year, as we presented in our last analyst call.
I also want to talk a little bit about China. There's been a lot of concerns about Chinese demand in basically every market, most notably this week in the oil market. You've seen that plunge in oil prices. What about when it comes to tires? Because tire volume was down in July. How do you see the Chinese situation developing?
Yeah. Well, let me divide the China tire market in between the replacement market and the original equipment. Original equipment in the first half of the year was extremely positive, leveraging on the fast growth of the electric vehicles. Because as you most probably know, the Chinese market was able to increase the penetration of EV, and today that represents half of the car registration. And so the growth was positive. It's true that we have in front of us most probably some months of slowdown, also because of a less favorable comparison versus last year. But all in all, the trend of the car registration remains positive in China. While if we move into the replacement market, yes, in the last 2 months, we are facing a negative market, a negative 3-4%. And the expectation for the second half of the year is not to recover. And so there is a slowdown of the general consumption in the replacement channel. But again, the high-value market inside this environment is maintaining its growth and remains on around single-digit, mid-single-digit growth. That's the expectation we have.
Andrea, we thank you so very much for your time. Of course, that is Andrea Casalucci, Pirelli's CEO. And still ahead, the cat's meow is no longer Clorox kitty litter. We're going to have the scoop in the social climbers next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The names that move markets are on Bloomberg.
Don't expect we're going back to zero, because zero was the product of huge global shocks. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it'll be lower than where we are today, but I think it's very clear that we're not going back to zero.
Bloomberg. Context changes everything.
Morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Bringing you up-to-the-minute technology news whenever and wherever it happens. I'm Annabelle Drawlers in Taipei, and this is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Uber announcing it will be the sole supplier of driverless rides with Waymo cars in Austin and Atlanta. This exclusive deal is a boost to Uber's ambitions in the autonomous vehicle arena. Next up, the online betting company Flutter announcing it will buy a 56% stake in the Brazilian gaming company NASDAQ Group. This move allows Flutter to expand into the soon-to-be regulated market in Brazil. And finally, finicky felines are roiling the bottom line for Clorox. A hack last year halted production at U.S. factories and led to shortages of its popular line of Fresh Step litters. But now that supplies are back online, cats have moved on. Clorox, for its part, is embarking on a campaign to persuade pet owners to switch back. But in my experience, you can't really persuade a cat to do anything. So it'll be interesting to see how that one goes. Meanwhile, let's take a look at the markets right now because we're about an hour into the U.S. trading day. You take a look at the S&P 500. We do have a rally on our hands. If this holds, this would be a fifth straight day of gains. Currently up about 0.4%. But as we know, there's a lot of volatility in this market, and that is especially true for your big tech benchmark. Of course, the NASDAQ 100 rather up 0.4%. The S&P 500 currently up about 0.6%. Shanali.
You know, it's funny, Katie. I do think that cats over humans is the way to go. Clorox and General Mills here all focusing on pet lines and, of course, trying to win those customers back. Pretty fascinating story. Now, coming up, we're going to talk to Harvard economist Jason Furman, who says the case for a 50 basis point cut next week is not there. Stick with us for that conversation. This is Bloomberg.
How can you have dinner with friends without hinting what you're thinking about? And do you ever get suggestions from your friends at dinner, this is what you should do? And how do you respond when they kind of say, maybe you should lower interest rates? You just keep eating or what?
You might define the word friend to mean doesn't ask you about interest rates. So, no, people don't do that generally. You know, people I don't know will always say, hey, cut rates. Somebody said that in the elevator this morning.
Did that influence you or no?
I said, thank you, sir. You know, and no, but I mean, you know, people say things, but you know, it's fine.
So in some parts of the society these days, people are making decisions based on something called artificial intelligence, AI. Have you thought about, you know, calling up ChatGPT and saying, you know, here's all the data we have. What do you think about would be a good idea? Have you ever thought about that, or they're not going to like you to do that?
We haven't done that. I mean, we have done little things like we've asked ChatGPT to generate questions for the press conference. And I'm happy to report for any journalists who are here that the questions were not as good as the ones we get from real journalists. So,
what about my questions? How do they compare to my questions? Okay.
No comment.
Right, so they weren't that great. Okay.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Americans spend about 11% of their income on food. It's about the same numbers it was 10 years ago, but prices have gone up over that time frame, and there's some lurking price increases that are sort of interesting and think about how these things get caused. Well, things like in the last few years, we're paying about 50% more for tractors and trailers, the big rig trucks that get the products from the fields or from our DCs into our stores. The freezer cases in our stores are about 35%.
That was Tony Sarsam, the CEO of grocery retailer Spartan Nash, speaking to us in the last hour on food inflation. And now, on the heels of inflation, all eyes are going to turn to next week's Fed meeting. And economists are split on how the Fed will communicate policy action. Certainly, traders are. Here to weigh in is Jason Furman, Harvard economics professor and former chairman of the Council of Economic Advisors during the Obama administration. And I want to pull up kind of the dispersion in views here. Bill Dudley, of course, overnight saying there's a strong case for 50. We know that you believe otherwise. So why do you disagree? Is that fair to say?
Look, first of all, the most important thing is the Fed should clearly cut rates. Inflation is down, unemployment is up, rates should not be where they were a year ago. Second, the Fed should communicate that it is starting a process of rate cuts and it expects to do more of them at future meetings. The reason I think it's better to start with 25 is that they chose not to cut rates in July. The data since then has moved in multiple directions. Yes, the unemployment rate is up, but consumer spending is really strong. GDP came in really strong. And now you have the CPI a little bit above expectations. So they set out a reaction function. They said they were going to cut rates twice this year, back in June, basically, in their forecasts. You know, I don't think going all the way to something like 4 cuts this year, based on the data we've seen, is the right way to update their reaction function given the data.
Well, Jason, building on that, I'm curious what you make of the Fed's communication thus far, because there was a speech from Chris Waller last week, of course, which caught a lot of attention because he talked about the concept of front-loading cuts in the same way that they front-loaded hikes. Maybe they'll be more aggressive at the start when it comes to the cutting cycle. He did say if appropriate. There was equal emphasis placed on that. But why even open that door then and sort of invite the possibility of a jumbo cut?
Yeah, no, it's amazing. I mean, we have the Fed meeting coming up, and the markets are basically 50-50 as to which of these two ways we're going to go. Now, part of that isn't quite as dramatic a difference as it sounds, because if you say, hey, we're doing more now so we can do less later, that's not massively different than we're getting started now and we're going to do more later. It's the cumulative amount that matters and the signal that they send. But yeah, this is a unusually high amount of suspense for a Fed meeting.
What would 50 basis points say if they cut that much in the first meeting? It's interesting to think about this idea of tone setting, because can't they just, if they did that 50 basis points, can't they just sit there in the conference and then say, don't expect this over and over again? I mean, don't they have tools at this point to kind of set better expectations in the market? Why leave everybody waiting so badly?
Look, there's another way to conduct monetary policy, a totally different paradigm where at every point in time you just have rates where they should be, and then at the next meeting you're just as likely to raise them or lower them. That's just not the paradigm that this Fed has had. For some time now, it's had a gradualist approach. It's had a repeat things meeting after meeting approach. And to completely change the way people understand and forecast what the Fed is going to do in the future, I think would be quite hard right now. So they have to say, this is how we operate. We're operating this gradualist paradigm. And we didn't move in July. The data since July justifies one cut. It doesn't justify something very different than what we were planning back in July, given how really robust demand is in our economy.
And Jason, it's interesting in hearing your pushback to the idea that they should go 50. I haven't heard you bring up inflation and the fear of inflation reigniting, because usually people say something along those lines, that we're not sure that inflation is totally licked yet. I think that you talk about inflation rate now. I mean, how confident are you that it's in the rearview mirror?
Look, there are definitely risks on both sides of the mandate. There remains an inflation risk. I think underlying inflation now is probably running at about 2.5%. I think there is more downward pressure than upward pressure. given how loose labor markets are. But, there's a lot of uncertainty in that. A lot of the low inflation we've had has been falling prices in just a few goods like autos and used cars. I don't think that will continue forever. We're not getting the shelter disinflation, and we may not, that everyone was hoping to get. And, wage growth that we're seeing is consistent more with 3 to 3.5% inflation. So I can tell a lot of stories about inflation going up from 2.5% rather than down. That's not my best guess, but that's a real risk. And that's part of what the Fed is insuring against by approaching this pivot that they're now embarking on cautiously.
Jason, I understand that the Federal Reserve has to work with the reality that we live in right now, but right after this meeting and before the next meeting, you have a presidential election, don't we? And so we're sitting here in a scenario in which you have politics here that could reignite the inflationary story. You said on Twitter at the end of August that one of the policies that you actually liked being thrown out by the Biden-Harris proposals here is to tax unrealized capital gains. I want to pull up this tweet here. I also want to point out that in this set of proposals being thrown out, you haven't agreed with everything. Because you've been affiliated here with the Obama administration and a Democratic administration, I want to point out that you have not been aligned with everything that has been thrown out there. But this unrealized taxation of capital gains here has been extraordinarily controversial for this market. Can you explain why you think this is a good idea?
Yeah, so first of all, I speak my mind whenever I can. And there's a lot of tax nerds that for a long time, both Democratic and Republican inclined tax nerds that have actually liked taxing unrealized gains. There's a bunch of ways in theory it's good. In practice, it's incredibly tricky. I don't think you can do it at a very high rate. I'm really glad to see her pragmatically backing off the 40-something% capital gains rate that was in the Biden budget. I think that's good economics of her to go lower. But I was making a sort of bit of a tax nerd point. Frankly, this debate is all academic. I don't think I should be using academic as an insult. It's not something Congress is going to do. And so maybe we should keep talking about it more in seminars than elsewhere. But the bigger thing is, if she's elected, there will be a difference in terms of taxes on the rich and corporations than if Donald Trump is elected. So that's a genuine difference, but I don't think this is the form that difference will take.
Increasingly, this tax question is becoming of bigger and bigger concern to the market. To your point that you're making, it would be billionaires and corporations. You've also made the point that perhaps more even taxation across the board would be better. And so how do you think things end up at the end of the day, especially if you are kind of looking at the composition of Congress that won't allow perhaps some of these Harris policies to come through the tape if she's elected?
Look, I would be thrilled out of my mind if when the tax cuts expire next year, it became an impetus for tax reform and people could just think in a more sensible way about how to do the whole thing. For example, on the business side, making expensing permanent. That's a great incentive for business investment, tightening up some interest disallowances to help pay for that. So, on the individual side, we could broaden the base more in order to pay to keep some of the lower passed in the law that weren't paid for the first time around. So I'd be thrilled with tax reform. I'll certainly be out there trying to do what I can to advocate for it. The political system, though, may find it easier to just extend some things, not extend others, and have an argument over that fixed universe.
Right, of course. We'll have to see if tax reform is feasible, no matter who takes the White House in November. I do want to transition into a conversation on price gouging, though, of course. There's been many conversations of that. We were just talking to Tony Sarsam about that in the last hour, about whether he sees evidence of price gouging. He says no. Maybe you can help us be specific here. Price gouging is getting thrown around a lot as a phrase, but when you think about price gouging versus companies just raising prices, of course, to deal with higher input costs, what balance are you seeing there?
Yeah, so first of all, there's a question of, is price gouging an important thing that's going on right now and we could lower grocery prices by tackling it? Absolutely not. I mean, that's just a far-fetched notion. There's still quite a lot of competition in these sectors, and prices move up based on supply and demand, and you try to get in the way of that, you cause some really, really bad side effects. There is then a second question, which is in very extreme natural disasters or emergencies, are there temporary surges in prices the government should do something about? I am quite skeptical about that too. I think we can identify that. It stops the things from moving into the disaster areas. But a lot of states do that. There are some economists that support that. So I don't think that second version is completely crazy. I think it's unnecessary, though, at the federal level, and not something worth doing.
All right, Jason, have to leave it there. Fantastic to get your perspective. Have a great weekend.
The S&P 500 since November of 2023. So last week, of course, a brutal sell-off, the worst week since 2022. But those dip buyers, they are really out in force, especially as it pertains to big tech. One of the reasons that we have the S&P 500 and the NASDAQ nicely higher on the week has to do with some of the chip makers on the week, including Broadcom, Supermicro Computer, and NVIDIA. You can see these shares all nicely higher. One of the best weeks for these stocks over the last many weeks. So we're seeing a rebound in some of these AI-related chip names. And then take a look at Oracle here, up 16.1%, potentially still the best week since 2002's at the highs on the week, the best week going back to 2001. That's the degree of the buying power on a great quarter, a good outlook that was provided most recently in an investor update. That quarter, of course, earlier this week, and a new partnership announced with AWS. So the AI demand for Oracle strong. Perhaps that's what's helping these AI chip stocks climb as well. And then, of course, there's the topic that you were just debating in quite some detail. Let's put it together with a Bloomberg terminal chart, because as we do have the debate around how much will the Fed be cutting this month, you can see just yesterday it was closer to just one cut, 25 basis points. But right now we've come off of that lower level. So right now it's still closer to that 25 basis points, but it's not exactly there. So this debate sparked off by policymakers per a Wall Street Journal report debating the scale of the cut really has us between the 25 basis cut and the 50 basis cut. Right now, with the stocks up so much on the week, it seems as though investors are enjoying that debate.
Bloomberg's Abigail Doolittle, we thank you so very much. Now, coming up one step closer to the presidential election, Blair Efron of Centerview Partners tells us how Wall Street perceives the debate between Vice President Harris and former President Trump. This is Bloomberg.
The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Top names at Jackson Hole are on Bloomberg.
Inflation's kept coming down, so in the real rate sense, we've been tightening. I think that this reflects the reality of the economy, that we've got to keep our eye on the employment side of the mandate now. This is what the path down to 2% inflation looks like.
Nobody covers Jackson Hole like Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
It's time now for Wall Street Week, and Vice President Harris and former President Trump went head-to-head on their policies this week. Wall Street Week's David Weston asked Centerview Partners co-founder Blair Efron why Wall Street should support Kamala Harris.
The markets have done better under Democratic presidencies over the past 50 years than Republican presidencies. The third year of the Biden administration, which means no COVID impact, versus the third year of the Trump administration, which means no COVID impact. Higher GDP, more jobs, better market performance. The CEO, he or she wants stability, wants a free market-based economy, does not want to be sitting here with 10 and 20% tariffs across the board, which is upwards of 1% hit to GDP, 700,000 jobs. They want support from the public sector in a way that helps their business. If they know with certainty what the environment's going to look like, it helps them. And I also do think the signaling matters. When the VP talks about business, she talks about small business, which has been a big focus of hers for a long time. She talks about the entrepreneurial business, the startup community, and she talks about big business, that we're all in here together, aligned to figure out how to grow the economy for broad-based growth, again, back to the middle class. And I think most CEOs understand that.
Let's go to the other side, that is the Donald Trump. I'm not going to ask you to defend his position, but in fairness...
That would be hard.
Well, but in fairness to him, he says one of the ways he's going to address that deficit and that debt is with tariffs. And put aside the fact that that really comes from consumers and is, in fact, a form of taxation. Why is that not a way to actually retire some debt and deficit? Now, it is a tax. You know, he doesn't call it a tax, but it is on the U.S. consumer. But it is a way of retiring debt and deficit. Why is that wrong?
Because quite simply, if you have tariffs, you're hitting GDP. His 10% hits GDP, perhaps, as several economists have said, 1% hit. If he does 20, because he's been saying between 10 and 20, it's a 2% hit. At 1%, jobs, $750,000 jobs at risk. At 2%, 1.5 million jobs. That obviously has a big hampering effect on the economy. In addition, the tax to consumer is real. And if you think about 20%, he's almost at $1 trillion of tax to the consumer. That does not go, David, to defending the deficit. The deficit needs money coming into the system. That's the deficit. It's not money hurting the pocket of the consumer.
We tend to focus on the presidential candidates at this time in an election cycle. There are two houses of Congress also, whose majority will be determined. Right. What either candidate can do, can accomplish, will be determined by what happens in the Congress. How important is it that the Congress go one way or the other? Well,
you do know, obviously, the presidency has a lot of authority through executive power. But clearly, depending on how Congress goes, is always important. And right now, you can see the House going Democrat, and the Senate more up for grabs. But we will see. But I also think, as part of this, David, it's the signaling that a president gives that gives the markets, that gives business a confidence, okay? And the signaling about how you think about deficits, the signaling about how you think about growth. All of this will matter, and it's not just a matter of the policies, which one get through. It's a matter of how you discuss what you want to do. And by the way, when you talk about regulation, the vice president has been very clear. She wants to see, in certain areas, reform that regulatory is less expensive and done more quickly, particularly around the housing market when we want to get 3 million new homes.
So I'm glad you raised regulation because former President Trump has been very explicit. I think it's 10 to 1 now. He's saying we're going to eliminate 10 for every new regulation we have. What is the proposal to reform on the other side? Because part of the argument for some people is what we need for that GDP growth actually is less regulation.
So again, a little bit of a myth. There was as much regulation under President Trump as there was under President Biden. Done in different areas, but that's part of what goes on in the government right now.
And that was Blair Efron of Centerview Partners speaking with David Weston. That conversation and more on Wall Street Week tonight at 6 p.m. New York time. This is Bloomberg.
Earnings. I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets. It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Let's go over to ETF land, where wild swings in the markets are being blamed on leveraged ETFs, which, as we know, have become very popular among retail investors in recent years. And you have JP Morgan and Nomura saying that the ETFs, they're having a real influence on the broader markets and all of the volatility that we're seeing. Let's unpack that argument, of course, with Bloomberg's Denitsa Seikova. So give us both sides here. What are JP Morgan and Nomura saying, and is anyone sticking up for these leveraged ETFs?
Well, we have to start with the AUM. If you look at the AUM, they're at 120 billion. Just 4 years ago, this was 40 billion. So massive exposure of AUM that's very heavily concentrated into tech stocks, and they're having especially heavy influence on them. So what we're seeing is, due to the mechanics of them, and they target like 3 times leverage, they have to rebalance in the last 30 minutes of the day. And often this happens just in the span of 10 minutes. So we're talking around 15 billion of balancing, which, you know, in a 600 billion a day stock market is not that big, but in a span of 10 minutes, actually it's exerting a lot of influence. And we're seeing Morgan Stanley, we're seeing Nomura, we're seeing JP Morgan, all of them saying that during those 10 minutes, it's actually having a really big impact, especially when liquidity is a little bit dicey and the moves are really big.
I loved what you cited here from Morgan Stanley's quant team here, that actually that leveraged ETFs may be exerting their biggest ever influence on the broader marketplace. Specifically, for every 1% drop in share prices, these funds would need to sell almost 7 billion of equities. How hard is it for them to do that?
Exactly. That number is really growing. The universe is a record AUM. And you can imagine if we see like a 2% move in the S&P, that means 14, 15 billions, which is something we have seen a lot lately. Of course, a lot of people are saying there are many other forces, there are zero date options, there are so many technical rebalancing that are happening at the end of the day that, of course, are also a force. But at the same time, we see a lot of the big Wall Street banks writing about it. And we see a lot of people saying that they take it into account when they consider their end of the day moves.
Right.
And especially they're very focused on semiconductors, on NVIDIA, on all those big names, and everyone is watching them.
Yeah, and I mean, you make a good point that there's plenty of different culprits to point a finger at here. But I mean, part of the reason why we have these in focus is because they're just so big. And unfortunately for the people who are worried about these, they're just getting bigger.
They're getting bigger and bigger. We saw record launches this year, 46, which is almost double what we saw last year. And an interesting trend is we see people competing to get more and more leverage. So the rebalancing gets more and gets bigger and bigger. The products get more volatile, and we see all those rebalancing being centered towards the most volatile and biggest names in the market. So it's definitely a force that we should continue watching, and that everyone on Wall Street is talking about.
Yeah, of course, it's fascinating. You have 3 times leveraged out there, both long and inverse. It'll be fascinating to watch this space. Of course, Denitsa Sekova covering it closely. And remember to tune in to ETF IQ every Monday at 12 p.m. Eastern. I'm actually off next week, Shanali, so you'll be in the hot seat.
Hold down the fort for you.
Yeah, well, let's get a check on these markets right now. Of course, on this Friday the 13th, it looks like we may have 5 straight days of gains. Of course, it's been a little bit since we've seen that, given that rough start to September. But currently, the S&P 500, it's on this side, actually. It's up 0.5% right now, of course, following 4 straight days of losses to start off this month. And Shanali, you think about what are the forces from here? You remember, we have that big Fed meeting next week.
You could have the best week of the year if we hold these gains out. We're at 4% gain for the week, 25 basis points until you would erase last week's losses. But yes, not so scary of a Friday the 13th. Now, coming up next week on Open Interest, we have some great guests for you for Fed Week. Kate Moore of BlackRock, Steve Eisman of Neuberger Berman, the CEO of KPMG. This is Bloomberg.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
politics to the world of business. Joe Matthew and Kaylee Lyons deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, this is Bloomberg Technology. Coming up, tech charges higher as the NASDAQ is set for its best week of the year. We dig into the AI drivers. That's even as Adobe misses the mark, a muted forecast on AI growth, overshadowing better than expected third quarter results. And Uber, it powers ahead as it expands its partnership with Waymo, bringing autonomous ride-hailing to Austin and Atlanta. But first, let's check in on these markets. I single out what is now the best week for the NASDAQ 100 this year, almost making up for the dire sell-off that we saw last week, and it seems to be chip stocks that drive us higher. Look at that, up 5.8%. So this knee-jerk reaction, risk off, risk on then for the last 5 straight days, really just showing that the market sentiment is trying to get round what the Federal Reserve does, but ultimately what the AI play is from here. Move on to some of the individual movers, because look, we are seeing one particular drag. The worst performer on the NASDAQ 100 is Adobe. We're seeing it sink some 8%, having a pretty dire day as once again its forecast cannot make up for actually a really rather good set of third quarter results. But it guides us towards the fact that its digital media area, the focus on artificial intelligence, just not driving that revenue as many had hoped. We saw 10%, well 11% growth for the third quarter, but what then of the fiscal fourth quarter? We'll dig into that in a moment. But let's look into what's happening with Uber, because we are driving higher on that 4.9%. This is also, of course, a deal that it's making with Waymo. It really wants to be owning autonomous driving. Let's dig into that news, that it will basically be the only app offering driverless rides in Waymo cars in Austin and Atlanta. So good news for this stock. Natalie Lung is with us to break it all down. And Natalie, overall, I am wondering more broadly about, well, what Uber is seeing here. Is it the challenge coming from robo-taxis, the challenge coming from Tesla, or is it something else that drives this?
It could be a combination of all these things, and Uber wants to make early innings into being the platform that people go to, that regular people go to get these get these driverless rides. So that's why they're making partnerships with Waymo, as with Cruise, as well as BYD for ride experiences outside the US. And it wants to be that so-called indispensable partner to all these manufacturers who are looking to put their driverless cars to use.
It's going to bring on board all-electric Jaguar I-Pace vehicles, the Waymo offering. How quickly am I going to be able to get in one at the moment? Where, which cities, how fast will this expand?
Right, so Uber and Waymo currently has a collaboration in Phoenix, so that's happening there now. But starting early next year, Uber will be offering those Waymo rides exclusively in Austin and Atlanta.
It really is a good day for the Uber stock. We're popping. Best day since August the 8th, but up almost 5%. Natalie Lung breaks it down. We appreciate it so much. Meanwhile, Adobe shares doing the opposite, whipsawing to the lower side today after the company reported earnings yesterday after the bell. Outlook really failed to quell investor impatience for new AI tools to start generating cash. Brody Ford pointed us toward it yesterday and is here with the results today. And it does seem to be that digital media side that is letting the side down.
Yeah, well, here's the big question for these software companies that were the big winners over the last decade. Is AI a meaningful new product that'll unlock new revenue? Or is it just kind of like a cool feature that you add in and it's a nice to have, but it doesn't really move the needle? And that's the question that investors have been batting back and forth with Adobe. And what we saw last night is just that incremental revenue they were hoping to see from new AI products at least isn't materializing yet. We have executives talking about we are optimizing for use and adoption rather than really driving monetization on these products yet.
Yeah, what does Shantanu have to say to quell investors' nerves? Because this is a heavy sell-off in the stock, but they seem to be trying to show that, yes, they're driving profitability, they're driving forward in terms of their offerings, but not really speaking to this weakness.
Yeah, defense, as I read it, and it was a bit of a subtle one, is that AI is still a value add because it keeps folks from going to our competitors and it allows us to increase prices, right? So it's not that I'm paying an additional $10 for the new AI tools, but it's that, well, I'm not going to go install Canva, and if you raise my prices 10%, I'm not going to cancel, and I'm not going to fight you either. And so they said that it's kind of an indirect monetization story at this point, with more direct monetization to come in the future.
What levers, therefore, can they pull to monetize in the future?
In the future, the idea would be that, generations, say in Photoshop, click here, make a picture of a dog doing a backflip. Every time you do that, you have, let's say, 1,000 credits standard for generations. You go above that, you start getting charged. That's one method. In more resource-intensive models, such as video, which they're working on, they said that could be a whole different monetization mechanism, in part because the compute would probably be so much higher. So in general, credit packs consumption and additional product tiers would be the general way folks would expect and they've spoken about.
One area of focus that we have for Adobe going forward has been the investment that they're having to make as well, the partnerships they're striking, where they're trying. You were on yesterday just talking through how these businesses are trying to delve into the 3D modeling side of things. How expensive is the artificial intelligence offering for them?
The beauty of being a giant company like Adobe, some folks have told me that Adobe's suite of creative tools is one of the most profitable products ever. And so they have a bit of a mountain of cash, and so they're definitely able to train these things and throw some money around without it being too dilutive at this point. So it's a big expense, especially for the startups. We hear about it being it can be even an inhibiting factor. Adobe has really tried to message that, look, we have a diversified business. We are willing to pull some cash over here and put it over here to make sure we're able to keep on doing this and keep getting adoption. And they generally think that they're best set by centralizing users on Adobe and keeping them there by keeping AI accessible for a little longer before jacking up the prices.
Brody Ford, we thank you so much. Thank you. Meanwhile, coming up, United Airlines and Elon Musk's Starlink, they joined forces for free Wi-Fi in the sky. More on that next. But going back to, database, software offerings and the like, Oracle up 1.7%. This is at a new record high once again. Brody Ford all over this company too, writing that the annual revenue will rise to at least $104 billion in fiscal 2029. That's a pretty optimistic signal on the growth prospects for the software maker's cloud infrastructure business. This is AI again, folks. This is Bloomberg Technology.
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Let's talk aviation tech right now. Boeing factory workers walked off the job for the first time in 16 years today, halting manufacturing across the plane maker's Seattle hub. This after members of its largest union voted overwhelmingly to reject a contract offer and go on strike. While both parties have expressed a desire to get back to the bargaining table, the move adds to the strain on Boeing. Let's just stick with the airline industry now, because United Airlines has announced a deal with Starlink. The airline is set to offer in-flight Wi-Fi through SpaceX's internet service for free. Bloomberg's Lauren Grush joins us now. Wow, no more $5.99 minimum spends for whenever you get on the plane. What does it say about Starlink's reliability in the air?
Right. I think a lot of people were wondering when, they would strike a big deal with one of the major airlines. And I think what it's showing is that, all right, there were some questions about whether or not it could handle the capacity earlier. But now I think at least one of these airlines says, all right, I think they're ready to handle our fleet of vehicles.
When you say one of these airlines, one of the big carriers in the US, they've already got a deal with Hawaiian Airlines, right? They've got some deals with some
JSX, which is a smaller airline, predominantly based out of Texas. But yes, this is one of the big four, if you will. And so now they finally have, I think, the bragging rights that they need to say, all right, we are here for the big time, the big players. Just look at this deal.
Scott Kirby really talking about how you're going to be able to just walk straight on the plane from the lounge. Right. Everything will be seamless, ultimately. You'll be connected devices, also what you're going to be using on the aircraft itself. What, in terms of market share, do analysts think that they're able to get here? Is Scott Kirby the first guy to go and everyone else follows?
I think so. I think a lot of people think this might be like a watershed moment for them, because it's a big advertising get, right? They can say, all right, here we have one of the major players. When are the other ones going to follow suit? And so that's, I think, really the big get for them.
The technology is what we love to hear from you. And ultimately, how hard is this? We all understand how glitchy the airline Wi-Fi is at the moment. Why is that, and what does Starlink offer?
Well, one of the big advantages that Starlink has over its competitors for other internet satellites is that they're closer, right? So the incumbents that a lot of the airlines use satellites that are in much higher orbits, and so there's a latency, there's that lag that I'm sure everybody has been frustrated with on their planes from time to time. But with what Starlink offers is their satellites are much closer to the Earth, and so you can have that cut down in latency. Of course, that comes with more satellites in orbit. They need to launch more and more so that they can have that global coverage, because when you're closer to the Earth, the satellites are moving a lot quicker. And so in order to have a satellite overhead at any given time, they just have to keep launching satellites. It's basically a numbers game. But if they are able to have enough satellites in orbit, then you cut down on that latency and it's a more seamless experience.
William Blair analyst Louis De Palma seems to be saying Starlink is now positioned to have the highest aviation market share over the next decade. But he's not saying in the next 2 or 3 years. This takes time, right?
Yeah, it's definitely going to take time. And as we've seen, in terms of where Starlink has excelled, they've really gone up in numbers when it comes to individual subscribers, maritime deals. They're definitely very popular over the ocean, right? Because there's less demand there. But when it comes to the, over land and with the bigger airlines, that's going to take some time. Also, you have to get certain approvals. You have to outfit the planes. So it's going to be a slow process, but this is just the first step, and it'll be interesting to see if any of the other airlines follow.
Lauren Grush, what a joy to have you in the studio in New York while she's here traveling. Thank you so much. Been a busy week in space. But elsewhere in transportation, Amazon says it will invest more than $2 billion in its delivery service partner program. It's basically an effort to raise driver pay to a national average of about $22 an hour. Bloomberg's Matt Day reporting across this. Why do it, Matt?
Well, why? The first and kind of obvious context behind this is pressure from labor groups. Amazon's contract delivery drivers are a focus for the Teamsters in particular. They put a big target on Amazon's back, saying we're going after them. Famously, these folks represent UPS and have said they think they can organize Amazon workers. So Amazon playing a little bit of defense here.
Defense. Ultimately, why do they go for contractors to begin with? Why don't they hire their own drivers?
The argument they make is that it's about empowering small businesses. I think labor experts would maybe bat an eye at that. But it is a relatively common model, right? FedEx uses, versions of this. Uber, famously doesn't employ its own folks either. So for Amazon, this gives them, a bit of a best of both worlds, right? They don't have to provide, the perks of employees to these folks directly, while at the same time they can exert a relatively high degree of control over independent, often bespoke contract outfits.
How does it look abroad? Is it this model in the US, same elsewhere, different?
There are versions of it, and obviously, in countries with stricter labor laws, they have to comply with those. The U.S. has fewer of those when it comes to last-mile drivers. But there are versions of it, their delivery service partner program abroad. They say there's something like 390,000 drivers employed by DSPs worldwide, so it's a huge portion of their, kind of workforce that does not accrue to their books.
And let's talk about their books, because I think ultimately, this is a business that has been cutting jobs, has been getting leaner and meaner in areas it can, while it splurges an awful lot on artificial intelligence and compute. What does this say, a $2 billion investment? What is that in the context of Amazon's overall spending?
Well, I think it's a reminder that, as people talk about them as a technology company, their core business of getting you things, by delivery is still growing, even if it's slower than it was during the boom years. And it still requires a whole lot of bodies to make it work, right? We're going to see, surely from them, announcents about their seasonal hiring coming up for the fall, for the peak holiday season, something they do every year about this time. So just a reminder, I think, that, listen, while the AI is getting all the headlines, they still are moving a whole lot of stuff and require a lot of partners to make that happen.
Matt Day, all things Amazon, we appreciate it. Thank you so much. Now, coming up, meet the dirtbag of the internet, who happens to be behind the crypto project promoted by Donald Trump. That's next. This is Bloomberg Technology.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Good morning from our world headquarters in New York. I'm Manus Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
It's seeking licenses to start operating in the Middle East. This is the London fintech giant hunts for growth beyond its home market. Now, the firm has submitted applications to the Central Bank of the UAE, reporting shows, to become an electronic money institution and offer remittances in the country. They, of course, the sources currently speaking to Bloomberg, say that the goal is to eventually apply for a full banking license, similar to the one that it recently received from regulators in the UK after years of work. Now let's stick with the world of fintech, but the crypto side of it. In the last year, Donald Trump has fashioned himself into a friend to the cryptocurrency crowd. He and his two older sons now have been particularly good friends to World Liberty Financial, the crypto project they've been promoting on social media. Here to tell us more about, well, the deal maker behind the project is Bloomberg investigative reporter Zeke Fox. You're also the author of book Number Go Up, Inside Crypto's Wild Rise and Staggering Fall, which is up for a few awards, so congratulations on that, Zeke. You start your story focused on Chase Hero. What can you tell about this guy?
Yeah, so Chase is unknown in the crypto world, but I dug into his career, and he's been a marijuana dealer. He says he went to prison for that. He sold weight loss colon cleanses online. He had a $149 a month get-rich-quick class. And then now he appears to be the main deal maker behind World Liberty Financial, which is this DeFi startup the Trumps are promoting. And President Trump himself posted a video saying, you know, this is going to challenge the big banks. So it's really bizarre to see that this is the person they're partnering with.
I'm sorry, the guy behind this DeFi project isn't even known in the crypto world.
No, and I mean, he calls himself, in videos, he likes to call himself the dirtbag of the internet. I found in another video, he said regulators should kick people like him out of the industry, and not in those words. He seems to have a very cynical, to say the least, attitude towards crypto. And this project, World Liberty, you know, it might sound kind of impressive if you didn't know about crypto, but it appears to be kind of a copy of an existing project that didn't go anywhere and then lost a lot of money in a hack.
Yeah, you're talking about the DOUGH project, right? D-O-U-G-H. That seems to be what's got actually industry insiders, the crypto industry, a little worried, is ultimately that the people behind World Liberty Financial have come across from a much smaller project that didn't manage to raise that many funds and actually got hacked.
Yes, and I mean, we don't know the details of World Liberty. I obtained a white paper that lays out some of them, but I'm sure it's all subject to change. But this is supposed to be DeFi, like decentralized finance. The white paper says that 70% of the tokens will be reserved for insiders. So talking to people in crypto, they said this looks like it could be more of a cash grab than an innovative project.
Okay, and therein lies the issue that this could be some sort of cash grab. Some of the details in your story, and that might hint that there's a slight difference in how this DeFi project is run compared to others, is that the people behind the overall project keep, what, 70% of issued tokens? That's a lot.
Yeah, and I mean, like, we're talking about this like I think we're talking about this even a little bit too seriously. Yeah. Like, you should go read what this guy says about crypto. I mean, I can't repeat it. The language is too. This is a family TV channel, I guess. But the way he talks about it doesn't give you any confidence that this is a serious project that's going to challenge big banks.
He says basically you can sell utter rubbish and anyone will buy it in crypto. He happened to say that in a 2018 YouTube video recorded as he drove his Rolls Royce.
Yes, and I mean, I'm digging deep to try and find his crypto resume, and I found that he appeared on influencer Logan Paul's podcast, and during the podcast, the two of them promoted a token called OMI, which I had also never heard of before. Since they promoted it a couple of years ago, it's down 96%. And another YouTuber, a scam-busting YouTuber named CoffeeZilla, posted this expose that appeared to show the two of them coordinating ahead of the show their plan to talk about OMI.
I mean, it seems that someone else listed in the white paper who's responsible as operations lead used to run a service called Date Hotter Girls, where he taught seminars on how to pick up women. All of this just feels like a real risk, ultimately, for the person who is running to be president of the United States again, to be associating himself with. Why do it?
I mean, it's pretty bizarre. And the crypto industry the people I spoke to from it are not happy about it. They like that Trump has flip-flopped and has endorsed crypto. He said that he's going to fire the head of the SEC and provide looser regulations that he says will make the U.S. the crypto capital of the world. They're like, that all sounds great, but then why are you starting this pretty silly-sounding new venture, a for-profit venture, just before the election? It almost discredits raises questions about his motivations for deregulating the industry.
What has ultimately the World Liberty Financial spokespeople said to you? Have you tried to get in touch? What have they said ultimately about the real underlying necessity of this project?
So I did contact them, and I received an email back from a man who said he was not a spokesperson, but then he spoke for World Liberty and said that he could see where I was going with all these questions, and it was painting an inaccurate portrait of this company, and that time will tell that this is a serious project that's doing cool stuff. And Donald Trump has said he's going to unveil the details on Monday at 8 p.m. on a Twitter Spaces. So I guess we'll see if what he says is consistent with the white paper, or if they've made some changes. I'll certainly be listening.
Whether or not it will indeed move away from the old banks, as former President Trump has discussed. Zeke Fox, we might need to come back to you on Monday. Thank you so much. Extraordinary piece. Meanwhile, some news from a company that used to be associated with crypto, much more in the AI world now, CoreWeave. It's a cloud computing provider now that's among the hottest startups in the artificial intelligence race. And it's in talks to arrange a sale of existing shares, valuing it at, get this, $23 billion, according to sources. The sources say that the company is discussing a transaction that would allow existing shareholders, such as employees, to tender between $400 million and $500 million worth of their holdings. Coming up, we have so much more on AI. In fact, the so-called godmother of artificial intelligence is joining the show. Fei Li, raising $230 million for her own new startup. What is it doing? Why? And where did she get the funds? That's next. This is Bloomberg Technology.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
Lots what's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York. Let's get your check on these markets because they are higher. And in fact, they've been higher for 5 straight trading days on the NASDAQ 100. We've added more than $1 trillion in market cap. We're up another 0.4%. Maybe the panic of last week becomes the past and we start to once again factor in maybe a 40% chance at least that the Fed could indeed cut rates to the tune of 50 basis points as soon as September. That's what the market is currently trying to digest. We see that reflected in the bond market, the yields just falling on the 2-year yield. I'm saying this because actually equities worldwide are seeing buoyancy from this. Stock 600 over in Europe finishes the trading week also on the higher side, and it adds some 0.75% on the day as we finish trade. Let's move on to some of the individual movers trading here in the United States at least. Look, chips have been on fire. We've made up so much of last week's real panic selling that we saw. The stocks is currently up 1.4%. In fact, every single name have been trading in the green on the day. And largely, we've got some meteoric moves over the last 5 days. ARM is up some 25%. This, of course, a chip design company that Raymond James is saying they're now rating it an outperform. They see a growth view, particularly when it comes to AI on the edge. And we're looking at Adobe, though, despite managing to live up to expectations in its fiscal third quarter, it's dragged lower. Its forecast not good enough. Where have we heard that before? NVIDIA, Broadcom, and we've heard this a theme in the earnings season, and Adobe once again just not managing to show the generation of revenue from AI, even though they do add generative AI to their offering. Let's just stick with AI now, because AI pioneer Fei Li has raised $230 million from a star-studded list of investors for a new AI startup called World Labs, which officially launches today. The company aims to build software that can use images and other data to make decisions about the 3-dimensional world, building what it calls large world models. Here to talk about what exactly that means, and indeed the fundraise, Dr. Fei Li, alongside Bloomberg's Rachel Mitz. It is wonderful to have you both here. And, well, Dr. Li, I asked first and foremost, what was it like raising funds as an academic, now entering this private world to be raising money? You've been in private world before, but to raise funds, was it easy from this star-studded list?
Good morning, Caroline. It's really good to be here. Well, nothing is easy, but what's really, really hard is make spatial intelligence happen. I'm just so excited that we brought together a incredible group of Pixel AI talents to work on this really, really hard problem that we now call spatial intelligence.
Explain to us what you mean when you say spatial intelligence, and what is it that you're building exactly?
Yeah, Rachel, well, look, humans have spatial intelligence. It's actually a very ancient ability we have evolved over millions and millions of years. It's the ability to understand, to reason, to generate, and to even interact in the 3D world, right? Whether you're looking at a beautiful flower or trying to touch a butterfly or building a city, all this is part of the capability of spatial intelligence.
We see that with humans and we see that with animals. How do you expect that we'll see that with computers?
Well, that's the problem we're working on. We're already starting to make tremendous progress. The past decade of AI has been pretty exhilarating, and people hear a lot about language recently, but truly in the world of pixels and vision and spatial intelligence, we've been making progress, such as understanding what's in the picture, to be able to tell a story of what's in the picture, to even prompting a sentence and get a 2D image out of it. But what's really the next frontier, which is such a hard problem to crack, is to bring all this into 3D, because the real world is 3D, and humans' spatial intelligence is built upon this very native capability of understanding and working with 3D. So
let's put into real-world context that working with 3D. The applications, is it robotics? Is it manufacturing? Is it just us interacting with the real world when we put our AI function glasses on?
You're not wrong, Carolyn. This is such a foundational technology. It's a foundational ability for computers that it has implication in a wide range of use cases. To start with, right, creators. Creators includes not only artists and VFX creators, but also designers, developers, builders. And this technology has a profound implication for them. But in the long arc of this, of course, robotics, manufacturing, AR, VR, this is, there's a reason that Apple calls their Vision Pro spatial computing. Well, in my opinion, spatial computing needs spatial intelligence. So does many other use cases.
Why does spatial computing need VC money, private sector action? What couldn't you achieve in academia?
So this is a whole ecosystem. We've been seeing this in AI. We've been seeing this for years now, and this dates back to any technology that our society, our country is building. Right, this ecosystem needs upstream, fundamental, curiosity-driven research, which I have spent many years of my life in. But it also needs very focused drive in industry. We've got great big tech companies working on related problems, but we also, what's beautiful about our ecosystem are startups that has a tall dream, has the ability to call on the believers who believe in cracking such a hard problem, and we come together and focus all of our energy in solving this truly hard problem that needs to be scaled, needs to be productionized, and needs to be delivered in the hands of users and customers.
Dr. Li, one of the things that you're most well known for is ImageNet, big database of millions of images that really help push forward the field of object recognition in images. I'm curious how your work on that played into your decision to start World Labs. How do you see those two things as related?
Yeah, thanks for asking that question, Rachel. I think they're related in two ways at least. One is that ImageNet is one of the earlier work in the field of computer vision, which is in the pixel space. Granted, in that time, more than 10 years ago, what ImageNet and the derivative algorithms were able to do are still in the 2D space, right? Recognizing objects in photos and eventually telling stories of pictures. But now this is an intellectual continuation of the early work in computer vision. Now we're into the next really difficult chapter, which is spatial intelligence. So intellectually, I feel it's my life's work in continuation. And zooming out one layer, ImageNet was my, more than 15 years ago, it was my intellectual bet on a big North Star problem, a North Star problem that can really change the course of AI. I do believe spatial intelligence is the next North Star for me and for my team, that it will change the course of AI.
One of the things I'm wondering about with the funding for this company is there are a number of big names in AI in particular that invested in this. We've got Jeff Dean and Jeffrey Hinton, Andre Karpathy. Some of them you've worked with previously. I know several of you were at Google at the same time. How did you pitch them on it?
Well, that's the beauty of our field. First of all, these people have been friends and colleagues for years or former students. I think they share my belief. I think they see this as such a big problem. And they believe in my team, that when they hear my co-founders, Ben Mildenhall, Christoph Lassner, Justin Johnson, and really the entire founding team, they recognize that while this is a tough problem, it needs people who really can have the ability and belief to crack this. And I think that's why they supported us.
You've got money from big name VCs as well, Andreessen and Horowitz, to name just one. I'm interested more broadly about the rallying call you've had for money to go towards academia. You went to President Biden himself saying that there needs to be more funding in the public sector as well as the private sector when it comes to AI, R&D. Ultimately, so universities can access GPU and compute. Are you still feeling that necessity that public sector needs money, or have you just sort of given up and gone to the private sector here?
Carolyn, I actually believe even more so now that I'm traversing both the private and the public sector, that seeing the access to compute, access to support in the private sector, I believe none of us will be here in the private sector without the public sector. You know, ImageNet, convolutional neural network, backpropagation, transformer models, many of these seminal work in AI came from public sector first. So I think this ecosystem is so critical, and missing or the imbalance of any component is harmful for the ecosystem. And now I have personal experience to see the access we have to resources. It makes me believe even more that our country needs to invest in our public sector, in academia, in this kind of moonshot mentality to support, you know, students and faculty and researchers in basic science research.
Academics backing you financially, as well as I say, A16Z, NEA, Radical Ventures, as well as many others, and some celebrities in the mix as well. We thank you so much. World Labs co-founder Fei Li and Bloomberg's Rachel Metz. Appreciate it. Now, let's just talk about elsewhere in AI. OpenAI CEO Sam Altman, NVIDIA CEO Jensen Huang, and other industry leaders have actually just been meeting with senior Biden administration officials at the White House just yesterday, where they discussed steps to address massive infrastructure needs for AI projects. Following the talks, the White House announced an interagency, they're calling it, an interagency task force to help promote data center development in the US and initiatives to support accelerated permitting for those facilities. Coming up, we're going to be joined by Dylan Cox, head of private markets research at PitchBook, for the firm's latest report on private money going into startups, like we've just been talking about. And then we've got Rethink Impact founder and managing partner Jenny Abramson on the firm's latest fundraise. It's a lot. This is Bloomberg Technology.
What are your thoughts on fast fashion? It's been transformative. It gives the masses access to fashion, but there's a cost to it, downside to it.
My first notice is too much waste. I think this is also how I grew up, you know, making your own clothes and making something that's very special and very unique. It's like timeless. And now you see that everybody is looking the same, like wear sweatshirts and wear t-shirts. And for me, it's just like when they wear something very special, they feel empowered.
Is there a need for fashion to be more mindful of the impact it's having socially, environmentally?
Definitely.
Is it happening enough?
I think it's happening. It's gradually happening. All the designers are doing, everybody is thinking about this subject at this moment, thinking how to be more sustainable, how to be more environmental friendly.
Do you think the fashion industry is doing enough to ensure that it is sustainable. There's so many targets out there. Are they even realistic in wanting to achieve them?
I think some of them are just like they're using sustainable ideas as a marketing concept only. They're actually not really doing it. I think as a designer, it's really important to really make it happen. Every collection, I think about how to do it and how to tell the customers. I think that is our responsibility to educate our customers.
Bringing you up-to-the-minute technology news whenever and wherever it happens. I'm Annabelle Drawlers in Taipei, and this is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
This week, PitchBook released its quarterly private market fundraising report. Not that pretty a reading. Funding was down in the second quarter, with venture capital seeing a 33% drop in fundraising year over year. Let's discuss it all with PitchBook Head of Private Markets Research, Dylan Cox. Dylan, we know that it's been hard to raise funds for some. Who particularly is it hard for?
Well, thanks for having me on. Over the last 12 months, our data shows it's been particularly hard for venture investors as well as private real estate funds. On the flip side of things, we've seen some strategies have success, such as private equity secondaries, which provides liquidity to private markets and mitigates the J-curve impact for newer investors, as well as private real assets, which a lot of people don't expect. There's a lot of money right now flowing into infrastructure, kind of along the lines of decarbonization of the economy.
What about, well, data center and digitalization? Are we seeing that in terms of the real asset allocation?
We are. That's another big piece of it. It's decarbonization, it's data centers, but not to be forgotten are sort of traditional infrastructure like roads, bridges, ports, and airports. And then something that also catches a lot of folks by surprise is the sort of slow but steady chugging along of more traditional natural resources in that bucket. Things like oil and gas and timber funds, I think have proved to be a bit more resilient than a lot of investors would have expected maybe 5 or 10 years ago.
Less on our tech theme of things, but important to acknowledge. Dylan, talk to us a little bit about what's happening in VC. What are the funds having to say to former LPs to get them to commit to new funds? Where are we seeing outliers raise big new funds to allocate?
Well, AI is certainly the name of the game, which will, of course, surprise nobody. We're seeing much larger AI-focused funds as well as AI-focused deals right now, many of them, household names at this point. But in terms of the asset class as a whole, I think the single most important issue right now is liquidity. That's distributions back to investors of venture capital funds. Viewed as a proportion of the size of the fund or of the assets in the fund, we're reaching sort of decade lows in terms of trailing 12-month distributions, which of course means that investors in those venture funds have fewer dollars on hand to recommit into the next vintage of venture vehicles.
Love that you talk us through the secondaries and the liquidity side of things as well, Dylan Cox, PitchBook Head of Private Markets Research. Great to have your take. We're actually going to now pinpoint a complete outlier to the conversation that we've just been having, because Rethink Impact is now one of the largest VC firms dedicated to funding female CEOs, and it's just announced a whopping $250 million fund, its third and largest fundraise to date, nearly doubling the firm's assets under management to more than $500 million. Founder and managing partner Jenny Abramson joins us now. So Jenny, we were just hearing that it's dire out there for venture, but not for you. Who did you have to come on board? Which LPs are interested?
Well, first of all, thank you for having me on behalf of my partner, Heidi Patel, and the rest of our Rethink Impact team. Yeah, we're very excited to have announced a more than $250 million raise, the largest fund backing female CEOs. And we were fortunate, despite the trends that Dylan shared, to be able to do this in this market. And it was in a large part due to major institutions who came on board to support the fund.
What sort of institutions are willing to almost take what now feels that the pendulum has swung on, a more DEI focus to investing?
Yeah, I think people, major institutions, we had more than 10 university endowments. We had more than 10 major foundations. We had, for example, a hospital and others that really do care about returns and I think have realized that investing in women and gender lens investing is not just something that feels good, but is actually good business. And so they came on board along with many individuals, self-made billionaires like Sarah Blakely of Spanx and Sneaks, to Melinda French Gates, the major philanthropist, and to many others. And we think the combination of big institutions that I named, a global bank like UBS, Cambridge Associates, their LPs, these kinds of institutions have realized that this is now a mainstream opportunity.
We were just looking at some of your previous portfolio from the first fund. The vintage is good. The billions that you've managed to raise, well, these founders have now made themselves valuable at. Guild Education, for example, Spring Health, Elevest. But these companies haven't yet exited, per se, some of them. When do you think that might occur in the first fund? How is the IPO pipeline looking for you? Do these female founders want to go to IPO, or are they looking at M&A opportunities?
Yeah, it's a great question. I mean, I think the data has shown that female entrepreneurs do deliver higher revenue, more than twice as much per dollar invested, and tend to exit on average a year faster than their male counterparts. And these companies, like all companies, there's been a slower IPO market, but we invest sometimes as early as a late seed. And so it can take companies typically 8-10 years, as well as an open IPO market. Of course, there's also M&A opportunities, PE buys, and others. And so depending on the company, different outcomes will occur.
We were just hearing from the people who've jumped on board to commit capital in what I kind of already referenced, of this moment where the pendulum has swung. We are hearing more pushback against funds that focus on women, people of color, minority founders, rather than wanting to embrace them. We've seen the Fearless Fund, for example, actually have legal issues being able to allocate its grants to women of color. Was that anything that you heard of when you were out this summer raising the money?
We really mostly heard that people were excited by the opportunity, that investing in women is no longer just a passing trend in the wake of the Me Too movement. And I think this raise makes clear that this is good business, good for the economy, and certainly here to stay. So that's mostly what we heard. Male-founded companies continue to get 98% of investment capital, and almost all of our companies have men and women in the top team. And we think gender-diverse teams outperform. And our goal is to, grow the pie here and grow the economy, which is what we're doing by backing these great female leaders.
Oh boy, Jenny, but you say that stat. Just 2% basically of VC money going to female-founded companies. And it isn't changing. And I'm interested as to why you think that is occurring. If you give us all the statistics that they're managing to exit quicker, they're building revenue faster, we're seeing better outcomes.
Yeah, I think this is the moment where it's starting to turn. To us, this raise from Rethink Impact that we announced, it really shows that these mainstream investors, these institutional investors, see the opportunity, and that the opportunity between the data and now examples of companies like many that you held up, a company like Spring getting a $3.3 billion valuation last month, and many others, we think that's going to be the turn that leads to capital being more allocated in ways that grow the pie. So we're excited. We think this is that moment that things are going to finally unlock and change that data point that's been stuck for a while.
Wow. Heidi Patel and yourself leading this and raising a huge round. Rethink Impact founder and managing partner, Jenny Abramson, we thank you for your time. Now coming up, French AI startup Poolside is in talks for a new round of funding. So many more details ahead. This is Bloomberg Technology.
news and tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything.
What did you say to your mother and father when you said, I'm dropping out, despite the fact I said I wasn't going to drop out?
Well, I said I'm just taking some leave.
Oh, leave?
Yeah. I think I'm still technically on leave. Harvard has kind of a funny relationship.
How long can you be on leave? For 10 years or so?
Well, I guess we're going to find out, yeah.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
One other VC story that we're watching, AI startup Poolside is in talks for a new round of funding, giving it a valuation of $3 billion. All this before the company even released an initial product. According to sources, the company is set to raise $500 million in new financing with Bain Capital in talks to lead the investment round. And that does it for this edition of Bloomberg Technology. You do not want to forget our podcast. You can find it on the terminal, as well as online on Apple, Spotify, and iHeart. It'll be back with me next week. Have a wonderful weekend. This is Bloomberg Technology.
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
The names that move markets are on Bloomberg.
Don't expect we're going back to zero, because zero was the product of huge global shocks. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it will be lower than where we are today, but I think it's very clear that we're not going back to zero.
Bloomberg. Context changes everything.
there is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Top names at Jackson Hole are on Bloomberg.
Inflation's kept coming down, so in the real rate sense, we've been tightening. I think that this reflects the reality of the economy, that we've got to keep our eye on the employment side of the mandate now. This is what the path down to 2% inflation looks like.
Nobody covers Jackson Hole like Bloomberg. Context changes everything.
From New York City for our viewers worldwide, I'm Shanali Basak, and Bloomberg Real Yield starts right now. Coming up, a week of economic data sets the stage for the Fed to start cutting rates. Now, the question is, how big will Jay Powell and the central bank go? 25 or 50? And we're going to catch up with Akila Graywall, partner and global head of credit product at Apollo Global Management. There's been a lot of news coming out of that shop. But first, we're going to begin with the big issue, debating the Fed's path ahead.
The market participants are still trying to gauge, is inflation still back in the box?
Overall, it looks very well controlled to me. We're quite comfortable with an inflation rate in the 2 to 3% range.
Inflation, it's gotten a lot better. It is going in the right direction.
People are worried that the economy is slowing and inflation isn't slowing fast enough.
We were expecting slightly lower print last month.
I think it maybe was a little bit of a shock to some people in the market that inflation could still be a concern.
It holds the Fed back. I think we get 25 basis points this month for a cut.
Inflation today at the margin is tilting investors towards 25 basis points in September.
The market has seemingly removed the expectations for a larger, more aggressive 50 basis point cut next week.
So while the Fed's focusing on the labor market, they're not going to forget about inflation. So I think it's going to limit the flexibility that they have.
We may have a slow start to Fed cuts if inflation remains sticky.
Now, we're pretty much looking at a coin toss in the markets between that 25 or 50 basis point rate cut. Traders are boosting the likelihood of a 50 basis point rate cut to more than 40%. And remember, that was an outcome that just days ago seemed like it was off the table. The Wall Street Journal's reporting that the Fed's decision is a close call hinges on this one question. Do they start small or begin big? Of course, whatever they choose to do with that first cut will set the tone for the path ahead. Mohamed El-Arian warns of that potential volatility coming up.
We have a major reconciliation in our future. We have the Treasury part of the fixed income market that is signaling quite a high probability of recession. We have the credit part of the fixed income market that is signaling a very high probability of a soft landing. Now, if liquidity doesn't reconcile these two things, there's going to be even more volatility in this marketplace. And at some point, volatility spills back to the real economy.
Joining us now, Gennady Goldberg of TD Securities and Brandywine's John McClain. And Gennady, if you think about exactly what has changed over the last 24 hours, it's not the economic data so much. You did get the University of Michigan sentiment data, but that confidence that you saw in the data would have supported a 25 versus a 50 basis point cut, would it not? So why do traders still believe that 50 is so on the table?
Well, there's been some reporting out of the Wall Street Journal that I think has driven some of the market pricing. Right now, we're in the media blackout ahead of the Fed meeting, and unfortunately, information vacuums breed uncertainty, and this is exactly what we're seeing. The market is questioning whether, the Wall Street Journal knows something that the rest of us don't. They're questioning, this is exactly what happened ahead of that June 2022 meeting, where the Fed actually kind of let the Journal in on a little bit of, information ahead of the meeting. The problem is, I don't think there's anything new in that story, so fundamentally, nothing has changed.
So, John, how do you see this going? What would it say if the Fed were to cut 50 basis points?
Well, we don't think the Fed is going to cut 50 basis points, and we think if they were to do so, again, that's like shouting fire into a crowded movie theater. There's no reason to be doing this at this point. The data supports 25 basis points, and going slow and steady, we think, makes sense.
At the end of the day, if they went 50, and the reason I ask this so much is because the odds in the market seem to be rising, not fully favoring that direction, but closer to it than they were before. Could they go 50 and then go 25 after that, Gennady?
Well, I think that's the difficult thing to communicate, right? How do you tell the market, oops, we're starting really late, so we're going to go a lot faster, but the next couple are going to be slow, so don't worry about it, but we're also going to be data dependent, right? That tightrope is extremely tough to walk. So what they want to do is tell us, look, we're going to start gradually. If we need to go faster, we can certainly go faster. I think what's more likely is they go 25, keep the door open for 50s, so that if the next two payroll reports after the September meeting, let's say they weaken, we could certainly accelerate into a 50 basis point a meeting pace if it's necessary, but not necessarily right now.
So then, John, to that effect, do you believe that that could be the case as well? What does the labor market look like to you that would justify even those 50 basis point cuts later on in the year?
Well, yeah, I mean, look, the labor market is certainly softening, and we're getting a lot of micro data from companies talking about the low-end consumer particularly struggling, and the middle-income consumer is really starting to suffer in terms of wages relative to what we've seen in inflation. But I think the logical is exactly what was just discussed, which is start with 25, see some more data. We talk about being data dependent. And if the data continues to soften, then you can hit the accelerator. But starting at, going from 0 to 60 feels like it's probably not the right course. And I think the market will actually interpret that negatively. I would expect stocks to sell off if we start to see a 50 basis point in September.
Listen, this dispersion is huge. We've been talking about how this is essentially a coin cost in the markets. When you think about what Bill Dudley has said recently, he's on the other side. He thinks there's a strong case for 50. He says that he knows that that's what he would be pushing for. It's basically up to Chairman Powell to see how much support he has for being more aggressive. When you read the tea leaves across the other members of the FOMC here, Gennady, is there more support to be more aggressive?
I don't think so. I mean, they're certainly keeping the door open. If the economy slows down, if the labor market really starts to slow down, they can certainly go. But we had Governor Waller speaking on Friday, President Williams speaking on Friday, President Goolsbee speaking on Friday. If ever there was a chance to drop a hint, that would have been it. None of them really pounded the table on a 50 basis point cut. Governor Waller initially seemed to be a little bit more in favor of it, but if you read his speech closely, he was talking about accelerating from 25 per quarter to 25 per meeting. That's not exactly anything new. So at the end of the day, I think they've had their chance to drop the hint for a 50. If they choose to push markets that way, they could have certainly done it. I think the market right now is just trying to trade the information vacuum. Now,
it's interesting, John, when you look at the 2-year, for example, it has pushed below that 360 level. As I speak to you right now, we're at 359 essentially, 5 basis points lower, even after that University of Michigan data. What am I not seeing here? Because we have the consumers saying that they believe that inflation is really moderating enough to feel good about the outlook of things. You understand here, yes, the labor market is cooling, but if the consumer feels okay, then what's the worry?
Well, I mean, look, I do think the worry is in the slowdown of the consumer, and the worry is that we are coming off of unprecedented fiscal stimulus and very high inflation, and so we're trying to stick a soft landing here and getting a little bit cute with monetary policy, frankly. So, I think you look and see 9-10 cuts priced in over the next 12 months, and we think that is far too aggressive in terms of where the Fed is. But that's why the 2-year is where it is today, is the expectation. Is the expectation that we get ahead of things.
Would you buy at these levels?
No, I'd be fading this here. I mean, I think the front end has reacted to kind of where they think the Fed's going to be in a couple of years. And the back end's really tricky here because we have no term premium baked in.
So, Gennady, speak to that as well. How do you think about the differentials between what you're seeing in the front end and the long end, and how you would position from here?
Yeah, I mean, I think I agree, John. I mean, it's tough to chase this rally. I think most investors I've spoken to don't want to be chasing this move in rates. Stepping back, I think what we're seeing right now, very importantly for the Fed, is an easing in financial conditions. That's something I don't hear talked about enough, is that if you look at financial conditions just across any index, whether it's the Bloomberg one or any, pick your index, all of them are really pointing towards an easing in financial conditions, and that's huge, right? A lot of that is long-end interest rates coming down, short-end interest rates coming down. We're looking for the 10-year to finish the year at 3.4%. We're looking for the 10-year to hit 3% by next year. That's assuming a relatively soft landing. If we get a harder landing, you're probably not going to get that good of a print. We can keep going and rates can actually fall further, but in the short term, I think there's a lot of investors out there who are very concerned about chasing this too far down.
Well, you look at Fed swaps, you look at even the spot market when it comes to treasuries. Question for you, Gennady. Do you think, and an investor brought this up to me this week, that what's being priced in here is not as much a reflection of where they think the Fed is actually cutting, but just a risk premium that is baked in that things could be worse than you think it is?
Absolutely. I mean, it's the same reason we have our forecast for the end of next year at 3% when our forecast for Fed funds is at 3% as well. That's not something you typically have. That's an absence of term premium that you only have when the market is expecting something bad to happen. So, we always have to think about this as a range of possibility. You've got a soft landing as the base case, but as you keep getting this weaker and weaker labor market data, the fear is, it's kind of death by ice, effectively. It's a cooling over the labor market to the point where the economy slows and rates continue to pencil in some chance of a recession. And I think that chance is gradually rising as the data comes in.
John, what is the probability you place here on a chance of a recession and how hard it could be?
Well, I mean, I think the chance of a recession is reasonable, probably 20-30%. But I think really the issue is that companies' balance sheets are fortified at this point in time. So a garden variety recession isn't going to be materially impactful to the corporate bond market, which is where we're really paying attention. So we think, look, a recession could happen, but companies have been thinking about a recession since 2022. So the balance sheets are strong.
A very large investor telling me this week that perhaps we already had our recession and we're in the beginning of a 7-year bull cycle. The market will certainly show its face at some point. Gennady Goldberg of TD Securities and Brandywine's John McClain, we thank you so very much ahead of a very critical Fed meeting, historic really, that could set off a rate cutting cycle. Let's see how easy that goes though. Up next, the auction block, Hewlett-Packard Enterprises raises $9 billion, which is pushing this week's sales past forecasts. We're going to talk credit next as this easing cycle begins. Stick with us. This is Real Yield on Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where the pace and demand for global debt sales remains strong. Over in Europe, Italy's 8 billion euro 30-year sale attracted over 130 billion euros worth of orders as investors rush to lock in the region's highest yields. Monthly sales now top 100 billion euro. And in the United States, Hewlett-Packard Enterprises and Citigroup led the way for high-grade sales this week. Around $38 billion was sold in total, which pushes the year to date total past $1.2 trillion. Over in high yield, the week's issuers count hit 15, making it the busiest period since May. By number of issuers, Tuesday was the busiest day this year. And private markets were also part of this week's sales. Blue Owl and Sixth Street both had offerings. Blue Owl selling $1 billion, adding to the record-setting pace this year for private credit funds. We're going to stick with credit, bring in Akila Grewal, partner and global head of credit product at Apollo Global Management. A lot in the news about Apollo this week alone, but let's start here with the environment. This idea that we are on the precipice of a historic rate cutting cycle. What does this mean? We've seen a flush of issuance come out this year in anticipation of just this moment. People looking to lock in those better rates. What do your conversations with clients look like?
No, thank you, Sonali, so much for having me. And absolutely. So I think, like you had on your prior segment, the market is obviously pricing in additional rate cuts to happen over the course of the near term. I think remains to be seen whether that'll be 10 over the next 12 months, but equally there likely will be some compression in rates that we're all expecting. That being said, when you think about rates today, it's still elevated versus where we've been for the last 10 years. And so investors are still very much focused on getting exposure to credit because from a total return perspective, from a yield perspective, you're still getting really attractive risk-adjusted returns.
We seriously hear that a lot, whether you go into credit markets as opposed to what you're seeing in treasuries for that extra yield. What does this mean for public versus private credit? Where does the investor demand go as you see the rate cutting cycle start to begin?
No, it's a great question, and we get it a lot. Obviously, liquidity has continued to be a focus for investors, particularly given the rise of private credit. And you've heard Apollo or others talk about how historically public credit was associated with good and liquid, and now private credit sometimes has a misnomer of being bad and illiquid. I think we're going to continue to see a convergence of those two markets, and we can talk about that more. But equally, I think from a public market perspective, it's also a tale of two cities, right? You have really liquid parts of the top end of the market, larger issuers, new issuance that you mentioned, and then when you go down to legacy exposure or more smaller companies, you actually have a lot of illiquidity in the public market. And the liquidity premium for public markets has actually near or about historical lows, whereas in the private markets, our expectation of what we're seeing is in sub-IG, you're still getting about 200 basis points plus for private credit vis-a-vis public. And in investment grade, you're actually almost doubling the spread that you can get in the public market. So at least for now, it still feels like private credit is a relative value that you want to play.
So this is fascinating because we, of course, reported this week that Apollo is partnering with State Street. You're looking to provide private credit access in the form of an ETF. I know you can't talk about the filing itself, and also this idea that we reported on that Apollo is creating a trading desk to make this possible to begin with. But talk about the concept here. How liquid can these markets really get? I mean, what does all this retail access mean for the industry? Does it make the private markets look much more like the public markets anyways?
No, it's a great question, and you're right. I'm limited in what I can say, but equally, State Street is a leading asset manager. We're thrilled to be partnering with them. We can't say too much at the moment, but I think thematically at a high level, you've heard our CEO, Mark Rowan, talk about this convergence between public and private. This is emblematic of that in our view. I think you'll also continue to see, and there was news today as well, of traditional and alternative asset managers partnering to kind of bring broader access of alternatives to these more liquid type of structures. And I think that, Apollo is getting engaged in this facet as well as thinking through what do we think about investment grade markets, generally speaking, and should there be a bifurcation or are they coming together in terms of liquidity?
How do you think about this in terms of risky versus not risky? Apollo, of course, the old legacy of Apollo was in distress. The new legacy of Apollo is in investment grade credit. And so when you think about those companies that are still feeling the strain of higher rates, to your point, rates may stay elevated.
Right.
How many companies are still going to feel that pain if we don't see those 10 rate cuts? How does Apollo handle that?
I think you're spot on, and I think to your point, legacy Apollo, new Apollo, but we can debate. I think equally Apollo's credit business, as you well know, is very much focused on still high quality, top of the capital structure, secured type of risk. That doesn't mean that there won't be opportunities for opportunistic and hybrid businesses to delve into some of those situations. As you know, right, I think JP Morgan reported there was $50 billion worth of distressed activity over this year, which is incredibly high, and you're seeing that really in the floating rate market more than the fixed rate market, to your point on rates. And so I think what Apollo is going to try to do is focus on still high quality companies, fundamentally sound companies that may need additional structuring, LME or otherwise, and that are focused on good company, maybe suboptimal balance sheet, versus diving down into kind of, in our credit business, suboptimal company and suboptimal balance sheet.
What does this say about kind of what's coming to market right now? Because when you look at credit spreads, they are still so tight that you could argue that most investors are sitting around and ignoring the risks in the credit market. But then you see bankruptcies also hitting the tape very significantly. So what is Apollo seeing kind of on that falling angel end of the spectrum? Are you seeing kind of a lot of companies out there that you just wouldn't touch at this point, given where we are in the economy?
I think in the high yield market, yes. I mean, the CCC market is difficult to kind of get engaged with. Not to say that we would never, but I think we're going to definitely be much more focused on picking our spots. And to your point, high yield spreads are where they are. If you take out the bottom 20%, you kind of have a really historical tight, we've never seen in terms of high yield spread. So it's definitely going to be about picking our spots.
So private credit once more, because I think this is an interesting aspect for all credit investors. Access is being made as we speak. But what does this mean in terms of future interest? As rates go down, how much interest will there be in private credit? Given so many instruments have been floating rate, you've seen also a lot of pressure on investors. That has been made fundraising, that hot fundraising we saw at the beginning of the year, start to taper off now. So where's that extra interest coming from, and what does that look like as rates start to subside?
No, it's a great question, and I think you've heard us talk about this before as well, but the wealth and high net worth, and retail market, I think, is incredibly instrumental in our growth, and candidly the alternatives growth more specifically. It's a $200 trillion market, 5% in alts. And so if you believe that they're going to continue to diversify, get additional sources of income, additional sources of exposure, and really try to lean into the alts market, whether it's the announcements that we talked about earlier or otherwise, that's going to be a big area of growth for us. And I think equally on the institutional side, we speak to investors all the time. There's still a number of investors who are early in their private credit exposure days. And as we kind of take a step back and you think about return targets for a long time haven't really changed in terms of what investors are seeking to achieve. And when rates were zero, they leaned to more equity or higher risk strategies. Today, when rates are not zero, higher than zero, you're seeing people move across the risk curve.
What is it actually being offered to these retail investors? Because it's not like when they are investing in private credit, they're investing in, the next leverage buyout, right? Yes. I mean, what are the kinds of things that are being placed into those private credit portfolios?
Great question. I think it's about semi-liquid products that allow investors to get
mortgages.
Yeah, mortgages. We can talk about in asset-backed finance, it's mortgages, it's resi, it's consumer. It's a diversified approach to everything that we're doing across the origination channels in various product forms.
About 30 seconds left here. What's the single biggest question your investors ask you right now?
I think the single biggest question is where are the unintended risks that I'm taking in my portfolio, and how do I mitigate against it? And a lot of what we've been talking about with investors is shifting your private credit allocations to investment grade as well, to start thinking about a holistic fixed income portfolio, which is a big theme of ours.
Akilah, we thank you so much. That is Akilah Grewal of Apollo Global Management. And still ahead, the final spread, the week ahead, it is the big week. A Fed rate decision just around the corner. We're going to talk about those expectations next. This is Real Yield on Bloomberg.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
I'm Shonali Bassick, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up Monday, you have PIMCO CEO Manny Roman speaking on Bloomberg Television. You're not going to want to miss that. Plus, U.S. Empire Manufacturing. Tuesday, the latest retail sales print, and we're going to hear also from J.P. Morgan CEO Jamie Dimon. You may remember he's believed in higher rates for a long time. Let's see if he still does. Wednesday, a Fed decision and Chairman Powell's news conference, the big moment of the week. And Thursday, another round of U.S. jobless claims, existing home sales, and a Bank of England decision. Finally, Friday, it's the Bank of Japan's turn for a rate decision. Plus, we'll hear from ECB President Christine Lagarde. For my final thought, let's take a look at those central bank decisions around the world. Of course, remember, because we have U.S., Brazil, and Indonesia on Wednesday, UK, Norway, Taiwan, Turkey, and Ukraine, and then Japan, I'm watching, of course, U.S., the UK, and Japan to watch all of those differentials. Remember, the story on Wednesday could change drastically by Friday because of that carry trade and just how hawkish Bank of Japan's governor has sent signals into the market, already setting some jitters in the market this year. Now from New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome to Bloomberg Markets. I'm Scarlett Fu. Stocks are getting ready to close out the week with gains, with traders now increasingly betting on a 50 basis point rate cut at next week's Fed meeting. You look at the S&P 500, and so far this week, it has closed up every single day, and it looks right now set to do it again today. Within the equities complex, the small caps are leading the way. The Russell 2000 up 2.5%. Of course, small caps are seen as benefiting more from a Fed cut in the near term, given the massive gains that we have seen in big tech up until now. There's movement across treasuries, rising across the curve, but especially at the short end, which is, of course, more sensitive to Fed policy. The 2-year down 6 basis points to 3.57%. And I included gold there now at 2610. That is a new record high. All right, let's go back to equities to just highlight a couple of movers. And first up, we wanted to show you Restoration Hardware. Up on results, the home furnishings retailer reported sales and EPS above analyst estimates and also said demand trends have been improving. Now, moving to the downside is Adobe, the creative graphics software maker. Those shares sliding the most in half a year on a disappointing sales outlook. Investors all through this earnings season have been impatient to see how revenue from AI businesses are showing up on the results, and that was also the case with Adobe. The stock is down about 9.4% over the past 2 days. Staying with decliners, the worst performer in the Dow Industrials today is Boeing, and this is as its factory workers walked off the job for the first time in 16 years. Members of Boeing's largest union last night overwhelmingly rejected a contract offer and voted to go on strike. That sentiment being reflected earlier by one of the union leaders.
This is about respect, this is about addressing the past, and this is about fighting for our future. Our members rejected the contract by 94.6%.
For the latest on what's going on with the labor action, we're joined now by Sid Phillip. He is Bloomberg's deputy editor for global aviation. So, Sid, the contract they voted on included a 25% raise over 4 years. That's the largest ever, but the union wants more. What specifically are they pushing for?
They were pushing for about 40%, and they were also asking for a restoration of pensions. They were asking for an increase in healthcare expenditure. So, essentially, they were asking for a lot more, and they didn't get that. And given the fact that Boeing is in a precarious position, it is a good time for them to sort of try and get the best they can, because they felt that previous deals did not get them what they wanted.
Yeah, they feel they have the leverage now.
Exactly.
Do we know if the two sides are talking during the stoppage?
We do. We do know that both the sides want to get an agreement quickly. Boeing is desperate for a deal because they would like production to get back up, and they're concerned that essentially it would, as the longer a strike goes on, the less they can sort of produce planes, and that means no cash coming in. And so Boeing desperately needs a deal. The union's keen on getting a deal as well, and so it all depends on how long this strike lasts, and essentially that will determine what the financial impact will be on Boeing.
Well said. And we should mention, too, that the White House is involved as well. There's a full statement here, according to a White House spokesperson. Administration officials are in touch with Boeing and the machinists. We encourage them to negotiate in good faith toward an agreement that gives employees the benefits they deserve and makes the company stronger. Sid, I know that you were just listening to Boeing's CFO speak at an event. What did he say about the strike action?
He did say that it's too early to tell the impact of what the strike's going to be. He said the impact on cash flow and on cash flow progression for 24 and 25 is still uncertain because essentially it's still a lot of work in progress. He did talk about how Boeing is keen on maintaining its investment grade rating, and they did sort of talk about how in the long term they do see a positive business for Boeing. So essentially they're looking to get around this issue. They said that they're willing to get a deal, they're willing to work with the unions, and they do sort of hope that in long term they can sort of turn this ship around.
Yeah, and you mentioned, of course, that he did say that Boeing still has this investment grade rating that they want to keep. Moody's may cut Boeing's ratings to junk status. I mean, it's just right at the cusp of that, right?
It is hovering just above junk, and so they need to do some actions in order to preserve that.
What are analysts saying about the strikes? Are any of them pointing to perhaps silver linings here?
So far, they're all talking about essentially it all depends on, everyone's hoping that it'll be a quick strike, and they're hoping that it will take much less time than previous ones, because in the past, in 2008, we had a 50-day strike, which that would be estimated to cost between $3 and $3.5 billion in cash flow. But essentially, if it was shorter, that might have a less of a financial impact, as well as it be able to get production quicker and sort of get back going. Otherwise, you have to wait much longer to get production and deliveries back on track.
And just when it comes to production, this is a work stoppage in the Seattle area factory. Which aircraft is this factory responsible for?
So this stoppage affects the 737, it affects the 777, the 767. The aircraft that isn't affected as much is the 787, but then Brian West, the CFO, did talk about how the 787 production is lower, it's basically below 5 a month because they're facing shortages of parts, including seats. Yeah. So many problems for Boeing at the moment.
Absolutely. Sid Phillip, thank you so much for bringing us up to date on the latest here. And of course, the timing couldn't be worse. We just talked about how this comes 8 months after that incident in midair where the door plug basically blew out. Boeing has been bleeding cash. Its credit rating is almost at junk status and could very well be cut. And of course, it's weighed down by $45 billion of debt as well. So what are some of the implications of this stoppage at a critical time, and where does this leave Boeing's leadership? Anita Menderita is a special advisor to the Secretary General of UN Tourism and author of The Call to Leadership, Unlocking the Leader Within in Times of Crisis. And she joins us now. Anita, thank you so much for joining us. I know that you have tallied up the numbers that show the cost of this strike, not just financial, but in terms of the extent that the work stoppage will lead to production delays. Let's start with the fact that production has basically ground to a halt over in that Seattle area. What does that mean for production delays? What do your numbers indicate?
Brilliant. Scarlett, thank you for having me. And it is a tragic Friday the 13th, I must say. We're looking at up to effectively $100 to $150 million per day in terms of losses of production. But I want to go very much to what was being spoken about just now and what the union leader was speaking about as well. This is about so much more than the numbers. It is not just Boeing that is being impacted. The entire aviation industry and ecosystem is being impacted by this. Our world needs Boeing. Boeing ultimately is part of a duopoly between Boeing and Airbus. They represent 4 out of 10 commercial aircraft that we see. Plus, of course, there's cargo as well. And we also have, obviously, the aerospace going beyond in terms of the spacecraft. So this organization represents so much in terms of aviation for all of us, quite honestly, at a passenger level, at a trade level, at a global level. So the implications are massive. It's not as if we can simply say Boeing production is going to be reduced. Yeah. The fact that this is happening with, again, the 737, that's an aircraft that's already been put pressure on production by the FAA. So this has a massive implication. Airbus cannot simply churn up and increase capacity. They're already struggling with deliveries. So this is going to have a huge implication on daily costs, on orders. If there are failures of contracts, that can be up to $1 billion in terms of operating expenses, and importantly, penalties, $10 million per aircraft in terms of the inability to supply contracts. So it truly is tragic. And really, to Kelly Ortberg, the new CEO, the 4th CEO in the last 10 years for Boeing, the spotlight is incredibly hot for him right now.
It certainly is, and I'm glad that you tallied up everything like that and really presented it as, you know, the big picture for not just Boeing, but for the industry at large. Can we talk a little bit about the supply chain? Because Boeing has a very complex supply chain, something like 12,000 suppliers. So even if this is a short strike, and there's a lot of hope that perhaps it will end within a week, maybe within a month, the impact on suppliers, as you've noted, can last much, much longer.
Absolutely. And it's already been struggling because, as you said, 12,000 suppliers, all of them already being very untrusting of Boeing in terms of the ability to recover. And they're not just recovering from the shortages of delivery. Almost 16,000 commercial aircraft were grounded during the pandemic. So all of those aircraft are trying to get back in the air, plus the new provision. We need to also keep into mind that Boeing is at the forefront of innovation when it comes to sustainable aviation. The 737 MAX is one of the leaders in terms of cutting emissions and fuel management. So our ability to reach net zero, all of global aviation's aspirations towards sustainability rely on Boeing and rely on its suppliers. So the pressure goes right through the ecosystem.
Absolutely. The new CEO, Kelly Ortberg, he has urged union members not to strike. Of course, they did anyway. He has also vowed to reset labor relations. Do we know how big a factor he was in the negotiations before the strike?
One of the great things is that he's been very visible, he's been very audible, and as he said, no one wins if anyone walks out. He needs to establish a win-win-win for Boeing, for the employees, and for the industry itself. Thankfully, again, he has been very much at the forefront of this. He needs to continue to be so, because ultimately, and again, as one of the union leaders said, this is about respect. They need to trust the new CEO. Why should they when they question, we've had 4 in the past decade. Why is Kelly different? So he needs to be very visible. He needs to be very accountable. And he needs to be human, quite honestly, and being compassionate to how they have suffered. And they also need to be understanding of how the organization, which they love, will suffer if the strike continues.
Anita, one last question to you, and quickly here. In terms of reputational damage, we know that it took Boeing a while to land upon Ortberg as its new CEO. How much grace will the board be inclined to extend to him to sort this out, to resolve this before they get impatient?
Oh, absolutely zero. He's been in the job for 1 month, and he's also already facing challenges across every single business unit. And it's understandable, again, that the business, the employees, the industry, the suppliers are impatient. Everyone is waiting for Boeing to recover. And I think that's an important part of it. We want Kelly to succeed. We need to back him. So we need to really support him very much from the point of view of withholding criticism. I think this is the few companies, Scarlett, where we've actually seen so much focus at all levels, from an audience level, from an industry level. We need him to succeed. And that's where, again, I give him full credit in stepping forward. He came out of retirement to take on this job.
Yes, he did.
He knew what he was walking into. So credit where it's due. And please, this strike does not carry on, because no one, especially Boeing employees, want to see Boeing fail.
Anita Mendarata is Special Advisor to the Secretary General of UN Tourism. She's a global consultant and advisor to many in the travel, tourism, and aviation sector as well. Thank you so much. Now, coming up on Bloomberg Markets, Uber making an announcement that is driving a significant market response. You can see there the pop in the stock. We have that as our stock of the hour next. This is Bloomberg.
In tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
This is Bloomberg Markets. I'm Scarlett Fu. It's time now for our stock of the hour. So we want to bring in Abigail Doolittle for a look at what, Uber, right?
Absolutely, Scarlett. It is certainly a big stock story on the day. And I should say stocks of the day, because it's not just Uber that's responding well to this news. We also have the shares of Alphabet climbing. Uber heading to the best day in about a month. Google or Alphabet off of its highs, but nonetheless up 1.4%. At the highs, up more than 2%. At that point, Alphabet had been on pace for the best day in 2 months. All of this, of course, having to do with that Uber-Waymo deal. This is an expansion of their relationship, their partnership that they established last year. This particular deal is an exclusive offering where the Uber app will be used for Waymo vehicles, those Jaguar I-Pace, the electric vehicles, in both Atlanta, Georgia, and Austin, Texas. Austin's interesting only because of Elon Musk's presence there, so it seems as though they're really trying to have a footstep there. But essentially, Uber will not only manage the technology of the app for the rides, but it will also manage services such as cleaning and repairing these vehicles. They're planning on the fleet in these areas to expand significantly. This deal will take place early next year. And of course, it does help Uber pivot to being a platform for commercializing autonomous cars. But Uber's already doing really quite well. If we take a look at the subscribers for Uber, this is clearly moving in the right direction over the last number of years, more than 5 years. The last quarter, more than 150 million subscribers for Uber. So you have to believe, Scarlett, that with this expansion of this exclusive deal between Uber and Waymo in both Atlanta, Georgia, and Austin, Texas, that it will help this trajectory.
Yeah, the future's coming. Driverless cars in Austin and Atlanta. Thank you so much, Abigail Doolittle. All right, coming up, we're going to take a look at Bloomberg's big take today, which is the ugly truth about student athletes getting paid, because sometimes they don't. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
What did you say to your mother and father when you said, I'm dropping out, despite the fact I said I wasn't going to drop out?
Well, I said I'm just taking some leave.
Oh, leave?
Yeah. I think I'm still technically on leave. Harvard has kind of a funny relationship
How long
with
can you be on leave? For 10 years or so?
Well, I guess we're going to find out, yeah.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg Markets. I'm Scarlett Fu. We turn now to Bloomberg's big take story this Friday, which is the floodgates now wide open for college athletes to get paid. But our reporting reveals that young athletes face a wild west of abruptly scrapped deals and huge disparities in compensation. I want to welcome now the reporter who worked for months to bring us the story, Peter Robison. Peter, really we're talking about college football here, and maybe to a smaller extent college basketball. And college football has become unrecognizable to traditional fans, right? You've got players switching teams like free agents. You've got players making millions from endorsement. UC Berkeley is part of the Atlantic Coast Conference. And all this comes down to a court decision that allows college athletes to profit off their name, image, and likeness. Is that right?
Yeah, the floodgates really opened back in 2021. That's when the NCAA let athletes profit from what are called name, image, and likeness deals. And it also changed the transfer rules, which let athletes in the big-time revenue sports move more easily from school to school. So what happened is that sort of alchemized into a de facto pay-to-play system where you have these booster groups, which are essentially the wealthiest people in town. Think the richest car dealer in town, the richest real estate developer. They get together, they pay to bring players to their school, and the university has this sort of hands-off third-party relationship. And we uncovered many cases where these athletes were promised one thing and got another, and promised big money, and then the contracts are abruptly pulled.
Mm-hmm. You described cases where players were taken advantage of. They were terminated without any notice, even though they did sign a contract. They were also promised money that never appeared. What kind of role does the NCAA or Congress play here? I know there's been a lot of hearings in Congress, but what's come out of any of that?
The big issue is that the NCAA has really lost the ability to enforce its own rules. It's repeatedly lost antitrust suits and just hasn't been able to put any guardrails around this. Congress has held a dozen hearings since 2020, and again, there's been no bipartisan legislation. And what's really missing is anyone representing the players. The coaches, administrators are professionalized now in college football. They make salaries, even the assistant coaches in college football hire agents and negotiate salaries from $400,000 to $2.5 million. And people hear about these big deals for certain college athletes, and that's certainly true. Some of them are getting these big deals. But the reporting that my colleague Noah Bucher and I did shows that the vast majority of the players are really at the mercy of these donor groups to take what they can get.
Mm-hmm.
We described a situation that was not known last year where the Michigan State Spartans actually had a near walkout before a game because the donor group abruptly pulled their funds.
Right. Peter, it's a fantastic story, and I encourage anyone to go and read it. Check it out on Bloomberg.com. Peter Robison writing today's big take, and of course it is available across our platforms. We want to stay now with the business of sports, and you might have seen viral videos of people watching football where it looks like they're standing in the end zone during a touchdown. In real life, they're actually at a venue that sells tickets to watch live sports on a screen that is, well, larger than life. The tech and the business behind this experience is called COSM. And joining us now to tell us all about it is COSM President and CEO Jeb Terry. Jeb, hi, welcome. And give us a sense of where people can see these screens or be part of the experience. Are they at, for instance, college games, or are they only at professional games right now?
Hey, Scarlett, how are you? Thanks for having me on. So we've opened up our first 2 venues in Los Angeles and in North Texas in the Colony outside of Frisco. And these are the most dynamic experiential venues we think to hit the market ever. And we're showcasing live content from the entire world of sport, whether it's college football or it's Premier League or UFC. We have Noche UFC live in our venues this Saturday. So there's some incredible opportunities for fans to come see content of all sorts, live and also in post with experiential art and cinema and a number of different programming.
It sounds like these screens need to be at certain venues, or can they be installed, taken apart, installed in different places? Are they mobile?
Yeah, so right now we're focused on bringing all of our technology into our venues. The format's called shared reality, and it's more than just the display. It's about the feeling fans have within our venue. It's being able to walk around, have great hospitality, great food, drinks, really comfortable seating, and it leverages all of our homegrown technology. Unknown fact is we're also one of the largest planetariums companies in the world. And so we're able to take this technology in sports and entertainment, also science and education, in a number of different avenues to make sure fans of all types get this incredible opportunity to experience the technology.
That makes a lot of sense, the planetarium link there. In your latest round of funding, Jeb, you raised over $250 million, and your backers include funds led by Mark Lasry, Dan Gilbert, David Blitzer. What is the status of their committing to make their games available on your technology?
Well, the key is that this growth round has helped us to realize our biggest vision, right? Our global ambition to deploy COSM around the world. And when we think about all the various partners, there's capital partners, there's broadcast partners, there's media partners, and really work within the entire sports industry and the construct as a whole to bring this vision to life. And so we're really privileged to have so many fantastic thought leaders, stakeholders, really influential people within this industry behind our vision, helping us scale and take this global.
Which live event are you most excited to see projected on your screens and using your technology?
Well, I'm biased, clearly, Scarlett, I like them all. I love American football. As a former athlete myself, it's something that's near and dear to me. But I can tell you the Premier League, when you're coming live from all various parts around the world and bringing that live locally in Los Angeles and Texas and soon to be in Atlanta as well, there's really nothing like it. I mean, this weekend we have Arsenal-Tottenham from Hotspur Stadium, and that'll be live at 6 a.m. here, and we've got a sold-out crowd. And so it's really the power to transport fans and give them that experience that's almost like actually being there.
Right.
We can never replace the feeling of being there, that energy, but we're getting close, and our goal is to make sure that we let the fans come in and experience for themselves. And it's just a fantastic energy in the room.
Jeb Terry, really appreciate your joining us today. Jeb Terry is the president and CEO of COSM. And I'm Scarlett Fu. That does it for Bloomberg Markets today. This is Bloomberg.
The names that move markets are on Bloomberg.
Don't expect we're going back to zero, because zero was the product of huge global shocks. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it will be lower than where we are today, but I think it's very clear that we're not going back to zero.
Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The top names at Jackson Hole are on Bloomberg.
Inflation's kept coming down, so in the real rate sense, we've been tightening. I think that this reflects the reality of the economy, that we've got to keep our eye on the employment side of the mandate now. This is what the path down to 2% inflation looks like.
Nobody covers Jackson Hole like Bloomberg. Context changes everything.
Bringing you up-to-the-minute technology news whenever and wherever it happens. I'm Annabelle Drawlers in Taipei, and this is Bloomberg.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Donald Trump says no rematch. Welcome to the fastest show in politics as the former president rules out another debate with Kamala Harris, who is still pushing for one. I'm Joe Matthew alongside Kaylee Lines in Washington. Welcome back, Kaylee. We missed you. I'm not sure this matter on another debate is settled yet, but we do have another policy proposal, if we can call that, from Donald Trump. No taxes on overtime.
Yeah, it seems there's a lot of things that the former president would like to not tax if he indeed takes the Oval Office again. We, of course, add this to no tax on tips, no tax on Social Security. But this very clearly is an appeal to blue-collar workers. As he says, overtime, those who work overtime are some of the hardest workers in the country. For too long, no one in Washington, he says, have been looking out for them.
That's true. And, of course, he's back to Las Vegas, where the no taxes on tips you mentioned was first floated. And I think there are a few overtime workers there, too, he'll be talking with. This all happens, of course, as the candidates get back on the trail following this week's debate and a question about whether there'll be another.
Yeah, of course, the Harris campaign is likely to continue to push for one, as polls after the debate have suggested most who watched it, and we know there was, 67 million who did so?
67.
Think that the vice president won that debate against Donald Trump, although he maintains he won. He calls himself a prize fighter.
Yeah.
That's the comparison we're drawing.
Let's check back in a couple of weeks, because I feel like we're not done with this yet.
Well, and of course, there is a VP debate still on the books for October 1st between J.D. Vance and Tim Walz. I don't think anyone's trying to cancel that at this point.
It's on, and we'll be bringing that to everyone here on Bloomberg.
Yep, just like every day, we bring a check on the markets at the top of the hour from Charlie Pellet. So let's do that now, up in New York. Hey, Charlie.
Well, hello there, Kelly, and good afternoon. Happy Friday to you both. We have got the Dow, the S&P, NASDAQ solidly in the green, but do want to begin with that developing story involving Boeing. Joe broke the news a couple of minutes ago. Boeing shares slumping right now, down by 4.25%. Boeing is at risk of losing its investment-grade credit rating at Moody's as the embattled playmaker faces the prospect of a drawn-out strike by workers that will further disrupt production and cash flow. The company's credit rating now one step above speculative grade, known as junk. Workers walked off the job in the Seattle area right around midnight of this morning. Boeing shares today down now by 4%. Stocks higher across the board, off-session highs, but still a lot of green on this Friday. The S&P, by the way, on track for a winning week, up 4% on the week now. S&P higher by 33, 56.29 where we stand, up by 0.6%. We've got the Dow up 0.8%, up 314 points, while NASDAQ is up 127, up by 0.7%. 10-year at 3.64%, with a 2-year 3.57%. Gold up 1% at a record $25.83 the ounce. West Texas Intermediate crude oil flat on the day, now $68.98 a barrel. Bitcoin up now by 2.3%. So again, recapping here, stocks rally. We got a Friday advance. S&P up 33, up by 0.6%. Balance of power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lines.
All right, Charlie Pellet in New York with a look at the markets as we close out the trading week here. Thank you so much. I'm Kaylee Lyons alongside Joe Matthew here in Washington, where it's been a pretty long week, shall we say. Of course, spearheaded by a presidential debate that took place on Tuesday, and in the days that followed, debate around whether or not a second debate would be happening. It seems, at least for now, Donald Trump does have an answer to that he says there will be no third debate. Of course, his first was against Joe Biden, his second against Harris.
I like that use of third there. That is good. I will note anyone who was with us on the late edition of Balance of Power yesterday heard our panel, Lester Munson, Kristen Hahn, neither buying it. They say there will be another debate. Just give it a couple of weeks. Watch the polls. He was talking about more than that yesterday, though. By the way, the eating animals in Springfield, Ohio, now part of the stump speech. We did go through that. He says they're now eating the geese in the parks. But he got to taxes as well. That's part of our job here. I mean, we try to talk about everything we hear. You have to clear through the clutter a little bit. We got to something on taxes for overtime. This follows, as you mentioned, his no taxes on tips.
Yeah, he was talking about this in a rally in Tucson, Arizona yesterday. Here is the proposal.
As part of our additional tax cuts, we will end all taxes on overtime. You know what that means? The people who work overtime are among the hardest working citizens in our country. And for too long, no one in Washington has been looking out for them. It's time for the working man and woman to finally catch a break, and that's what we're doing, because this is a good one. And I think it's going to be great for the country.
Donald Trump from Tucson, Arizona. Yesterday, it's on to Vegas. Tonight, Kaylee, and we bring in Gregory Cordy for more with his eyes on the campaign trail. Bloomberg senior White House and politics correspondent. Great to see you, Gregory. That's going to play pretty well, I'm thinking, when he gets to Las Vegas, where the no taxes on tips was first born.
Yeah, we've had a number of these surprise tax announcements that come seemingly randomly in the middle of Trump rally speeches. You know, if you've ever watched a Trump rally, which Trump wants us to do, and now Kamala Harris would like us to do as well, you know that they can sometimes be a stream of consciousness, right? And so when we get a brand new policy proposal like this, it's a little surprising to us.
Does the campaign know it's coming?
I would have to think so. Okay. If you take Trump at his word, he said he talked about this with some economists who think it's a great idea. I will say I don't think that that opinion is going to be universal among economists. Remember that part of the reason why Congress passed the Fair Labor Standards Act in the first place to require time and a half overtime was a concern that if employers can make their workers work 80 hours a week, that's a whole nother job that somebody else doesn't get. And so if you create incentives for workers to work more overtime, that could have an effect on the overall employment picture. Not to mention the budgetary effects. Now, we haven't scored this one yet, but at Bloomberg News, we've looked at every single tax proposal that Trump has put forth, and it tallies up to more than $10 trillion over the next 10 years of adding to the deficit. That's the no tax on tips, the extension of the Trump tax cuts from the Tax Cuts and Jobs Act of 2017, and also the no taxes on Social Security. That's another proposals he's made, and reducing the corporate tax rate down from 21 to 15%. That's a lot of tax giveaways that he's given out, and we still have almost less than 2 months till Election Day.
Well, and of course, his campaign and other Republicans will argue growth will help offset some of that in spending cuts. Though by our own calculations, there is not going to be enough non-defense discretionary spending over the next 10 years to actually pay for that, even if you cut it all to zero. Kamala Harris, on the other hand, does want some similar tax cuts. She, too, is supportive of no tax on tips. She has ideas of how to pay for that, raising the capital gains tax and raising the corporate tax rate, for example. Do we expect she might come around to this no tax on overtime as well? Because Donald Trump said no tax on tips first before she adopted that.
A day later.
and that's something that Trump will point out with some regularity, that he views the Harris no tax on tips proposal as a copycat. Technically, there are some differences. She would not eliminate the tax on payroll taxes. That's Social Security and Medicare. She would limit it to make sure that it's really just those hospitality and service workers that traditionally have been tipped. There's some concern that under Trump's proposal, hey, all of us here at the table can go to our employer and ask Bloomberg to pay us in tips or overtime or whatever it is.
Put a tip jar on my desk.
Can we do that?
There's some displacement of salary into tips, or salaried workers into hourly workers under this overtime proposal. So there's a lot of concerns about that. Trump's no tax on tips proposal we polled in our swing states poll last month. It was extremely popular and bipartisan in the popularity of that proposal.
I think Maya McGinnis's group scored just on tips alone. It was between $100 and $200 billion in deficit spending. To your point earlier, you add all this stuff up, and this is another situation of a ballooning deficit. But that is something that both campaigns potentially have in common. They haven't told us how to pay for this stuff. Donald Trump says, drill, baby, drill. We'll bring prices down, and we'll put Elon Musk to work. We'll find waste and fraud, and then we'll grow out of the rest of it. But economists don't speak that language, do they?
Well, this is a 40-year-old debate that we have, probably even older, about the Laffer curve and
Right.
whether or not you can grow yourself and you can have some supply side.
The argument is, if there was no pandemic, by the way, that the tax cuts would have paid for themselves. That's what you're hearing from the campaign.
That is an argument, but even that would have not closed the deficit, right? Correct. I mean, so at some point, if you are a deficit hawk and a debt hawk, you have to look at not just maintaining the status quo, but beginning to reduce the share of the deficit as a share of GDP. And so, yes, Trump thinks we can grow our way out of it. And conversely, on the Harris side of the equation, to tax the rich enough to offset it. I don't think the math works on either side. But this is a problem that, as you point out, Maya McGinnis and the budget hawks that are out there have, that neither side is really particularly serious about the national debt anymore. We're all sort of, whether you call it that or not, there's modern monetary theory sort of rearing its head into these economic proposals.
All right, Bloomberg's Gregory Cordy, thank you so much for joining us. We should tip Gregory every time he comes into the studio.
Man, that's expensive. We use them a lot.
Does it hit for us? I know you're very kind to join us here on Bloomberg TV and radio. Always, Gregory, appreciate it. And as we consider who these policies are really aimed at attracting, this specifically, no tax on overtime that Donald Trump is now talking about, trying to get to the blue collar vote. Right. And we know that it's probably the blue collar vote in a very small number of states specifically that this is trying to target as the candidates compete in the battlegrounds extensively.
They're in those states right now, aren't they?
Indeed.
It's Pennsylvania, it's Michigan, it's Wisconsin. It's exactly where they've been spending the bulk of their time. But as we mentioned earlier, he's in Nevada later, Las Vegas, where you've got organized labor, the Culinary Workers Union. They're going to like this storyline too, I suspect.
Yeah, and of course, Georgia is still in play as well. And that's where we go next as we turn to Andra Gillespie, who is a professor of political science at Emory University. Welcome back to Balance of Power, Andra. It's great to have you. If we could just take a look at Donald Trump's proposal in isolation for a moment, this notion of not taxing overtime hours for blue-collar workers, is that a policy that could actually garner him more support? Does that work?
Well, I mean, I think he's trying to appeal to lowering taxes of working people. I think in all of the proposals that have been made about reducing taxes, eliminating taxes on tips, eliminating taxes on Social Security, I think the bigger question is this legislatively dead on arrival? Like, these are decisions that presidents cannot make unilaterally. These are decisions that are going to have to go through Congress in a tax bill, and I think it would be a question of, could this get through a divided Congress if neither party has control of the Congress, and if it turns out that we have divided government where the executive and the legislative branches are controlled by different parties, does this have any chance of passage? And so I think the deficit discussion that you've been having is an important consideration, and some that folks would likely bring up. And there still are members of the Republican Party in particular who are concerned about deficits, and they may raise some objections to this part of the proposal, especially now that it's become even more expansive.
It's interesting you make that point, Andra, because Donald Trump has gone out of his way to make part of his pitch that he doesn't need Congress to do all of the things that he's proposing. You're right. Tax policy is going to be a knockdown, drag-out fight in Congress here, and it'll be interesting to see how that plays depending on who wins the White House. But when you're talking about tariffs, when you're talking about the greatest mass deportation in American history, as he calls it, or world history, whatever that may be, he does not need Congress for that, does he?
So there are some things that he might be able to take care of through executive order, but even there, separation of powers is likely to come into play, because there is very little doubt that if he were to try to enact some of these things unilaterally, that there would not be some type of judicial intervention where folks would try to go to the courts to try to enjoin him in some way, shape, or form. We can look as evidence of that the Muslim ban that he instituted shortly after he took office in 2017. There were lawsuits, they were enjoined. It did get all the way to the Supreme Court. And the policy that ended up going into effect actually looked a little bit different than the one that President Trump issued when he first issued that executive order right after he was inaugurated as president.
Well, we may or may not hear more on this policy and others from Donald Trump on a debate stage in the future, or Kamala Harris for that matter. If Donald Trump is to be believed right now, Andra, there will not be another debate that happens between these two after Kamala Harris widely was perceived to have won the one that took place this week. How soon should we expect that to be borne out in polls, if at all?
Well, there have been some polls that have come out, in the last day or so. And so what they're suggesting is that this race is still a statistical dead heat. So it doesn't look like Kamala Harris has had a significant enough bump that you could actually say that this was a boon for her. And so I think the larger question, as I know some of your earlier guests have said, is what do the polls look like in a couple of weeks? And then I think that there would be a question of how much fallout does Donald Trump have to take from his decision to not engage in the debate? Could he get baited by Democrats calling him a coward or a chicken? Or does he see some type of shift in the polls that would suggest that he absolutely needs to debate? I think, one of the things that's really interesting is that Donald Trump has usually been pretty effective in being able to spin things in his favor. And so the excuses that he's made for not wanting to debate by declaring himself the winner and saying that only losers want rematches, has struck me as actually pretty contortionist in their point of view. I know that his supporters, will go along with that point of view and start echoing it. But if it looks like it's going to start to hurt him, we might hear him talk about how he has changed his mind and then try to tell us that this is what he thought all the time. So, I think it's largely a function of Donald Trump really being allowed to have free reign at the spin. But if it starts to not work, then we might see him pivot, as we've seen him pivot on other issues.
Interesting. Andra, while we consider what's happening in Congress right now, the big talk is about whether we'll have a government shutdown later this month. No one seems to think that's going to happen. But there's an important event that's underway this week in Washington, a big annual event for the Congressional Black Caucus. They're holding their legislative convention right now, and we've been having conversations with some of their members over the past couple of days, including Congresswoman Jasmine Crockett, the Democrat from Texas, joined me last evening on the late edition of Balance of Power to talk about the CBC's priorities moving forward in this Congress and what might emerge next year. She reached for the issue of voting rights, of voting reform. Here's what she said.
For me, on day one is voting rights. That is my priority all around, because if we can stop some of the gerrymandering, because we have lost the Voting Rights Act in so many ways. We only have Section 2, and it's hanging by a thread right now. And when we're talking about making sure that in states like Texas, we have representation that is actually reflective of the will of the people, we can solve so many problems.
Andra, does the John Lewis Voting Rights Act see the light of day again if Kamala Harris gets elected?
Well, it really will depend on what the balance of power is in Congress. If Republicans control any chamber, it's still not going to go anywhere. And it's still also important to keep in mind that in the Senate, you would have to sort of break normal rules in order to allow majority votes. So as I would understand it, I wouldn't expect that vote would be able to survive a cloture vote. So I think that, it's pretty grim. We're not looking at, even if Democrats are able to maintain control of the Senate, we're not looking at them coming anywhere near a 60-vote majority. And so even if they had the majority of the House of Representatives, it would still be highly unlikely that they would be able to get it through the Senate, as was the case in 2021 when they were first pushing this through.
Andra, we just have a minute left, but before we let you go, as we consider the majority of the House of Representatives, if the government shuts down at the end of this month, what is that actually going to do to Republicans' electoral odds?
So I'm assuming that Republicans will be concerned about that. And I think it will be a big question about how Democrats actually choose to use that for their event. If this were happening a year ago, there would be time for the party that is blamed for the shutdown to recover from that. But happening so close to a national election, I find it hard to believe that Democrats wouldn't try to make hay of the situation and try to blame government dysfunction on Republican control and try to make the case in swing districts and in districts where Republicans are vulnerable, that the Republican Party should not be in charge of a chamber at this point because they are being overrun by extremists who don't want to get anything done. And so I think that those are the optics that Mike Johnson is trying to navigate, and part of the reason why he's been trying to, get this done as quickly and efficiently as possible.
All right. Well, we got 18 days to figure it out. Andra, great to see you. Andra Gillespie, Emory University, and a smart conversation as always here on Balance of Power. I'm Joe Matthew with Kaylee Lyons. This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
What did you say to your mother and father when you said, I'm dropping out, despite the fact I said I wasn't going to drop out?
Well, I said I'm just taking some leave.
Oh, leave?
Yeah. I think I'm still technically on leave. Harvard has kind of a funny relationship
How long
with
can you be on leave? For 10 years or so?
Well, I guess we're going to find out, yeah.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg, and we begin with a developing story. United States steel shares surging the most this year after the Washington Post reported that President Biden will not immediately move to block Nippon Steel's takeover bid. The newspaper says while Biden does remain opposed to the deal, a decision on blocking it is unlikely in the short term and may not be made until after the presidential election. Right now, we've got U.S. steel shares surging by 5%. The potential acquirer, Nippon Steel, up now by 1.5%. We have got the Dow, the S&P, NASDAQ all holding on to gains. The S&P, by the way, on track for a 4% gain on the week. Higher now by 37 points. 56.33 is where the S&P stands, up 0.7%. Traders are reviving prospects for a half-point Fed rate cut next week. The Dow up 350, up 0.9%. The NASDAQ Composite Index up 139, up by about 0.8%. A substantial rally for small cap shares, with the Russell 2000 index today advancing by 2.5%. 10-year 3.64%, the 2-year 3.57%. Gold up $26 the ounce to $25.84. That is a record, higher by 1%. And West Texas Intermediate crude now retreating, down 0.4%. WTI 68.72 for a barrel of WTI. MicroStrategy has bought another 18,000 Bitcoin for around $1.11 billion. MicroStrategy shares surging by 7.6%. Bitcoin today up 2.5%, now at 59,653. Recapping stocks higher. S&P up by about 0.7%. Balance of Power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet in New York, thank you so much. Joe and I indeed are broadcasting live on Bloomberg TV and radio from Washington, where a lot of the conversation has actually focused on the town of Springfield, Ohio. Part of this is a result of what's been happening online and the propagating of misinformation around Haitian immigrants eating pets in Springfield, but of course it actually made its way onto the debate stage. Donald Trump himself talked about the eating of dogs when he was sharing the stage with Kamala Harris in Philadelphia. And we're seeing a real impact of that now, as once again, the Springfield City School District has had to close schools today, according to school officials, one middle school and evacuated 2 elementary schools because of threats that local police were informed of. And this is something that the president, Joe, is now addressing from the White House, saying there is no place in America for this. It has to stop.
This is not something we showed up at work looking to talk about again. We did talk about it on Tuesday night when this came up in the debate. Having heard about this, J.D. Vance said it, had said it earlier in the day. The fact that the president went there knowing that Laura Loomer was with him on the plane to Philadelphia had some folks scratching their heads, but okay, we move on. It was debunked by ABC News. They were criticized for doing that in real time. But it has now become part of the stump speech, Kaylee. This wasn't just a one-off during the debate with Kamala Harris. It came up again last night in Tucson, Arizona, expanding it to a whole new species. Here's Donald Trump.
Recording of 911 calls even show residents are reporting that the migrants are walking off with the town's geese. They're taking the geese. You know where the geese are? In the park, in the lake. And even walking off with their pets. My dog's been taken. My dog.
He says they're taking the geese in the park, in the lake, not just the cats and the dogs. Let's round up our panel right now. Jeannie Shanzano, Senior Democracy Fellow with the Center for the Study of the Presidency and Congress, Bloomberg Politics contributor, of course, Iona University political science professor. Maura Gillespie is here as well today. BlueStack Strategies, Republican strategist and veteran of John Boehner's Speaker's Office. Jeannie, I'm going to start with you on this because, look, it's people laugh, it's wacky, it's funny for some people, but there are some real racial undertones here, aren't there? What's the point that Donald Trump's trying to make?
There absolutely are. First of all, it's hard for me to wrap my head around here. And Kaylee and you talk about pets being eaten by migrants. I still, what are we, 72 hours in? It's hard to wrap my head around. But here we are in American politics. And, absolutely, there is enormous racial undertones to this. But the reality is this is what Donald Trump has trafficked in for many, many years, and quite frankly, successfully. I was at Trump Tower when he came down the escalator and announced in horrific language about immigrants in 2015 in the race for 2016. This is the same thing. He garners attention. I remember we all said after that, boy, he doesn't have a shot in heck of the nomination, let alone winning. And there he went. So this has been a winning strategy for him. He is using it. President Biden is right. There is no place for it. And yet here we are. So it is up to the American public and voters to say there's no place for it, because as long as he is successful in these races, he continues to do this.
But Maura, if it was a winning strategy in the past, does that automatically make it a winning strategy now, especially when he was seen as having lost the debate by most Americans who watched it against Kamala Harris? Is this really what he needs to be pushing right now?
No, and I think that what you're seeing is, again, he's only playing to the MAGA base. He's not playing to win. He's not playing to reach people who are in the middle and maybe still undecided. This is not going to sway them to vote for Donald Trump. He's coming across largely on Tuesday night as unhinged. And when you're faced with a decision about who to put in the Oval Office, it's not just about that person, but who they're going to put around him. And so for many people who have said, are you better off now than you were 4 years ago and things of that nature? Well, when you think about those first few years during the Trump presidency, maybe you do feel like your life was better then. It was pre-COVID, so maybe you do feel like your life was better then. But I also would caution people to remember who was around him at that time. And largely most of those people who are in his cabinet or in his orbit have neither, left, were fired because they told him no, and he then replaced them with yes men, or are out there saying that he should not be anywhere near the White House. So I think, to only play to one portion of the Republican Party, and especially in such an extreme manner, is not an effective strategy for someone who would actually have wanted to win the White House. It's not helpful to down ballot races either.
You think about these families and the impact, the real impact that it's having in Springfield. As Kaylee mentioned, Jeannie, the Springfield City School District closed a middle school, Roosevelt Middle School, and evacuated another Perrin Woods and Snow Hill Elementary School as well this morning after they got bomb threats via email. Cliff Park High School outside of that district was also evacuated. They're now working with the Dayton FBI office to find the source of this stuff. There is a very clear and real example here of what the rhetoric can lead to, right?
There absolutely is. And this is the danger of this. It takes one person to react to this kind of obviously, clearly false statements and stories, to spread that disinformation. And this is why leadership matters, because leaders like Donald Trump have to be responsible and to lead us in a more positive direction. He is not doing that by spreading this information. That is clear. But the reality for Donald Trump is he's seen it be successful in the past. He believes it will be. And as long as he continues to believe that, he is not going to stop. And this is where, to Maura's point, we need other leaders on the Republican side to stand up and say enough is enough. We've seen that from Liz Cheney. We've seen that from Dick Cheney. We've seen it from Mike Pence. We've got to see it from others, including former President George W. Bush, who took a hands-off approach. They have to stand up and say, we aren't going to countenance this anymore. That's the only way. In addition to Donald Trump losing another election, and the Republicans may get tired of that if it happens.
I would point out, Jeannie and Maura, for our audience here on Bloomberg TV and radio, that Donald Trump right now is giving remarks to the press in Los Angeles, California. He's opened them by saying he's here in California with a simple message for the American people. We cannot allow Comrade Kamala Harris and the communist left to do to America what they did to California. As we consider the messaging we're getting from the former president, Maura, he also has weighed in on the happenings here in Washington in recent days, suggesting that House Republicans, who of course are trying to avert a government shutdown 18 days from now when funding expires, should indeed shut the government down if they don't get election security through along with it. The SAFE Act, of course, what we're referring to here, making illegal something that already is illegal, non-citizens voting. Do you believe this Donald Trump, who is speaking right now, actually wants to see the government shut down as he is trying to win election?
Again, I think it proves my point that he doesn't actually want to win, because everyone in Washington and otherwise would know that a shutdown right before an election is political suicide, quite frankly. It's not something that anyone wants to do. They are down to a matter of weeks before that happens. And to take this stance and take this position of, get everything you want or don't do anything at all is not how Congress works. And again, it shows the downside of having somebody in politics as the leader of the Republican Party who doesn't actually understand how it works. And I think that that's a detriment to what Mike Johnson is trying to accomplish, and other leaders on Capitol Hill who are trying to make something work that they can get through to avoid this situation that both sides know would not fare well for them politically, but in the polls, but also come election day.
Well, Laura, you worked for the Speaker long enough to have a better sense of how this stuff works than most people behind the scenes in the House. You don't really think the government shuts down, do you?
No, because they're not going to want to risk that potential. Because again, yes, the most of the focus of the media and American people are focused on these two choices, Kamala Harris or Donald Trump. But for Congress, what they're really focused on is, okay, we need to get things done and then go home to our districts and tell them why they should reelect us. And it's really important because Mike Johnson wants to grow his majority, which is very, very, very thin. And Senate Republicans feel as though they have a chance at flipping the Senate. So if they want to accomplish those goals, they actually have to show that they've gotten something done. And, you know, this week they've been focusing on China, but no one's really talking about it. And that's because all the oxygen in the room is constantly being taken by Donald Trump. Not to mention the fundraising dollars are also being taken by Donald Trump. So really, Republicans down ballot have to separate themselves from the former president because he's hurting them in so many ways, from messaging, from fundraising, and just getting things accomplished to actually come out with a victory in November in just a matter of weeks. Yeah.
I want to mention one Republican, the senator from North Carolina, Tom Tillis, just out with a post on X about someone who is seemingly getting closer to Donald Trump, has been traveling with him, in fact, this week. Laura Loomer. He calls her a crazy conspiracy theorist who regularly utters disgusting garbage intended to divide Republicans. A DNC plant couldn't do a better job than she is doing to hurt President Trump's chances of winning re-election. Enough, Senator Tillis says. Jeannie, of course, even Marjorie Taylor Greene has had some words for Miss Loomer this week. Is that actually having this effect, Donald Trump being surrounded with people like her?
You know, I don't think it takes Donald Trump being surrounded by other people for him to act the way he's acting. He purposely chooses to have her in his orbit. Tillis's statement is 100% right. But this gets back to what you were just talking about with Maura. Donald Trump is not concerned about the Republican Party or the nation. As Kamala Harris said, he's concerned about himself and his future. This is a man facing jail time right after this election. He needs to win. Why is he willing to have the government shut down in terms of pushing this need for a SAVE Act? Because he wants to set the groundwork that the election was unfair. If he does lose, then he is going to do the same thing he has done after every election, particularly 2020, and say the election was stolen. So he's setting the groundwork. So I don't think it takes Laura Loomer to do that, but Tom Tillis is right. It is not a good look for the campaign.
All right, Jeannie Shanzano and Maura Gillespie, our political panel today. Thank you so much for joining us. We'll have more coming up on Balance of Power right here on Bloomberg TV and radio.
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
How can you have dinner with friends without hinting what you're thinking about. And do you ever get suggestions from your friends at dinner, this is what you should do? And how do you respond when they kind of say, maybe you should lower interest rates? You just keep eating or what?
You might define the word friend to mean doesn't ask you about interest rates. So, no, people don't do that generally. You know, people I don't know will always say, hey, cut rates. Somebody said that in the elevator this morning.
Did that influence you or no?
I said, thank you, sir. You know, and no, but I mean, you know, people say things, but you know, it's fine.
So in some parts of the society these days, people are making decisions based on something called artificial intelligence, AI. Have you thought about, you know, calling up ChatGPT and saying, you know, here's all the data we have. What do you think about would be a good idea? Have you ever thought about that, or they're not going to like you to do that?
We haven't done that. I mean, we have done little things like we've asked ChatGPT to generate questions for the press conference. And I'm happy to report for any journalists who are here that the questions were not as good as the ones we get from real journalists. So,
what about my questions? How do they compare to my questions? Okay.
No comment.
Right, so they weren't that great. Okay.
The names that move markets are on Bloomberg.
Don't expect we're going back to zero, because zero was the product of huge global shocks. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that we'll be lower than where we are today, but I think it's very clear that we're not going back to zero.
Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The top names at Jackson Hole are on Bloomberg.
Inflation's kept coming down, so in the real rate sense, we've been tightening. I think that this reflects the reality of the economy, that we've got to keep our eye on the employment side of the mandate now. This is what the path down to 2% inflation looks like.
Nobody covers Jackson Hole like Bloomberg. Context changes everything.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ pushing higher. Best level of the day. Going to begin with the Russell 2000 index because small cap shares are surging. The Russell 2000 up now by 2.5%. To put that all in context, S&P 500 index up 39, up 0.7%. The Dow up almost 400 points now, up by 1%, and NASDAQ is advancing 138 points, up by about 0.8%. 10-year 3.64%, with a 2-year that's yielding 3.57%. Gold up $24 the ounce, $25.82, up by 1%. West Texas Intermediate crude trading lower now. WTI down 0.4% at 68.68 a barrel. Cannot ignore the move in Bitcoin today, up now by 2.7%. Still below 60,000 Bitcoin right now, 59,741. Traders are reviving prospects for a half-point Fed rate cut next week, spurring a rotation into stocks that would benefit the most from policy easing. Again, Russell 2000 index up by 2.5%. U.S. steel shares surging by 4.8%, the most this year, after the Washington Post reported that President Biden would not immediately block to move Nippon Steel's takeover bid. Oracle shares trading right now, little changed. We've got Oracle up by just under 1%. Oracle says annual revenue will rise to at least $104 billion in fiscal 2029. Again, recapping stocks higher. S&P up 39, a gain there of 0.7%. Balance of Power continues, the Friday edition. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, indeed. Happy Friday. Thanks for joining us on the Friday edition of Balance of Power, the fastest show in politics here on Bloomberg TV and radio. I'm Joe Matthew alongside Kaylee Lyons. Back with us today for an important conversation, Kaylee, as we spend so much time talking about the horse race, the policy proposals, of course, the debate this week, some of the wild rhetoric that we heard on the stump in the last 48 hours. We don't always think about the job that they're working for. And the latest from David Rubenstein, The Highest Calling. We've both been curled up with this book for a minute, Conversations on the American Presidency. You start reading about all of the presidents, including, by the way, Joe Biden and Donald Trump. And I'm left with the same question. Why would anyone ever want this job?
Yeah, very difficult one. Of course, perhaps the most difficult to attain, at least in American politics and the way in which this republic operates. And of course, one that may be held differently, viewed differently by the people who have inhabited the office as you look over the history of the now 46 presidents. And 20 of them are featured in this new book. And we're very lucky to have David Rubenstein, the author, here with us. He, of course, is co-founder and co-chair of the Carlyle Group, also a host on Bloomberg Television, in addition to being an author of this book. Always a busy man. Thank you for making some time for us here in studio in Washington. It's worth pointing out, while this is in part titled Conversations on the American Presidency, it's also conversations with a number of former and even the current president. You spoke with both Donald Trump and Joe Biden when writing this book. We talk a lot about the contrast between these two men. Did you pick up on how they may differently view the office of the presidency, or was there more overlap than you expected?
They do have different views on it and how they do it. I interviewed both of them on separate interviews with Joe Biden in the Oval Office for an hour alone. And I've known him for a long time, and I think he felt comfortable with me, and I've had a lot of interactions with him over the years. I've interviewed Donald Trump before. In this particular case, he was getting ready for a trial, and so it wasn't exactly in the Oval Office that I was doing it. But I had dinner with him not too long earlier, and I'd gotten ready for the interview. And they both have different perspectives on the job, and I call it the highest calling because this is clearly the most important job in the world. Since Woodrow Wilson went to Paris to negotiate the Treaty of Versailles, it's been clear the President of the United States is the most important person in the world, with very rare exceptions. And so you have to say to yourself, why do people want that much responsibility, you ask in the beginning? And think about it. John Kennedy was assassinated. Lyndon Johnson driven out of office. Richard Nixon was in fact had to forced to resign. Gerald Ford lost re-election. Jimmy Carter lost re-election. Ronald Reagan was almost assassinated. George Herbert Walker Bush not re-elected. So you have to say, why do people want to put themselves through this? And to be president, you have to now spend 2 years campaigning, bad food, no exercise, no family contact, and it's not a wonderful thing to do. But the reason is that people who are ambitious say, I want to do something to help my country, and I want to show that I've done something useful for society, and it's the ultimate job in the world, for sure.
Then after that big fight, you get there and you realize the golden bars surround you. You talked to both Joe Biden and Donald Trump, and I'm compelled, I believe on 2 pages facing each other, Donald Trump talked about the loneliness. You asked him, what is it like to be in the White House? The loneliness. You asked Joe Biden, is this as fun a job as you thought it was going to be? He said, fun is not the word that I would use. Maybe they have something in common there.
Well, every president thinks it's lonely because in the end, every major decision that the federal government has to make, and when it's difficult, it gets to the president, because it was easy to make a decision about something they would have gotten decided by somebody else. So it's lonely, and it's said to be a very lonely job. And what Donald Trump was referring to is that in several holidays, the government was more or less shut down. He had to stay there to wait for the government to open up and maybe sign a bill. So he didn't go down to Mar-a-Lago for, I think it was 3 of the 4 years he was in the White House alone during the holidays.
Christmas at the
and
White House.
Joe Biden has spent a fair amount of time there and long hours as well. One of the reasons presidents like Camp David is you can go there, you are with your family typically, but you don't have all the Secret Service watching you every second, and it's not quite the federal prison that the White House is often called by people. Ronald Reagan said it was the high water mark of the federal penitentiary system, because when you're in the White House, everybody watches everything you do. You can't walk around outside. It's a very complicated and lonely job. But again, many people spend time trying to get there, and a lot of people want that job.
Well, and Joe Biden wanted to keep the job up until just recently. You spoke with him in April of this year, so he still was attempting to seek a second term at that time. Do you think the tenor of your conversation would have been different had he already made the decision to not seek re-election and endorse Kamala Harris?
Probably, sure. He thought he was going to be the nominee of the party, and he wanted to be the nominee of the party, and obviously events unfolded. When history of this election is written, the two most consequential decisions, I think, will be Donald Trump's decision to do an early debate, because by doing an early debate, he in effect knocked Biden out, and therefore he now has an opponent that might be tougher. And Joe Biden's decision to ask for an early debate, because had he not had an early debate, and the debate was in September, October, it would have been too late to have him replaced, probably. Yeah. So both of them will probably look back, depending who wins, and say, maybe I shouldn't have had an early debate.
You dedicated this book in part to Ted Sorensen, which is fascinating to me. Of course, the force behind, as we've learned, profiles and courage, but also JFK's inaugural address, the "We Choose to Go to the Moon" speech. Before you joined us, Kaylee and I were talking about migrants eating animals in Springfield, Ohio. What would Ted Sorensen make of the rhetoric on this campaign?
Ted Sorensen, for those who don't know, was a very young aide who worked for President Kennedy, before that for Senator Kennedy, and he was the person who was probably very involved in writing, let's say, Profiles in Courage. Yeah. President Kennedy, or then Senator Kennedy, was ill, probably difficult to write too much of it himself. And then the inaugural address, which I think was the greatest inaugural address of my lifetime, was written in large part by Ted Sorensen. And I admired him. I didn't think I could be a candidate. I wasn't rich enough, smart enough, handsome enough, charming enough to be a candidate, but I thought I could be an advisor. And so he was the person I went to work for when I began practicing law in New York. And I greatly admire him. I was just with his widow the other night when I was doing a talk about this book in New York. And, Ted was an inspiration to me, because he knew how to write in a way that very few people have been able to do since then. He just had a way with words. And if you think of the inaugural address that Kennedy gave, ask not what your country can do for you, but what you can do for your country. Those are words that, are going to ring with us for the rest of our lives.
Would he see this as a world in which political rhetoric has regressed, though? These are poetic, iconic speeches you're talking about. Turn to 2024.
We don't value presidential rhetoric in quite the way that we probably used to. Yeah. We used to talk about great presidential speeches. Lincoln's second inaugural address, FDR's inaugural address, the first one, or Kennedy's inaugural address. Today, we often don't focus on the rhetoric as much, or the speeches, because the craftsmanship is not quite as fine-tuned, but there's not as much emphasis on it being fine-tuned. People just want to know, what is the president going to do? What's he going to do for me? And that kind of thing. And it's a different world. Remember, when John Kennedy gave his speech, inaugural address, in those days, there was no internet, there was no social media. The evening news shows were 15 minutes. There were 3 networks, each one did 15 minutes a night, and then the only papers that people cared about were the Washington Post and New York Times. Right. There was no other way to worry about conveying ideas, and so it was a different world. Today, if you're president of the United States, you're working in the White House, every minute you have to focus on social media, who's saying what, and you have to be attuned to what's going on all around the world, and you never really are free from social media or TV networks, never.
Well, and that's one of the ways in which the office perhaps has changed as you look from George Washington to present day. One thing, though, has remained the same. Every single person you talk about in this book is a man. That potentially could change if Kamala Harris wins in November. Does that change the nature of the office once what Hillary Clinton called that highest glass ceiling has actually been shattered?
Of course. Think about it. We've had 46 men serve in this position, no women. Interestingly, when the country was set up, women weren't even allowed to vote or in any way participate in government. We obviously changed that with the 19th Amendment. It is amazing that you have more than half the population is female, but we still haven't had a female president. We may well this time, who knows? I think Hillary Clinton came as close as any woman has ever come, because had she won 1 or 2 more states, she would have been president of the United States, and we would have broken that glass ceiling.
I'd love to hear your view on this race now. Everybody wants to know what's on your mind, and I'm sure there are some things you can tell us and maybe you don't want to share, but you understand the conversation on Wall Street. What is the great fear right now when it comes to Kamala Harris? Is it the idea of taxing capital gains on unrealized gains? Wall Street seems to be more comfortable with the idea of Trump, despite a pretty well-performing stock market under the Biden administration.
Right. Well, I'll tell you what I think people think, but I don't want to say these are my views necessarily. Understood. But people on Wall Street, and remember, Wall Street generally is focused on stock market and making money and other things, not kind of values that a president might have. But they're worried that taxes will go up on businesses and wealthy businesses. They're worried that, and wealthy individuals, they're worried that the regulatory environment will be very harsh. The antitrust environment has not been favorable for a lot of M&A transactions, and they're worried that it might continue that way. They're worried that the people that she might put into regulatory positions might be tougher on business than even the ones that Joe Biden put in. So that's what they're worried about. I'm not sure I share all those worries, but I think many people on Wall Street saying, look, we have to hedge our bets, and Wall Street is all about hedging, right? So they are focused very much on the Senate, because the Senate can very well go Republican. You only need to switch 1 or 2 seats if we go Republican. And so if the Senate were to go Republican, and with the filibuster rules, I think many people on Wall Street who don't like Kamala Harris would say, well, we can block almost anything through the Senate.
Well, and that's what we have to keep reminding ourselves as we get these various policy proposals from these candidates. There is only so much they can do on their own without Congress backing them. So it's important to remind ourselves of rules that have to be followed as far as how legislating goes. I want to ask you about a rule completely unrelated to politics, though, but related to, of course, your interest in sports as an owner of teams like the Orioles. There's a new rule in the NFL that allows private equity in. Bloomberg's reporting today the Chargers, the Dolphins are now getting interest. Is this something you're looking at, David?
Well, I would say that it was publicly disclosed that the firm that I'm the co-chairman of, Carlyle, is part of a consortium that has been authorized by the NFL to buy stakes that go up to 10%. And so all I can say is what's been said already in the press. But I do think that sports have been a very attractive investment for the last couple of years. Very few people have made major sports investments and have lost money. Now, some people say it's a bubble. It can't keep going on this way. No. On the other hand, nobody seems to be running away from the bubble. And one of the reasons is that sports is now global. And because betting has occurred, and betting is now very popular, betting has fueled, I think, interest in sports. And so people are much more interested in sports than when I was a child, because there's betting involved in addition to rooting for your home team. So as you know, I bought the Baltimore Orioles, or control the Baltimore Orioles with partners recently. And I'm now learning the ins and outs of what it means to be a sports owner. And, you know, every time we win, I'm feeling deliriously happy that and when we lose, I feel like it's a dagger in my heart. And so, you know, I wish I was a junior, I was a Little League All-Star when I was 8 years old. And I feel like going into the players and say, look, let me tell you what I learned when I was 8 years old about how to hit or how to pitch, but they don't seem that interested.
We only have a minute left. I'm a huge fan, I know you are too, Kaylee, of peer-to-peer. I know what my favorite episodes are. What's been your favorite interview in this experiment?
When I did Oprah, it was pretty interesting because she said, to be a great interviewer, she says, I'm not a great interviewer, I'm a great listener. And she's right, because you have to learn what a person is saying and then pivot. And that was really interesting. I did George Bush and Bill Clinton together one time, and that was, I think, really good. And Warren Buffett was great when I did him. So I like all my interviews, just like I like all my children, right? So I don't think anyone is more of a favorite. But what I like the best is when I know the person reasonably well. Yeah, right. And when I have, you try to use my sense of humor, they play along with it. You know, when somebody doesn't pick up that I'm asking a joke, it's not as much fun. So like when I asked one time Bill Gates, do you think if you had a college degree, you might be more successful in life? He didn't get that it was a joke, and he gave a serious answer. So, you know, I like people that can pick up on the joke sometimes.
That's great. The humor goes a long way around here. I have to say, by the way, the McDonald's CEO, why does the Coke taste better at that? I learn something whenever I watch Peer-to-Peer. David Rubenstein, a great treat to have you at the table. Congrats on the book. It's called The Highest Calling, Conversations on the American Presidency. Great to have Kaylee Lyons back, too. We'll see you at 5 right here on Bloomberg TV and radio.
Earning.
business. I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everybody, live on radio, TV, YouTube, Bloomberg Originals. This is Bloomberg Business Week. Carol Masser along with Tim Stenivek. And let's get to the setup on this Friday, the 13th.
Okay, you're going to say this, Carol, because every Friday the 13th when we anchor together,
I know.
You talk a little bit about some concept about people who are afraid of Friday the 13th. I can never pronounce it.
Triskaidekaphobian. Investors. I wonder if they're worried.
Sounds like a delicious cracker.
You know, I lived on the 13th floor in college.
They had that?
But it wasn't. They made it 14. But so you came off the elevator and there was this big word, triskaidekaphobia, because we just wanted to remind everybody that you were actually on the 13th floor.
I did see a black cat on the way home yesterday. I thought of you because you said it yesterday.
And?
I'm fine. All is good. So far, day's not over.
Well,
Day's young.
I do wonder, you've got a bit of an equity rally underway. I do wonder, though, if investors are thinking, wait, what are we going to get from the Fed? Is it 25 basis points? Is it 50 basis points? And if it's 50 basis points, is that because the U.S. economy is coming undone? So am I a little nervous?
We got Mike McKee in Ira Jersey talking about that in just a few minutes. Our countdown is on to next week's Fed meeting, what the debate is really all about right now.
Yeah, plus we're going to get into SpaceX's tiny little rival. It has soared about 1,400% from trough to peak this year. We've got the president of the company that is on a mission to perhaps out-satellite Elon.
All right, well, speaking of up in the sky, Boeing shares are flying low, this as workers strike. And then we're going to get to the dirtbag of the internet. It's a most-read story on the Bloomberg terminal. All that and more over the next hour.
We're going to say dirtbag as many times as we can.
I think it's 3 so far.
All right, first up, folks, let's get a check on today's Friday trade. On Friday the 13th, here is Charlie Pellet.
All right, hi, thank you very much. And here's what's going on. We have got the Dow, the S&P, NASDAQ 100 index. Got to begin with the Russell 2000 index of small cap shares surging now by 2.1%. Traders are reviving prospects for a half-point Fed rate cut next week, spurring a rotation into stocks that would benefit the most from policy easing. S&P, to put it all in context, up 30 right now, up 0.5%, still holding close to session highs. The Dow up 282 now, up 0.7. NASDAQ higher by 0.6%. Again, Russell 2000 bears repeating, up by 2.1%. 10-year yield 3.64%, with a 2-year 3.57%. Gold up 0.9%, 25.81 a barrel, an ounce on gold. In terms of barrels of crude, West Texas Intermediate 68.68 right now, trading lower by about 0.4%. U.S. Steel advancing now by 4.7%, surging the most this year after the Washington Post reported President Biden would not immediately move to block Nippon Steel's takeover bid. The potential acquired Nippon up by 1.5%. Boeing is at risk of losing its investment-grade credit rating at Moody's as the embattled planemaker faces the prospect of a drawn-out strike by workers that will further disrupt production and cash flow. Boeing shares today, workers on strike around Seattle area, Boeing down 3.6%. Again, recapping, stocks higher, S&P up 32 now, up 0.6%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, folks, check it out. On the Bloomberg, Wall Street traders reviving prospects for a half-point Federal Reserve cut rate next week, spurring a rotation into stocks that would benefit from policy easing. There's also a Bloomberg News survey of economists that's out there who expected the Fed likely to lower interest rates by 0.25 point rate move next week, and really at each of the next two meetings that follow. This is according, again, to economists surveyed by Bloomberg News. So we felt like we had to go to the experts.
Hey, the experts are here. Bloomberg News international economics and policy correspondent Michael McKee.
No
He's
pressure,
in our
guys.
Bloomberg Business Week studio. Along with
didn't
Bloomberg.
call us the dirtbags of the internet.
Not yet.
We still have a few minutes to go. I mean, we could get there, Mike. Also with us is Ira Jersey. He's Bloomberg Intelligence Chief U.S. Rate Strategist. He joins us in Princeton, New Jersey, from BI headquarters. Mike, some economic data today, perhaps not as important as the inflation data that we got earlier this week, but it does give us certain clues on the consumer, who of course is so important to the U.S. economy. What did we get?
Well, we got import prices, which were lower than anticipated, and the numbers that economists were able to pull out of those were the final pieces of what they consider the PCE puzzle. And basically, the forecast is now at the end of the month, after the Fed makes its decision, we will see a PCE number come in lower than it had been forecast, up just 1/10 for the month. Now, the Fed can do that math too. So in that sense, it tells them.
I'm so glad that they can do that math, because I was a little worried.
Yeah, well, they got 400 PhD economists. One of them has a calculator, I think, and they can figure that
or
out.
ChatGPT.
Yeah, or ChatGPT, whatever. But the Fed knows that inflation is going to continue to go down, keeps cutting on track. And then the question is, do you cut more?
Right.
The Michigan inflation numbers, the 1 year ahead inflation number fell, and I talked to Julie Shu, who the director of surveys there, who said people are starting to feel like inflation is coming down. They believe inflation now has really come down. Price levels still high,
right?
But they're feeling better about that. And of course, we saw a little rise in the Michigan confidence numbers.
So that's a good thing, that people are still feeling confident. All right, Ira, come on in. We got through the day's economic news, but is there a clear trade in terms of what the Fed's going to do next week?
Well, it's actually less clear now. I mean, this morning, before we had a Wall Street Journal reporter coming on and suggesting that the Fed is prepared to go 50 basis points, we were pricing mostly for a 25 basis point move, and now we're priced for about a 50-50 of either 25 or a 50 basis point reduction next week. Our multi-strategy connect, which we have here at Bloomberg Intelligence, where we have anonymous chats, we had a really good discussion in there about this 25 to 50 or 50 basis points. why would the Fed do one or the other? And someone brought up the idea that, hey, maybe the Fed thinks that they should have eased in July, given the data that they've received since then. And because of that, they can, Powell can just say, hey, we're doing 50 because we should have gone before, but don't expect more. And remember, they have the dot plot to play with this time, because if they were to go 50 basis points and they only say that they're going to cut 100 basis points by the end of the year in the dot plot, that signals that they're not going to be or expecting to do 50 basis points all the way down. One last thing, Carol, that I want to mention, not everyone believes it. In fact, we have seen some great reporting from our colleagues over at Bloomberg News about some of the flows that have been going through the market. And there are people who are buying options on short-term interest rate instruments, suggesting that the Fed's only going to go 25 basis points this week and 25 basis points a meeting through the end of the year.
Ira, what would be the different signals that a 25 basis point rate cut would send to the markets versus a 50 basis point rate cut?
Quite frankly, probably not a lot. At the end of the day, what's going to be important for the long end of the Treasury market, right? So the 10-year rate and the 30-year rate is going to be where they are, what the dots show at the end of 2025, how aggressively the Fed thinks it's going to have to cut, and how bad the economy is ultimately going to become. And will they change their forecast because of that? I think a 25 just says, hey, we're not panicked about the economy. We know things are slowing, but things aren't bad yet. And I think that even if they go 50, they're going to almost have to express that same message, regardless of, because they don't want to panic the market and say, they don't want the market to come out and say, hey, what does the Fed know that we don't? And which, of course, they never know anything more than the market does. But people make that assumption sometimes.
If only Jay Powell would wear like a dead shirt, maybe like trucking to mean one thing and fire on the mountain to mean another. I know Mike McKee, just some kind of indication. Greenspan used to have his briefcases. Having said that, Mike, bottom line, all right, we're going to get through next week's meeting. Do we go back to being data dependent in terms of what happens for the rest of the year in terms of Fed policy?
Sure. You saw Chris Waller, as Ira was talking about, Chris Waller saying, if we get additional data that shows us we can front load what we're doing. We can increase the size of the cuts. So they'll be looking at that. I would take most of what the summary of economic projections puts out in the dot plot with a bit of a grain of salt. Now, I don't even report the 1 and 2 year out
because who knows?
Because it's a joke. Who knows?
Sorry, Fed.
I think they won't disagree.
Yeah.
The rest of this year will be their best guess. If they did 50 next week, then they might even then say we would skip one of the remaining ones because we want to see what happens. That's a possibility. But I really think at this point that what we got was a couple of articles, and I have to say the Financial Times also did it, not just, and the reason because I'm saying that, of course, is because Colby Smith wrote it, and she's an alumnus of Bloomberg Surveillance, so we give her props for that. But if this was indeed the Fed suggesting something to these reporters, it's probably just to bring the market into balance a little more, so that if they decide to do it, that 50, that the market isn't caught way off sides. Now, they'd still have to explain why they were doing 50.
Right.
And that brings in a whole, I was talking about what they could say, but it just makes it more complicated for them to get that message across, because then do the markets believe it, or do the markets start running away with themselves? My base case would still be 25, but it's certainly possible that they could do 50. And I think maybe what we've got is Jay Powell is thinking that perhaps they should do 50, but he hasn't got agreement from the rest of the Open Market Committee, and they're going to be discussing it over the next few days.
Yeah.
So just keeping his options open.
All right. Well,
I would note, Tim, that this also is not exactly like June of 2022, right? Where the market, like as Mike just said, hey, we're priced for 50-50, right? So there's going to be, if the pricing stays here, there's going to be a market reaction one way or the other, at least in the short-term interest rate markets. Maybe not the long end, but the short end certainly will see some action. Remember, after 2022, when we had that leak and they leaked that they were going to go 75, the market was like 80% priced for that. We're not there yet. So the market, like Mike McKee is not quite convinced that they're going to do 50.
All right, good stuff. Guys, thank you so much both. Have a great weekend. Bloomberg News international economics and policy correspondent Michael McKee here in studio. And of course, our Bloomberg Intelligence chief U.S. rate strategist, Ira Jersey. That is the eco part of our agenda. Let's get to one name on the equity side that we have definitely been following.
That's certainly Boeing. Shares are down 3.2% as we speak. At one point today, down more than 4%. So far this year, down close to 40%. Boeing also at risk of losing its investment-grade credit rating as the plane maker faces the prospect of a drawn-out strike by workers that will further disrupt production and cash flow. Carol, factory workers walking off the job for the first time in 16 years. They halted manufacturing across the Seattle hub of Boeing after members of its largest union voted overwhelmingly to reject a contract offer and go on strike. I got to tell you, George Ferguson, earlier this week when you were out, he said, this negotiation is by no means over at this point.
All right, so that's why we wanted to check in once again with him. Bloomberg Intelligence senior aerospace, defense, and airlines analyst George Ferguson does join us from New Jersey. George, first of all, we've been, anticipating this strike, long versus short. How important is that?
So I think very important to Boeing. I'm sure the machinists as well, but to Boeing, I think more so, right? A long strike really, I think, runs the risk of hurting the supply chain even more. So I think as Boeing gets into this strike, they have to really think about cash on their balance sheet. We think they're likely to burn $3.5 billion worth of cash in 3Q, probably putting them close to about $9 billion of cash in the balance sheet.
Wow.
That's about the bottom of, I think, what they need to run the company. And so I think, if they don't get workers back on lines, building airplanes, bringing cash in the door, they'll definitely have to go to the capital markets. Then they got to figure it out, right? They want to go to the debt markets. I think the rating agencies wouldn't like that for sure, right? That might push them into less than investment grade if they do that. Equity investors never like being diluted. So the cash position and some of those considerations mean, Boeing's back is sort of really against the wall here.
Well, talk to us about this. Moody's, this is about two hours ago or so. Moody's says Boeing's ratings may be cut to junk. With a company that already, you just walked us through the Boeing balance sheet, already stressed, what would that mean if it was cut to junk? And especially if it sounds like it could need to tap the capital markets, debt markets in particular.
Yeah, so I'm not the credit analyst on Boeing, but I'll tell you that, I've spent time in credit teams at BlackRock and such, so I don't know the exact spread they would get. I'd have to go play around with that, but it'll mean higher spreads, right? Which means higher interest rates for raising money at Boeing. Plus, you get into this bad game where when a company goes less than investment grade, there are some funds that can't hold less than investment grade paper, right? And sometimes they'll end up having to get that, put that paper on the market. That doesn't help prices of the debt either. So two things I think they really want to be avoiding at Boeing.
What about reputational damage here? We've talked a lot about financial damage, but what about reputational damage? I mean, at the end of the day, I think it's fair to say a lot of people would call this a duopoly, George. Is the company at risk from a customer perspective at all, or are these customers locked in? Because, Airbus is sold out of the A320 till the end of the decade.
Yeah, I think that makes it hard, right, for people to move, for customers to move. And we continue to watch deliveries every single month. And there's still a lot of core customers. We even looked at the expected deliveries till the end of the year, and it's core customers that are taking airplanes. It's Ryanair, it's Southwest, it's United Airlines, it's Alaska, it's GAL out of Brazil, it's Copa out of Panama. All good airlines. I think going less than investment grade doesn't worry them. I think they're just watching closely to see how stable Boeing is, if they can improve manufacturing, improve quality. I think that alone will keep them coming back to Boeing, like you said, due to the long stretch for A320s, due to the cost of changing airplane types in those fleets. Lots of those fleets are pure fleets, so you save money on pilot training, you save money on your maintenance pools and things like that. But I think, this is not a road that Boeing wants to keep going down. Clearly, right, when you go less than investment grade, it means risks are rising of a default. U.S. government probably doesn't want to see that. Investors don't want to see that. That's the challenge, right? Is that you got to stem it at some point.
I'm not sure if we've showed this already to viewers, and for those folks are listening on radio as well, but Boeing's revenues, we've got a chart, and it just shows how they have been declining, right, and moving lower. And I understand the reasons why. And we're bringing up the chart, and you're seeing, the last couple of quarters, this is not a trend line that you want to see. It's not a healthy trend line. What does it take to turn it around at this point?
Yeah, I mean, I think that they have in place what they need to turn it around, right? And that was after the Alaska door problem, right? They really needed to get the FAA comfortable that they were improving manufacturing, improving quality. They're going to go in and buy Spirit Aerosystems, major supplier of the fuselage in the 737. And I should step back and say, look, the 737 is, right, it's really, I think, the most critical component of this turnaround, because that's the moneymaker, the profit generator at the company, and that's where they've had their problems, right? And they've got a plan in place to go buy Spirit Aerosystems, and now it's a function of keeping that supply chain healthy enough and starting to increase the components they build, so Boeing can pull those into the factory, build more airplanes, push them out the door, and generate revenue and cash flow. Boeing is sitting, though, on $85 billion of inventory right now because they keep taking from suppliers at a 31 rate, and they're not delivering at a 31 rate, and that becomes a problem too.
Hey, George, we only have like 10 seconds left here, but back to the strike, what's a timeline that investors should understand here? How long do you think it'll take to get resolved?
I really think this is going to be resolved in a couple of weeks to a month. I just don't see Boeing able to let it go on much longer than that. I think they just have to increase the salary, increases, and they're going to have to. I think the union's going to want more guarantees on an airplane. They'll want to make the next 737.
Yeah, the CFO already talking about the goal of building 38 737 MAX jets a month by year, and will take longer due to the workers' strike. So we know that there's already some delays. George Ferguson, thank you. As always, have a great weekend. Coming up next, folks, we're going to finally get to it. The dirtbag of internet. Need we say any more? It's a most read story.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Well, I said I'm just taking some leave.
Oh, leave.
Yeah, I think I'm still technically on leave. Harvard has kind of a funny relationship.
How long
with
can you be on leave for 10 years or so?
Well, I guess we're going to find out, yeah.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The names that move markets are on Bloomberg.
Don't expect we're going back to zero, because zero was the product of huge global shocks. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it will be lower than where we are today, but I think it's very clear that we're not going back to zero.
Bloomberg. Context changes everything.
It's 2:21 on Wall Street. We do check markets all day long. Here at Bloomberg, we have got the Dow, the S&P, NASDAQ continuing to push higher. Traders are reviving prospects for a half-point Federal Reserve rate cut next week, spurring a rotation into stocks that would benefit the most from policy easing. Let's begin with the Russell 2000 index. Right now, it is up by 2.2%. Put that in context, S&P up 0.6%, S&P higher now by 33 points. We've got the Dow up 327 of 0.8%. On NASDAQ is up 116, higher by 0.7%. 10-year at 3.64%. The 2-year 3.57%. Spot gold up almost $25 the ounce, trading at a record $25.82, closing in on 2,600. We've got gold up now by 1%. West Texas Intermediate crude oil down 0.4%, 68.71 a barrel. Uber will be the sole supplier of driverless rides on Alphabet's Waymo cars in Austin and Atlanta, a boost to the rideshare app's ambitions in the autonomous vehicle arena. The move deepens the two companies' partnership, one of a string of tie-ups that Uber has struck in a bid to position itself as a platform commercializing autonomous vehicles. Uber shares, they are up by 5.8%. We've got Lyft down now by 4.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, thank you so much. Charlie Pellet there with an update on the financial markets. All right, we knew we had to do this story, no doubt about it. It is among the most read on the Bloomberg terminal. It's also because it's someone associated with former President Donald Trump and key in Trump's thoughts when it comes to crypto. All right, we couldn't say it enough today. We want to get to the dirtbag of the internet. We are going to ask about that kind of name, if you will. Is the reporter who's been looking into him, writing about him. It is Zeke Fox. He's Bloomberg News financial investigations reporter, author of Number Go Up, Inside Crypto's Wild Rise and Staggering Fall. So he follows the crypto world very, very closely. Zeke is with us in New York City. All right, Zeke, who is Chase Hero, or should we say Chase Hero, which is kind of in the story?
It is pronounced
Hero.
Yes, it is pronounced Hero, even though he spells it with 2 R's. And he's the man behind World Liberty Financial, which, I mean, just this in itself is kind of shocking. This is a crypto startup that the Trumps are promoting just, a couple months before the election. And Donald Trump is going to unveil all the details he promises in a live stream on Monday. So I decided to dig into this business partner. And like you said, he calls himself the dirtbag of the internet. And that's just the beginning of the story.
Just what every presidential candidate wants to be connected with, the dirtbag of the internet.
Well, what do we know about Trump's connection to this? What role does he play in it? What role do his sons play in it? How connected is he to it?
So here's the story from what I've heard, is that Hero, who until recently was running a $149 a month get-rich-quick class, and he's a total unknown in the crypto world, but through a friend of Trump's, he got connected to the Trumps, and Hero had a DeFi venture called Doe. Again, just one of like countless crypto startups that seem to have failed to attract much trading at all. It's a place to borrow and lend, but just only attracted a few $1 million before getting hacked. And Hero pitched them on starting a new venture that would be similar to Doe, but it's called World Liberty. And I obtained a white paper for it. The Donald Trump is at the top of the list of the people involved. His sons, Donald Trump Jr. and Eric, are Web3 ambassadors. And even Barron Trump, his 18-year-old son, who just started his freshman year at NYU, is listed as a DeFi visionary. So the Trump family seems to be, deeply connected to this. But from what I've heard, it's Hero and his longtime friend and business partner, Zachary Folkman, who used to teach pickup artist classes, like how to teach men how to hit on women. These are the brains of the operation.
I mean, I know we're having fun with this. But I feel like the crypto world. Like, we have to be careful. We've seen, when things can go astray. I don't know, the respected folks within the crypto world, do they know this person? Do they have views on this person?
Right. Like, crypto, this is an industry where, it counts as like a innovative startup if you just sell coins with a picture of a dog or a cat on them or something like that. Mm-hmm. And even in this world, crypto investors were like, we never heard of this guy. This seems super dubious. People were really excited because Donald Trump, who used to call Bitcoin a scam, he changed his position and he said he's going to fire Gary Gensler, the SEC chairman, who's the enemy of the industry, and he's going to push for new regulations that'll help crypto. So everybody liked that. And now they're like, ooh, you're going to do your own coin? No, this is a bad look. That was the consensus of the dozen or so crypto investors that I talked to.
What are they actually selling, though, Zeke? And when we look at Trump's history in business, obviously he's known for real estate, but there have been many failed businesses too. Trump Airlines, Trump Steaks, Trump University.
Casinos.
Trump Vodka, some of the casinos. Mm-hmm. Yes, no question there. We know what he was selling with those, though. It was in the name. What is he actually selling with this project?
So the details that he announces may change, but according to the white paper, this is going to be like a platform for borrowing and lending, and it's going to have its own token, also called World Liberty, I believe. And the token has some sort of use within the platform. But the way this works in crypto often is that the startup is basically an excuse to sell the token. And you're hoping that the celebrities associated with the project are famous and that people will want to buy the token because of that. And Trump certainly is very famous. And we have a great example. Trump has a stock, Trump Media and Technology, mm-hmm. that owns a social network called Truth Social. And the network has almost zero revenue, but the stock is worth something like $3 billion. So you could see how you might want to replicate that formula in the crypto world.
So to kind of build on Tim's question, Zeke, is it right about making money for the Trump family? Is it about, it's an election year, right? And the days are ticking down to the election outcome come November. Is it a way for Donald Trump to reach out to, a sector of the electorate that might find this interesting and engaging? Because he's going on podcasts that certainly maybe play to a certain audience.
Yes. If he's trying to do this as a way to reach out to the crypto world, from the feedback I'm getting, this was a mistake. And what they said is it seems more like a cash grab. And one crypto investor I spoke to said that it felt like almost Trump was asking for a favor in return after promising lighter regulations. And that's why, experts that I talked to said that it's a conflict of interest for a presidential candidate or a future president to be promoting a private company in an industry where they have a big say in how it's regulated.
Zeke, you kind of joined us at the perfect time because there's actually some breaking news around Trump Media and Technology, ticker DJT. Shares are halted for volatility after rising 13% because as Donald Trump was giving remarks in California, he said he will not sell shares of Trump Media and Technology. There was concern that as the lockup period expires next week, he would start unloading shares. He is the largest shareholder of the company, but he did say at a press conference, Carol, to reporters that he will not sell Trump Media Group shares. So it does show the power of the president to, or the former president, and Republican presidential candidate. What he says moves stocks. What he says can sell or cause people, to buy or sell.
Well, absolutely. And we should point out that earlier in the week, right, coming off of the debate, we saw the day after the debate, shares of Trump Media and Technology down about 10%, followed by the following day, another 3% decline. So him coming in and saying, I'm not selling, providing some support. But nonetheless, the stock is traded. All right. So where do we go from here? I mean, were you able to talk to Chase? Were you able to get anything from the company about what they are doing? Because it just feels like there's lots of questions, maybe not so much transparency.
Yeah, Chase did not give me an interview, and the company said that my story and my questions about it seem to be pointing in a certain direction that they disagree with, and that time will show that this is truly an innovative platform. But I just look at what Chase himself has said in past videos about crypto. I mean, I can't even read most of this on the air, but he had said that regulators should kick people like him out of the industry. He said you could sell anything if the story's right. I mean, it just seems it's very surprising to me that Trump would be starting a venture with this guy so close to the election.
It is a little puzzling given the timing. But you also write in the story about the former president's conversion to crypto believer over the last couple of years.
Yeah, so this was also shocking to me. In July, he flew to Nashville and gave a big speech at the Bitcoin conference. And in this speech, he repeated like the crypto industry's wish list of things. And he said he'd fire Gary Gensler. He said he would establish a national strategic stockpile of Bitcoins. I mean, it was a complete turnaround from what he thought about crypto before. And the crypto industry, in return or in response, held a fundraiser at this conference and raised what they said was $25 million for his campaign. And, it sort of seemed like that was the end of it. And then him and his son started promoting this World Liberty. And they're saying this is going to change the world of finance. It's going to take on the big banks. And that's why I decided to look into the background of the people involved, see if they had the kind of experience that would let them do that. And it seems very doubtful.
All right, so Monday, just to wrap up, 30 seconds here. So when the former president, Donald Trump, presents or makes some comments about this, what are you looking out for? What's kind of key that you think our audience should listen for?
Well, one thing I'll be watching for is will they actually be selling a new coin? Mm-hmm. You can start a crypto app without it having its own coin. And so if it doesn't have its own coin, then it's less of a way to make quick money. If they are selling a new coin, I want to know the details of that coin, how it works, how people are going to buy it, because it also, this model of initial coin offerings of selling new coins, this has gotten people into a lot of trouble with the SEC in the past. Mm-hmm. So if he's going to go and do that, it could set up a conflict with Gary Gensler in the near future over his own venture.
All right, going to leave it there. Unbelievable. Interesting stuff, though. Great read, as we said, among the most read. Zeke Fox, Bloomberg News financial investigations reporter. He's also author of Number Go Up, Inside Crypto's Wild Rise and Staggering Fall, joining us in New York City. We do want to mention that shares of Trump Media have resumed trading, and we're seeing the stock. Actually, did it pause again? Because it probably... I think it resumed.
Yeah, volatility trading
because it moved up. It's up. The last trade was up 25%. Again, this is coming on Donald Trump saying he doesn't want to sell his Trump Media and Technology Group shares, and that he doesn't need the money, in remarks at a press conference out there in California. More to come right here on Bloomberg Business Week.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The top names at Jackson Hole are on Bloomberg.
Inflation's kept coming down, so in the real rate sense, we've been tightening. I think that this reflects the reality of the economy, that we've got to keep our eye on the employment side of the mandate now. This is what the path down to 2% inflation looks like.
Nobody covers Jackson Hole like Bloomberg. Context changes everything.
What are your thoughts on fast fashion? It's been transformative. It gives the masses access to fashion, but there's a cost to it, downside to it.
My first notice is too much waste. I think this is also how I grew up, making your own clothes and making something that's well special and well unique. It's like timeless. And now you see that everybody is looking the same, like wear sweatshirts and wear t-shirts. And for me, it's just like when they wear something that's special, they feel empowered.
Is there a need for fashion to be more mindful of the impact it's having socially, environmentally?
Definitely.
Is it happening enough?
I think it's happening. It's gradually happening. All the designers are doing, everybody is thinking about this subject at this moment, thinking how to be more sustainable, how to be more environmental friendly.
Do you think the fashion industry is doing enough to ensure that it is sustainable? There's so many targets out there. Are they even realistic in wanting to achieve them?
I think some of them are just like they're using sustainable ideas as a marketing concept only. They're actually not really doing it. I think as a designer, it's really important to really make it happen. Every collection, I think about how to do it and how to tell the customers. I think that is our responsibility to educate our customers.
Morning from our world headquarters in New York, I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute technology news whenever and wherever it happens. I'm Annabelle Drawlers in Taipei, and this is Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We are keeping an eye on shares of DJT. That is Donald Trump's media company. Trump moments ago saying he does not want to sell his Trump Media and Technology Group shares and that he does not need the money. Those remarks coming at a press conference. DJT advancing now by 24%. Again, story we're watching, keeping an eye on shares of DJT up now by about 24%. It is Here's an update for the U.S. stock market with the Dow, the S&P, NASDAQ all advancing. Traders are reviving prospects for a half-point Federal Reserve rate cut next week, spurring a rotation into stocks that would benefit the most from policy easing. Case in point, small-cap shares, Russell 2000 index up now by 2.1%. To put that in context, we have got the S&P up by 0.4%, higher right now by 24 points. The Dow up 265, up by about 0.6%. NASDAQ advancing right now by about 0.5%. 10-year, 3.64%. The 2-year, 3.57%. Spot gold up $23 the ounce, up by about 0.9%. While West Texas Intermediate crude oil is now down by just about 0.2%, 68.85 a barrel. MicroStrategy has bought another 18,300 Bitcoin for around $1.1 billion. That according to a SEC filing by the enterprise software maker. Bitcoin up 2.7%. MicroStrategy shares, they're surging now by 8.6%. Again, recapping, stocks higher and repeating our earlier headline, Donald Trump says he does not want to sell his Trump Media and Technology Group shares. Again, shares of DJT up now by 21%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I appreciate that update, Charlie. All right, we've been talking a lot about this in the newsroom. United Airlines announcing a deal for SpaceX's Starlink to power its in-flight Wi-Fi, becoming the first major U.S. carrier to use the satellite system and giving the Elon Musk-run company a marquee customer. Now, the telecom sector and how we stay connected, it really continues to evolve, gets disrupted, which brings us to the tiny telecom company that wants to compete with SpaceX. Check this out, everybody. It has become one of the hottest stocks in the world this year after soaring from $2 to nearly $30 in just 6 months. So, Tim, let's get to the interview.
It's up another 13% as we speak today.
Yeah.
Joining us from Boston, we've got Scott Wisniewski, president of the $8.1 billion market cap wireless telecom company AST Space Mobile, the company building a global cellular broadband network in space to operate directly with standard, unmodified mobile devices. Scott, welcome to Bloomberg Business Week. Good to have you. Explain for the layperson how this technology works and how it's different from typical 5G technology that they'd get from a typical wireless operator that sends them the signal on the ground.
Well, thank you for having us today. Our technology is space-based. It's in low Earth orbit, and it functions as a sort of replacement for a cell tower on the ground. It uses today's wireless frequencies, today's cell phones, and it's backwards compatible with the 5 billion plus phones that we use today around the world. So you are a user. Our partners in the U.S. are AT&T and Verizon. If you're a customer of one of them, have a plan with them, the phone in your pocket in the future will be able to access our satellite network in space. And so we have the technology and the patents to make that work in a way that was never contemplated before because space is so far away. But we have the technology in orbit. We just launched 5 satellites this week. And the size of our satellites allow us to connect to regular, small, low-powered cell phones.
In your view, Scott, does this replace cell phone towers? Should companies like American Tower be concerned?
Well, that's an excellent question, one we often get, but American Tower has actually invested in us twice. So we're designed to supplement cellular networks on the ground. Because of physics, terrestrial networks will always be best served people that are nearby. Our towers in the sky are over 500 miles away. So we are a supplemental coverage. When your phone is quiet and has no coverage or weak coverage, that's when we come in. And it makes a lot of sense for us because we have the ability to cover half the country with only one satellite at a time. So it's a very efficient way for operators like AT&T and Verizon and the other 45 around the world that we have agreements with, who collectively have over 2.8 billion subscribers. So we're really an extension of their networks, and we were designed from the beginning to complement their networks, work with their existing technology, and work with a phone in your pocket without without you even knowing it.
All right, so supplementing, complementing, but at some point, couldn't it be that what you do be comprehensive? I mean, I think about Starlink, and they certainly seem to want to be comprehensive in terms of their capabilities. But I'm curious for you guys, American Tower might be joining up with you guys just to be prepared for kind of what's next and what might be the future rather than what they are doing currently.
Yeah, it's a really interesting question, and it gets back to what the cell companies and the tower companies have created over the last couple decades, which is an incredible network that covers most of the population. There are spots that are missed, but today's terrestrial networks are very good. So we'll never replace that. It's just a question of physics. Our satellites are the largest ever put into low Earth orbit commercially. It's over 700 square foot each. We've been flying one for the last 2 years, and we just launched 5 more yesterday.
Right.
So we are going to be able to provide a lot of coverage from a satellite perspective.
What's a lot? What's a lot? When you think about people who are using would need to tap into the service, 50%, 60%, 70%. What's a lot?
Well, we have the ability. You may be familiar with other satellite services that are starting to pop up on phones today, and those tend to be SOS, emergency, maybe some limited texting. We've tested 4G, 5G speeds to the phone over the last year, and that was a big part of the technical demonstrations we did last year with our partners AT&T and Vodafone in Europe and Rakuten in Japan. And so we've done over 20 megabits per second to the phone. But this is a supplement. Think about extra gigabytes to the phone, not your base package typically. This is an add-on for when you're moving in and out of coverage as you live, work, and travel, or importantly in the developing world, we have the ability to help really put a dent in the 2.5 billion people who don't have any cellular broadband access today. So it's really meant to be a supplement, but it is a large supplement, and that's why it's a cellular broadband network.
Scott, we said you want to compete with SpaceX, but you also rely on SpaceX. For example, yesterday you launched 5 commercial satellites atop a SpaceX Falcon 9 rocket. Explain your relationship with SpaceX here. And remember, SpaceX owns Starlink, so that's why we're talking about this.
That's right. And so what we're doing is very different from what Starlink and others have historically done, which is talking to a dish. We're standing up a brand new vertical within satellite telecommunications of going directly to the phone. And it's all about working with the wireless carriers globally. So we're not a closed system. We work with today's standard phones, which have been standardized globally and are really incredible, and we all benefit from them every day. So we're standing up a new vertical within satellite telecommunications that really looks and feels like a wireless network. And to get to orbit, to build that network, we're actually vertically integrated. We're based in Texas. We build our own satellites. It's an incredible core competency of ours and very, very important to building any low Earth orbit network. So we build our satellites ourselves. And then in terms of launching that network, we plan to work with all the major launch providers globally.
What's the toughest part of what you are doing right now? Do you have enough capital to do what you need? Obviously, investors are pretty excited about what you're doing. What's the difficulties?
Yeah, the unlock for us this year it really started in January when we announced investment from AT&T, Vodafone, and Google, and then we followed that up with investment by Verizon in May. And so for us, we're publicly traded on the NASDAQ. We've raised over $1.5 billion. We feel very good about our capitalization to achieve our near-term objectives. And so we feel good about capital. We feel great about the technology with the demonstrations we've done over the last 2 years with our in-orbit satellite.
Yeah.
And for us, it's really a race against time. We're building our satellite network as fast as we can, and our partners are very excited. And based on the hundreds of investors who traveled to watch our launch this week at 5 a.m. in the morning, they're very excited as well. I think there's a real strong latent demand for our service, and it comes from the fact that when our phone does not work, we feel it very heavy in our pocket.
Hey,
and so
super quick, 10 seconds. Do you go it alone? Is that the plan, or would you be open to linking up with someone real quickly?
Well, we're already partnered with many wireless operators around.
You know
the world.
what I mean.
So that's all we do is we need them. So.
All right, gonna leave it there. Look forward to future conversations. Scott Wisniewski, he's president of AST Space Mobile, joining us. Coming up next, we're gonna get into options insight. What are the markets telling us ahead of that Fed meeting next week?
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio and Television.
All right, quite a week. We're getting ready for the Fed meeting next week, but let's get a check on the markets.
Let's turn to Options Insight with Bloomberg News Markets correspondent Abigail Doolittle. She's with Thomas Thornton, president at the hedge fund Telemetry.
Great to have you with us, Tom. It's been quite some time. I think this is your first time back to the Bloomberg building since the pandemic, so welcome back. And speaking of the markets, we're looking at a rally. Last week, we had the worst week for the S&P 500 since 2022. Now we're looking at the best week, up about 4% since November of 2023. What's driving it, and how much is the Fed, the meeting next week, an influence?
Well, last week was the worst of times, and this is the best of times this week. And I think that it all turned around when NVIDIA, the CEO, spoke at the Goldman conference, and he gave some insight on the trends and the panic, really, with their customers trying to buy their AI chipsets. And I think that's what did it. And then zero data expiration options took hold, and the options activity with NVIDIA and some of the big tech names really drove the market higher.
Okay, so there was some real micro action beneath the surface that was driving it. Let's turn to that macro, though, the Fed, because there's a big debate at this point, in part today being stirred by the Wall Street Journal and a piece they did on the debate among policymakers about whether to cut by 25 basis points or 50 basis points. Where do you think the Fed's going to land? And if it happened to be 50, does that signal that something's wrong with the economy? Is it too much at this point?
I've been thinking 25, and I thought that if the market broke last week's lows and then, let's say, traded with the S&P 5350, then they'd go 50. But now that you have these leaks coming, and Michael McKee always talks about the leaks.
Wait, I just want to interject for a minute. So did you just say that if the S&P 500 cracked 5350, then they'd go 50?
I thought so. So.
Is the Fed supposed to be watching the S&P 500 in terms of their policy moves? That's an interesting observation from somebody such as you who has so much experience.
I do think they look at the markets, and
okay.
I do think that they look at that from a sentiment point of view. I think they want to make sure that the markets function properly, and that means going up. And if they broke last week's lows, I think there could be some, heavy selling happening. But we were under. The S&P was under last week's low for just a minute, and then bounced. And here we are, not so far from all-time highs. So we could go a little higher. And if the Fed cuts 50 basis points, it would be the same as they did in 2007. The market had an emotional reaction. It went higher. And then all of a sudden, bad news started to come into the world. And the market faded and they had to cut rates, I don't know, 10 times and QE to stabilize things.
So that's a pretty interesting thought, making the 2007 comparison, right when the S&P 500 topped out before the GFC sell-off. Are you making that consciously in terms of stocks? And let's bring, speaking of 2007, 2008, oil into the conversation, because we're certainly not seeing oil at $149. What is interesting is we basically have had a crash in oil this week, and nobody's really talking about it.
Yeah, I think that oil's been in a downtrend for a while, and I actually bought energy stocks for the first time since the beginning of the year in my fund, and energy stocks were the best performing sector in Q1, which a lot of people don't realize, but it was, and then everything fell apart. But we did have DeMarc exhaustion signals on the downside. I think things got overdone. So I'm thinking there's a mean reversion bounce here happening. And of course, energy stocks are not necessarily the place where you want to be, or crude, if there's a recession on the horizon.
Interesting stuff. So how I know that you have an options trade. It's funny. I know we've talked about a lot of options trades in the past, but you had one in particular that you liked, one way to take advantage of this situation.
Okay, I like the October expiration for XLE, a call spread. If you buy the 87 and sell the 92 strike, I think it's about $1.20. And you can make 4x on your money. I think it's a cute trade. Or X. Or X. I'll
you're
mention
throwing that out
that.
there very casually, Tom.
Yeah, well, options. It's options insight, and things work. Some don't.
So is something that's also interesting to me is gold. So we've had gold at record highs. I associate when gold goes higher, that has to do with a dovish Fed, which of course that is the expectation in rates. I mean, I almost fell out of my chair at one point when I caught up with the 2-year yield at a 357 as opposed to 5% or higher, the 10-year yield at 364. So we actually have a more normalized yield curve there. Of course, that inversion, that will signal that at some point, or signals that there's likely a recession ahead. How do you put gold into this picture in about 40 seconds or so?
Well, if you look at gold this year versus any other commodity, it's been the most resilient commodity out there. And I say that because you haven't really seen pullbacks like other commodities, and it's been really pretty steady. And I think there's been a buyer, an overseas buyer with governments buying. I think people are looking at it as an inflation hedge because we still do have some inflation out there. And it's really been low volatile. So I think that people are gravitating towards that. Now, if the Fed only goes 25, you could probably see a sell-off in gold, and we'll see, how far down it goes.
Stay tuned. Next week's going to be interesting. Tom Thornton of Hedge Fund Telemetry, thanks for joining us for Options Insight. Carol and Tim, back to you.
All right, guys, thank you so much. Coming up on TV, The Close, Tim and I continue on Business Week.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Bets for a jumbo rate cut are back, and conviction for a big stock market rotation returns. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Alex Steele. I feel like the market's like, let's go, rate cuts.
By the way, happy Friday the 13th.
Oh, happy Friday the 13th. It's going to be not a scary show. Okay, taking a look at where we are right now. You're looking at equal weighted index. I did this instead of the S&P just to show how we're broadening out in the rally. That's up 0.7%. The outperformer, Russell 2000, up over 2%. You have the 2-year yield down like a rock, down 6 basis points, and the dollar also lower. All of this points to that cut that we're going to see most likely on Wednesday. And the question is that 25 to 50 in that balancing line there, Romaine.
Yeah, I was looking at the price action on the day and on the week, and really the biggest flip-flop in markets this week was really in that geeky corner of the overnight index swaps market. That's where traders this Friday are now pricing in a definitive quarter-point rate cut for the Fed's meeting next week, and a roughly 1/3 chance of the FOMC cutting a 0.5 percentage points. That's a massive repricing from Monday when the market saw an almost near zero chance of a jumbo cut. But buyer beware.
This Fed tends to move slow. They're watching with a rearview mirror. But by November, it's going to be obvious that they should have cut. And, they'll probably do 50 in November.
And that is the backdrop for the flip-flop in equities, with the S&P shaking off what was its worst week since March of 2023 and cruising today towards its best week since potentially November 2023. Rotation graphs on the Bloomberg terminal showing strong inflows into materials, industrials, real estate, and healthcare stocks here on this Friday the 13th. There are some notable laggards out there, though. Adobe crushed after saying recurring revenue in its creative software business was lower than Wall Street expectations. Moderna coming close to erasing all of its gains from the pandemic, and Boeing down a fourth week as the embattled plane maker faces a drawn-out labor strike that could further disrupt production and cash flow. We're going to get to those stories in a minute, but let's circle back here to the broader story and those Fed cuts.
Yep, and that rotation trade. And there's one way to look at it, and you can look at it with the Russell and the 2-year, right? So the more the 2-year yield drops, the more we're pricing in some Fed cuts, either 25 or 50, you name it. Michael Feroli is still looking for 50 next week. Now, the other way you look at it is the Russell, right? As you have lower yields and you have a Fed rate cut, you have a broadening out of this rally, and this just shows that relationship. So about a year ago, you started a big differential here. You have the Russell is the orange line and the 2-year yield is the white line. They moved in tandem a little bit in the spring, and now you see the big divergence. Look at this move that we've seen in the 2-year yield, just straight down like this just in the past couple months. The Russell's had a little bit of difficulty, however, but now we're really on the upside. So if we wind up seeing yields come down, if we see that Fed cut, does the broadening out from the Russell to what you were saying, Romaine, right? Materials, even utilities, the best performing stock on the day, does that all have legs?
Absolutely. We've been here before, and that is the question of the day as we kick you off to the close here on this Friday afternoon. Urian Timmer, I'm pleased to say, joining us here in Studio 2, Director of Global Macro and at Fidelity Management and Research. Great to see you, Urian.
Good afternoon.
All right, let's talk about this great rotation. We've had a couple of great rotations this year that didn't quite stick. This one does feel a bit different.
Yeah, so it started in July, really, when we got that first sort of really good CPI report that finally put the market on notice that, okay, the Fed can actually execute on its bias to ease. And we've had this churn in the market, this big broadening, and overall the statistics look pretty good, right? I mean, about 80% of stocks are in uptrends above their 200-day moving average. The S&P equal weighted index, which you mentioned earlier, is trading at an 18 multiple. Earnings are not only growing, they're accelerating, and the Fed is about to drop the cost of capital. So this is really the opportunity, barring a recession outcome, that the market can truly broaden and the left behind stocks can finally participate.
You say barring a recession outcome. Not a lot of people are predicting recession, at least not imminently. Are you in one of those people?
So far there's very little evidence or signs that a recession is imminent. We know about the Somme rule getting triggered, of course, but so far the Fed's been able to thread the needle by reducing the excess labor demand, which of course can be inflationary, and by not producing a recession at the same time. So that obviously is the caveat, but the way I think about it, and of course we're talking about the Fed, what they're going to do next week, even if the Fed were to deliver sort of a Greenspan-like give back of some of the rate cuts as he did back in 1995, and we're in the soft landing mode, you figure a neutral policy rate is probably around 3.5, right? 2.5, 3% inflation plus a real rate spread, the natural rate of interest. And that gives the Fed at least 6, 7 rate cuts. And then it's a question of how slowly or quickly does it want to deliver those rate cuts. And my sense is that if the Fed waited longer than it otherwise might have to deliver the rate cuts because they wanted to make sure that inflation really was well behaved, at this point, if they have 150 to 200 basis points to cut, why not just go with 50? Right. So I think they're very much justified in doing 50, and they can easily explain it through that lens.
Do we need 25 or 50 for the rotation into, say, utilities, material, industrials, and also into small caps to sustain, or does it not matter just to start the cycle?
I don't think it matters. I think, at this point, with the emphasis going from the sticky inflation side of the Fed's mandate to the growth side, I think the market is seeing that the Fed has, like I said, at least 6, 7 rate cuts to go before even reaching neutral. That's not even assuming a full easing cycle, but just a normalization to neutral. And how quickly or slowly it gets there, I mean, it matters. Of course, you know, the housing market can really take some of the pressure off if it goes quicker, but I don't think it really matters. What matters is that the left behind stocks, financials, industrials, the bond proxies, real estate, utilities, can finally breathe, and that is, you know, a promising sign for the broadening trade that we're seeing unfold today.
So does gold fit in to this narrative we've been talking about when it comes to equities? I can't count how many record highs we've had in gold.
So I think gold is a play, and Bitcoin to some degree as well, is a play on the concept of fiscal dominance, right? So fiscal dominance means you have an expansionary fiscal policy, and the Fed sort of doesn't get in the way of that. If you think about fiscal dominance in its purest form, it's what Japan has done for years until very recently, and what the Fed actually did back in the 1940s. And so with the Fed now pivoting by presumably several hundred basis points at a time when the deficits are going to continue as far as the eye can see, that promises or implies that the money supply growth will be above trend in the future, and gold is very much a play on that.
Is that mostly, that demand, is that mostly coming from outside the U.S.?
The demand for
gold.
I think it's a combination of, you know, the Russian central bank, the Chinese central bank, but I think it's probably global, and you know, gold is a proven hedge against either price inflation or monetary inflation. It's also, of course, a play on the dollar, and now the dollar can weaken because the interest rate differential between the U.S. and other central banks has narrowed.
All right, Urian, great stuff, and great to see you in person. Urian Timmer, Director of Global Macro at Fidelity Management and Research, kicking us off to the close here on this Friday afternoon as we push ahead to next week. And by the time we get to next week, we'll likely have an answer to the long-awaited question: how big will the Fed's first rate cut be? We dive into whether the jumbo rate cut bets on Wall Street are just a pipe dream.
Plus, no driver, no worries. Uber expanding its partnership with Alphabet driverless tech company Waymo. What two cities could start seeing Uberless drivers as soon as the next year? No thanks.
And we continue to follow that strike at Boeing. We're going to talk about why Moody's is warning that the situation puts the plane maker's credit rating at risk. That conversation and so much more coming up in a bit. This is The Close on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg.
strike will impact production and deliveries and operations and will jeopardize our recovery. So our immediate focus is to be laser-like focused on actions to conserve cash, and we will.
That was Boeing's CFO discussing how the current labor strike will impact its production. This comes as Moody's issues a warning that the aerospace giant is at risk of losing its investment-grade credit rating. Shares of Boeing sliding right now by about 3.2%, as the company says it is willing to get back to negotiating table immediately. I want to bring in now Ben Chakanos, aerospace director and S&P Global Ratings. Hey, Ben, how long do you think until we reach a deal?
Yeah, it's not clear at this point to me what the difference or what the key sticking point is. I think probably if it's wages, there's probably a little more. It'll probably be a quicker deal reached. If it's other points, I think it could take longer. So at this point, we're thinking a short strike in the order of weeks. But we at this point we just don't know.
What do the mechanics want? I mean, the labor, yes, but in terms of planes being built specifically on the West Coast by unions, for example, where are those sticking points?
Yeah, but my understanding was that the offer included the next plane to be built in the Puget Sound area. So my understanding is that's already been was part of the initial offer.
So this gets us to a point here when we talk about this company, which we know was already dealing with its own issues with regards to its 777 and broader concerns about leadership here. When you start to see some of the rating agencies taking a closer look here, do you think we are in a position where when you look at cash flow, you look at profitability and the potential impact, how much longer does this strike have to go on when we have to really start to talk about a potential ratings downgrade?
Yeah, well, I think that there are things that a company can do. I think you heard Brian West's comments earlier today that potentially that they could raise capital, and that would certainly give them some cushion, buy them some time. So I mean, I think a combination of a quick resolution and potential additional capital would certainly improve the situation from a rating standpoint.
Are you surprised, though, that it got to this point here? I mean, we came out of a summer last year where we had seen a lot of strikes in other industries. We had seen the bargaining power, at least in this cycle, that the unions had and the concessions that companies had to make. Boeing had a chance to sort of nip this in the bud. This is a long-term contract. Yeah, 40% sounds like a lot. Why don't you think they were maybe a little bit more willing to go closer towards that number simply to get this off of the books?
Yeah, that's a great question. I think that they may have misread the level of dissatisfaction. Certainly, the union leadership may also have misread it. It's also possible that this gives them the opportunity to. They took the first offer. They have room to go up from there to show that they got a better deal. But I'm looking at the Spirit situation last summer. There was a similar initial offer rejected and came back with an improved counteroffer, and there was a quite short strike. That's kind of the best case scenario from our perspective, and not a guarantee that that's how it's going to play out, but that's one way it could go.
Oh, how long do you think the stock is going to suffer for? What's going to be a floor for this if this goes on for a few weeks, like you said?
Well, I'm not going to speculate on the stock. I mean, certainly the longer it goes on, the more cash they burn, and they were already guiding towards a pretty sizable cash burn for the year. And every day that a strike goes on, I think that the deeper that hole gets.
All right, Ben, thanks a lot. Really appreciate it. Ben Chocanos, Aerospace Director and S&P Global Ratings. Man, it's not going to be an easy time.
Yeah, absolutely. Labor issues now for Boeing, and of course, keeping an eye on potential labor issues at some of the East Coast and Gulf Coast ports here in the United States. But some breaking news just crossing the wire. This on your favorite person, Alex Steele. Sam Bankman-Fried formally filing an appeal to overturn his fraud conviction. This crossing the wire right now. The New York Times reporting that he has now filed that appeal to effectively overturn his fraud conviction. Remember, he is serving a 25-year sentence in prison related to the collapse of his cryptocurrency firm, FTX.
Apparently, his lawyer is saying that Sam Bankman-Fried was never presumed innocent. He was presumed guilty by the judge who presided over his trial. It's all about the lawyers. That's the deal.
Yeah, 102-page appeal calling for a new trial, pointing to several rulings by the judge that limited the ability for him to introduce new evidence in the case. We'll get some more details on that and bring it to you as soon as we get them. In the meantime, we want to take a deeper dive into Carvana's business model. Our top call segment is coming up next, and we're going to talk to the analyst saying that Carvana could become the next U.S. retail category killer. This is The Close on Bloomberg.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
All right, let's get a view from the sell side. Our top calls. These are the big movers on the back of analyst recommendations. And we start off today with ARM Holdings. Raymond James initiating coverage on the chip design company with an outperform recommendation, $160 price target, implying an upside of about 8%. The analyst saying ARM is well positioned to benefit from rapid growth of Gen AI in the cloud. He also expects ARM to dish out more chips for the smartphone, car, data center, and PC markets. Shares of ARM getting a nice bid on the day, up about 6%. Moderna next in line, the vaccine company having an ill day as analysts tuck tail, JP Morgan among them, downgrading the stock to underweight. The analyst saying she's not a fan of Moderna's plan to cut costs rather than raise equity, making it difficult for the stock to keep up with its peers. Those shares, which plunged yesterday, down another 3% today. And finally, let's take a look at Capri Holdings, owner of the Michael Kors and Jimmy Choo fashion brand, Citi downgrading to neutral from buy. This as the FTC here in the U.S. furthers its case to challenge Capri's merger with Tapestry. While the analyst believes the FTC's case is, quote, without merit, he does feel that the decision will ultimately have an adverse impact on valuation. Capri shares down 3% on the day. And those are some of our top calls. Now, we do want to return to a call from earlier this week on Carvana. That's the used car dealership service. Stevens rating it overweight and praising Carvana's business model and profitability. Joining us for more is the man behind that call, Jeff Flick. He's managing director and research analyst covering the auto ecosystem now over at Stevens. Great to see you again here, Jeff. And let's get right to it. I mean, this is obviously a big comeback story. I always tell people if you want to know what the best performing stock is, it's not NVIDIA, it's Carvana. But it's coming off an incredibly low base, Jeff. And I am curious as to what gives you the conviction that there's more to this stock right now than just bouncing off those lows.
Well, first off, Romaine, thanks for having me. It's great to be here. You know, interestingly enough, the used car market this year is actually down 1% to 2% in terms of units. Carvana was up 16% in Q1 and 32% in Q2. So in addition, the average profitability of a used car sale this year is down, whereas Carvana's has gone up, and there, as we point out in the note, it is the highest metric in the industry at $3,400.
What's driving that disparity? Why are people going to Carvana to buy their used cars instead of others?
Well, it's a combination of the demand and supply side of the equation. From the demand side of the equation, why people are going is it's simply a better experience. The other thing is, the old adage in the car business is, consumers don't buy a car, they buy a monthly payment. And Carvana's average monthly payment is about $475. So it's not necessarily the, Mercedes and BMW crowd, but, Carvana, as we point out a note, is selling to the masses. From the supply side, we point out Carvana's taken an approach similar to like what McDonald's did in the 50s and 60s. They've standardized the reconditioning process of a used car. I mean, people take for granted when you buy a used car, it didn't quite look that way when you bought it. There's got to be a fair amount of reconditioning that gets done. And so Carvana's actually centralized that process, and they probably have about a $500 to $1,000 per unit advantage over their competition.
Wow, that's quite a bit. So I'm guessing there is definitely a first mover advantage, obviously, for Carvana. Do they have any real competition in that area?
Well, that's the interesting thing about the used car market. First off, it is the largest consumer vertical in the U.S. at over $1 trillion. It's about 40 million units are sold a year. CarMax is the leading player, but they only have 2% market share. Carvana has 1%. The top 12 participants only make up 7% of the market. So there's not an awful lot of competition. Carvana is really competing against what we call in the note, Bob's used car lot.
So, Jeff, are there more inefficiencies then that they get to wring out, or have they kind of maximized that kind of potential and it's now incumbent on the regular used car guys to kind of catch up?
No, we think that, look, they're just getting going in a lot of areas. On the reconditioning side, there's a lot of economies of learning. It's very much like an assembly plant. We think there's probably another $500 to $1,000 there. Likely they'll give a good portion of that to the consumer. Advertising per unit, Carvana pays about $550 per unit of advertising. The average used car person, dealer might spend $300. Carvana's chosen to advertise to that level. So I think there's more to go, and frankly, there's really no one that can catch them.
Well, I'm glad you bring that up because, I mean, there are a lot of competitors out there. Obviously, you have, AutoNation and some of the other ones. Maybe they don't necessarily have the same standardization that Carvana has. But is there any sense here that they could try to play catch up, and more meaningfully, that they could do it? I mean, it's not like they don't have the deep pockets.
Well, one of the things you got to understand is, AutoNation and, for example, maybe Penske Automotive, they focus more on the 2 to 4 year old, what you kind of call the certified pre-owned car. Carvana, the average car on a Carvana site is 5.6 years old. So again, it's really catering to the masses. It's not that AutoNation couldn't choose to go over that, but go for that market. But Carvana's already there, and it's a slightly different market. Our AutoNation gets a lot of its supply from trade-ins, and again, those are the 2 to 4 year old cars.
All right, Jeff, great to talk to you, and really interesting research note here, of course, on one of the hottest stocks out there, making the fundamental case for Carvana. Jeff Flick over at Stevens. Those shares, a modest bid here on the day, but I was looking at it, it's up, 160-something% on a year-to-date basis. Off an incredible low for the company, but still, on a percentage basis, if you time this right, you're doing well.
also wonder, too, on a macro level, and I don't actually know the answer to this, if we get more broad-based tariffs on foreign imports of cars, does that help these kind of secondhand retailers, basically? And would that be even a bigger boost for Carvana because the selling prices would be higher? Like, I'm wondering how the macro kind of overlays into this.
Yeah, and then there's the interest rate equation of it, too. And I don't know how that's going to reshape the car market once you see interest rates. Does that push people more to new cars, or are they still going to sort of be interested in used cars?
What was Ally Financial that we saw this week? They said that auto loans are really struggling. So, so wouldn't that then, in essence, push them into even cheaper used cars if they had to?
So a lot of layers in this. I mean, I just recently bought a car. I mean, we bought a brand new car. And it was an interesting experience here. And I think, but we did look at Carvana and some of these sort of kind of online sellers, if you will. And there was an ease to it, if you wanted to go that route that you weren't going to get if you just walked to a lot out in New Jersey, New York, or wherever.
And you get a bigger range. Like, you get a bigger range of different items, which is why I wonder if we get like less EVs or different imports of cars that aren't able to come in, or higher tariffs, if that also helps because you have a broader lens there. All right, coming up, where will Fed rates go? Thank you for that tease, guys.
Romeo.
Thank you. We're going to wrap up this week's Eco Data and look ahead to the next week's rate decision with former Fed Governor Randall Krosner will be joining us. Also, how do you know where neutral is? I don't understand how you figure that out right now as an economist. We'll break that down with him. This is The Close on Bloomberg.
How can you have dinner with friends without hinting at what you're thinking about? And do you ever get suggestions from your friends at dinner, this is what you should do? And how do you respond when they kind of say, maybe you should lower interest rates? You just keep eating, or what?
You might define the word friend to mean doesn't ask you about interest rates. So, no, people don't do that generally. People I don't know will always say, hey, cut rates. Somebody said that in the elevator this morning.
Did that influence you, or no?
I said, thank you, sir. And no, but I mean, people say things, but it's fine.
So in some parts of the society these days, people are making decisions based on something called artificial intelligence, AI. Have you thought about, calling up ChatGPT and saying, here's all the data we have. What do you think about would be a good idea? Have you ever thought about that, or they're not going to like you to do that?
We haven't done that. I mean, we have done little things like we've asked ChatGPT to generate questions for the press conference. And I'm happy to report for any journalists who are here that the questions were not as good as the ones we get from real journalists. So,
what about my questions? How do they compare to my questions? Okay.
No comment.
Right, so they weren't that great. Okay.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
I'm
think the logic for 50 is pretty compelling. The Fed officials have basically said policy should be neutral. The risks to the labor market side are equal to the risks on the inflation side, and they're a long way from neutral.
All right, former New York Fed Pres Bill Dudley speaking just about 1 week ago right here on this show, discussing what he expects from the Federal Reserve next week here. And we are in countdown mode, just about 3:30 p.m. here in New York. The countdown to the close and the countdown, of course, to a big Fed decision, Alex.
Yeah, and also taking a look at what Bill Dudley said overnight at a conference in Asia, he's like, look, there's a strong case for 50.
Yeah.
And he's not the only one. Michael Furley sticking to his 50 call. Citi sees 25 now next week, but then they see two more 250s in November and December.
And you see that it reflected in Treasury prices, that yield curve shifting lower. And then, of course, in the options markets, where everyone, those overnight index swaps really indicating, I think right now, last time I checked, roughly about a 36-37% chance we get that jumbo rate cut.
Right. It definitely feels like we're on the line here.
Yeah.
So for more on this, let's go to Randall Krosner, professor of economics at the Booth School of Business and a former governor for the Federal Reserve System. Hey, Randy, my question is, how close do you think it's going to be between 50 and 25?
Oh, it's definitely a close call. I think the markets have it right this time. Often the markets don't seem to get it right and anticipate some wild moves by the Fed. But here, I think they really have a real debate internally of what they should do at the first step. You can look to the inflation numbers and say, hey, core PCE, which is their favorite measure, that's been stubbornly staying above 2.5% for the last 3 or 4 months. So we better move carefully. On the other side, you say, looks like the labor market is weakening a little bit more rapidly than we would like. And with long and variable lags monetary policy, we better get going. So I think that's going to be the debate around the table.
Yeah, I love that you brought up the long and variable lags. We obviously had them on the hiking cycle. Do we also get them on the cutting cycle?
For sure. And that's one of the challenges that some people would say, well, it's too late. Substantial slowdown is baked into the cake. And I do think that there will be a substantial slowdown the rest of the year, not necessarily recession, but a substantial slowdown because, as the Fed has kept the interest rate constant, inflation has come down. And so the inflation-adjusted interest rate, that is the real interest rate, has gone up substantially over the last year.
So it gets to a question, though, Randy. So when we do get this rate cut, whatever it may be, next Wednesday, Powell's still got to come out there and answer some questions. And I'm sure everyone's going to ask about the pace of future rate hikes and I guess the steepness of those hikes in the short term here. How much of his hand does Powell need to show or will show next Wednesday about the future rate hikes beyond September 18th?
I think that's really what the markets are going to react to because, they're right on the edge between 25 and 50, but it's what's coming in the rest of the year. And we'll have the economic projections, so we'll get some new information from his colleagues and himself about where things are going to be going. And so that's really what the market's going to react to. His challenge is that if he goes 50 now, it's going to be really difficult to say, well, maybe we'll just do 25 at one of the next 2 meetings. So he's kind of committing to 150. And does he really want to do that? Maybe. But I'm not sure he's completely there.
This gets to this also issue, too, that we're heading into this rate easing cycle at a time where everybody is hyper-focused right now on fiscal conditions, particularly given a big election and maybe some potential big policy changes over the next few years that could maybe exacerbate that fiscal situation. You've spent some time on the Council of Economic Advisors, had the president's ear here. I mean, what's sort of the conversation that the Fed has to have amongst themselves with regards to fiscal policy that they effectively have no control over?
Sure, that's one of the things that the Fed has to deal with. There are a lot of things outside the Fed's control. People think the Fed controls everything, but it really doesn't. And fiscal policy is one of those key things that it doesn't control. And so it has to make some estimates. It'll probably do some alternative simulations of the model. We used to call them alt-sims to look at, well, what if we get this one approach to fiscal policy? What if we get another approach to fiscal policy? I think regardless of who the next president is, I think we'll continue to have a fair amount of spending and a fair amount of and fairly high deficits. One may be larger or smaller under one president or the other, but I think they're assuming that there's going to be a fair amount of fiscal impetus in the economy going forward.
So, Randy, does that mean that growth's going to reaccelerate? Like, if we get the soft landing and we get the fiscal spend, no matter who's in the White House, do we have growth reaccelerating and maybe inflation reaccelerating?
That's exactly what they have to worry about. And growth has been reasonably good. The unemployment rate has stayed remarkably low. I mean, people are rending garments over it being in the low fours, but my goodness, low fours is a really, really good number. It's just we've been in the unusual situation of a near 50-year low for the last year. I think it's likely that we could get a 5 handle on the unemployment rate over the next 6 months or so, but it still wouldn't necessarily mean recession. That's just a slowdown, which I think would help to reduce the inflationary pressures. But we'll have to see.
I mean, 5% sounds bad. I know historically that's like nothing, but compared to where we were, that would be kind of aggressive.
Yeah, I think because I do think the economy will slow. As I mentioned, I think there's been a lot of so-called real tightening as inflation's come down, but interest rates, the Fed's interest rates stay constant. The real cost of borrowing has gone up. Also, something that's great for American households is that real wages have started to grow over the last year. But what that also means is that firms are going to be a little less sanguine about hiring people than they have before. And so I think that combination of things, plus the old fiscal stimulus that came in to really boost people's savings, we're not, they've kind of spent a lot of that down. So I think there's going to be more challenges going forward.
How much then does a rate cut or multiple rate cuts actually goose the economy? I mean, let's say we get that 100 basis points over the next few months as the market thinks we're going to get. Do you think that will have an immediate and direct impact?
It'll certainly have some impact on some asset valuations. Obviously, the stock market seems to like lower interest rates, and a lot of private equity valuations would probably go up. On the real economy, in terms of housing market and spending and investment, it'll take a little bit more time. That's where the long and variable lags come in. So a little bit on asset prices, and then a longer tail effect on the real economy.
All right, Randy, really appreciate you hopping on for us. I know you're a busy guy. Randy Krosner there, former Fed governor and now professor of economics at the Booth School of Business, setting us up here for the Fed's two-day meeting, September 17th and 18th. It seems like it's a foregone conclusion. We're getting a cut, right?
Right.
The question is, how big?
And also, do markets react now to the downside if we don't get 50 basis points?
That's what I wonder. Are we on that hopium phase once again here?
But this is what we do in financial media. We talk about something so much, and then it happens, and then nothing actually happens in the market. But now that we're sort of more on a knife's edge, do we get a market reaction to the downside?
I thought some of his comments, though, about economic conditions, particularly when it comes to the unemployment rate, that's kind of interesting, too, though. I know 5%, like you said, maybe that's not huge, but given where we used to be when we're at 4.2 now, to get to 5 in what did he say, 6 months or something?
Or at least the next year, how you get there and what that actually winds up looking like. It's interesting, though, if we go to 3, if we have a 3 handle for the neutral rate, what does that mean we have the next cycle? Like, do we go to 7% then? Do we get to 8? Like, does it get really bad later?
You're getting way ahead of us, Alex.
I'm part Irish. That's what we do.
All right, when we come back, we're going to talk about what the Fed's going to do in 2029. But before we do that, we're going to talk about Uber. Uber actually having a good day. Lyft, not so much here. The driverless future, well, it may be upon us. Uber stock rising on the news that it's expanding its partnership with one driverless tech company. It's our stock of the hour, and it's up next. This is The Close on Bloomberg.
politics to the world of business. Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I said I wasn't going to drop out.
Well, I said I'm just taking some leave.
Oh, leave?
Yeah. I think I'm still technically on leave. Harvard has kind of a funny relationship.
How long
with
can you be on leave? For 10 years or so?
Well, I guess we're going to find out, yeah.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The names that move markets are on Bloomberg.
Don't expect we're going back to zero, because zero was the product of huge global shocks. I think to get to there, something really bad has to happen that we're not currently expecting. So it'll be somewhere obviously in between. I think we've made a big point of saying policy is currently restrictive, so you can deduce from that it'll be lower than where we are today, but I think it's very clear that we're not going back to zero.
Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
All right, time now for our stock of the hour. A closer look at Uber having a great day as we learned that the company is indeed going driverless here. There was an announcement that it will be the sole app offering driverless rides using, wait for it, Waymo. Abigail Doolittle joining us right now to talk a little bit more about what's going on here. Okay, so Waymo, of course, is known by Alphabet. We talk about this is going to be very limited here. They're basically saying Austin, Texas, and Atlanta. I wasn't quite sure the time frame of when they start doing this, but I mean, what's the net benefit? I guess it's good that they've somehow locked in Waymo, which most people think is kind of the premier driverless car company out there right now. But what's the upside for Uber?
I think that the biggest upside is that they were previously planning on being in autonomous vehicles themselves, actually having the vehicles. They scrapped that plan in the pandemic, but it's an area they needed to address, so now they have this partnership. The partnership began last year, but now we have this exclusive deal for them to basically manage the Waymo Jaguar I-Path, EVs.
I-Pace.
I-Pace, okay, I-Pace, thank you. In both Atlanta, Georgia, and Austin, Texas. Now, there's so many different interesting things that we could take this. So it starts next year.
Okay.
But what's also very interesting is Austin, Texas, of course, Elon Musk. Next month, he will be doing the robotaxi event. So this is almost like a little bit preemptive. But when you compare Waymo to what Tesla's robotaxi potential is going to be, Waymo's like maybe 5,000 or 10,000 vehicles a day, rides a day. Tesla has the ability to be so much bigger. So, Waymo and Uber are really behind the curve. I think that's something around this. The stocks are clearly having a big reaction because this is something they, again, do need to address. They need to be in the AV space, but we don't know the unit economics. We don't know what this is going to do to profitability. So there's a lot of unknowns. It's a step in the right direction, but it might be a smaller step than the stocks suggest.
Romaine, yes? Questions?
But I'm so confused. So they get permission to just take this on the roads, right? And I could pick because I feel like I saw this in like Total Recall and it didn't end well.
It did not end well.
So is it I just call up one of these things and I can choose between Uber regular, Uber Black, or Uber driverless, take me to wherever?
Yes, I was under the impression that it could just show up without you requesting it, but maybe I'm wrong on that point.
Yeah, that sounds a little aggressive.
I swear, I'm trying to find it right now. Anyway, but the take rate for Uber is still 30%, which is what it gets normally. But I was talking to Mandeep Singh of Bloomberg Intelligence earlier also, and he was saying that the difference is that Uber is going to service the cars, take care of the cars,
repair them,
on the cars. So
the cost is on
Uber.
They're almost like a management company for a building in a way. But again, we don't know what the economics are.
Which they don't have to do for a regular Uber car, so that's going to definitely wind up dinging that economics.
And I had a great conversation with Mandeep also off air. I believe yours was on radio, where he was saying that they have freight that's unprofitable, deliveries unprofitable. From his perspective, they should get rid of those other businesses. They need to be an AV, but they really need to be focused on it so that it doesn't drag on profitability. he was not convinced. On the other hand, Mark Mahaney over at Evercore ISI, he's saying that this is a key catalyst, addresses the overhang. So it seems as though there's different.
Would you get in one of these
I was just about to ask you. You beat me to the punch.
Oh gosh, no. Are you kidding me?
You would.
But would you have gone into a car with a stranger like 10 years ago?
Exactly.
No.
So I would definitely. I would prefer to get in an AV as opposed to a car with a stranger.
But like you're not sitting in the front seat. Like what if something happens? Like I don't know. Isn't the whole point?
Nobody ever gets injured in the back seat.
Right? No, but I mean, like, don't you want to be in the front, like, just in case?
The safest seat, by the way, is behind the driver. Just so that we're talking about this. Yes, that's the safest seat in the car.
Use them as a shield. Abigail Doolittle, very tactical.
Tactical driver sit position there. All right, taking a look at Uber stock, definitely up on the day. All right, we are 15 minutes away from the closing bell. We're going to break down the last minute market action with Joanne Feeney, partner and portfolio manager at Advisors Capitals Management. This is Bloomberg.
Top names at Jackson Hole are on Bloomberg.
Inflation's kept coming down, so in the real rate sense, we've been tightening. I think that this reflects the reality of the economy, that we've got to keep our eye on the employment side of the mandate now. This is what the path down to 2% inflation looks like.
Nobody covers Jackson Hole like Bloomberg. Context changes everything.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning from our world headquarters in New York. I'm Manus Krenny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Bringing you up-to-the-minute technology news whenever and wherever it happens. I'm Annabelle Drawlers in Taipei, and this is Bloomberg.
market is seeing that the Fed has, like I said, at least 6, 7 rate cuts to go before even reaching neutral. That's not even assuming a full easing cycle, but just a normalization to neutral. And how quickly or slowly it gets there, I mean, it matters.
All right, that was Urian Timmer, Director of Global Macro at Fidelity, kicking us off to the close just about 10 minutes ago, talking about what else. Everybody looking ahead to the big Fed meeting and whether all of these rate cut bets that are being priced in today are actually going to be good money spent.
But you are seeing the rotation in the equity market, so it appears to be continuing on that theme, right? The S&P is up 0.5%, but if you look beyond that, the Russell is up a whopping 2.3%. In the S&P, utilities are the best performing sector, up over 1%, right? I mean, yeah, you got Adobe down, some of the tech names are down, but on the whole, it's very much of a rotation trade.
Absolutely. Here, and as we get closer to those closing bells and I guess closer to that Fed meeting, let's get some insights out of our next guest. Joanne Feeney joining us right now, partner and portfolio manager at Advisors Capital Management. And of course, Joanne, we start off with the question of the day and really of the week, and that really is, are you anticipating that we are going to get that outsized rate cut, 50 basis points, next Wednesday?
Well, the pundits certainly are throwing that possibility around, and obviously a lot of coverage of that. We are in a situation where the bet is a more dispersed one than we have seen in previous in the up to previous Fed meetings. So our view at Advisors Capital is that it's more likely that we get a 25 basis point rate cut. We don't see the need for the Fed to do anything dramatic here. It's clearly the case that the economy is slowing down. It's clearly the case that inflation has come down. So things are working, right? The Fed rate increases over the past year and a half or so have done their job. We are in a position, we think, for rates to now come down, but we don't see necessarily a reason for them to do anything dramatic because of the signaling question and the credibility question. And they don't want to potentially alarm folks and have people think, oh no, what does the Fed see in risks to the economy that we don't?
Well, that gets to the question then, too. When we talk about this rotation, we're looking at pretty massive outperformance, at least today, for the Russell and the mid-caps relative to the broader market here. How much do these rate cuts, this sort of easing cycle in totality, matter to the sustainability of that rotation?
Yeah, Romaine, I think what you're seeing today, right, is that that bet, that the 40% chance of a 50 basis point cut is coming into equities. Obviously, smaller cap companies are more helped by rates coming down. Big cost of their capital is in short-term borrowing. So you can see why you're seeing that rotation. And we do worry. And we have warned clients that there's likely to be some volatility here in the near term as the reality sinks in either direction. So, yeah, I don't think that the rotation, this short-term rotation that we've seen is necessarily sustainable, especially if we're right and we only get a 25 basis point cut next week.
I mean, it sets me up. I was wondering if we don't get that 50 basis points, like, what does the market do? Like, do you see a ton of selling on the front end? Do you see a sell-off in small caps and the cyclicals?
Yeah, there's a chance of that. And that's why, you know, from our perspective for clients, right, what we want to do is make sure we've built portfolios that are more resilient, that are more middle of the road. We certainly have some small mid-cap portfolio strategies that are going to be jerked around by this. But overall, in our largest strategies, like our balance strategy, we want to take the position that for the long term, we know that rates are going to come down. So even if it doesn't all happen next